I did,
Are you starting?
Yep.
Okay, we didn't have your microphone.
Okay, it wasn't. We'll go on the record. It's about 8 o'clock now, and you have some housekeeping matters.
good morning, yes, just a few housekeeping things. First, we had agreed on a number of unobjected exhibits on the Hess side, and I thought it might save some time just to move them into evidence now. So it's HX1 through HX6, HX8, HX10, HX18, HX30, HX32, HX34, and HX35. And so we'd move those into evidence now. I believe that's by agreement.
As long as you use them with a witness.
Yes. And we intend to use those all this morning.
Yeah. So as long as they're used with a witness, I have no objection. But I don't want to blanketly move them in and then not have them used with a witness so the commission has no context for the documents. So I have no problem with Mr. Naresh just going into a document. He doesn't have to lay the foundation, but I don't want to admit documents that are not used with a witness.
Understand and noted, and we'll receive them on that condition.
We'd also like to move into evidence A55, which was used yesterday with Mr. Gatling from the applicant's exhibit list, which was the transcript from Vitesse.
No objection.
And then, again, we could do this, I could prove it up after, but for demonstrative purposes only, we'd like to move in HX 85 to 88, which are the witness slides, Mr. Gatling's from yesterday, and then we have slides for the other witnesses as well, which were disclosed to the other side.
No objection.
So A55 is received, and demonstratives A55 to 88 are received as demonstrative exhibits.
It's HX 85 to 88.
85 to 88, okay.
Yes.
All right, you may call your second witness.
We call Michael Fraley.
Could you spell your name for the record, please?
Michael, M-I-C-H-A-E-L, Fraley, F-R-A-I-L-E-Y.
Could you raise your right hand, please? Do you solemnly swear or affirm under the penalties of perjury that the testimony you're about to give in this matter will be true and correct to the best of your knowledge and belief?
I do.
All right, thank you. You may begin.
Mr. Fraley, could you please introduce yourself to the commission?
Sorry, do I have slides?
Oh, yes, I do have some slides for you here.
Okay, thanks. My name is Michael Fraley. I have two different jobs at Hess. I'm the senior director for commercial for Hess Corporation, and I'm the chief commercial officer for Hess Midstream.
And Mr. Fraley, you just asked for some slides. Are those slides that we prepared to help the commission understand your testimony today?
Yes, they are.
And for the record, that's HX 86, which should be in the white binders towards the end of the second binder. Let's just give the commission a moment to catch up. Mr. Fraley, could you just start by giving the commission a, if you look at slide 2, did you prepare a summary of your testimony today?
I did.
And let's just start from the top. The first one says roles of Hess entities in North Dakota. What are you going to talk about on that issue?
So we're going to talk about three different entities, the upstream entity, the midstream entity, and the marketing entity, and how they work together.
Okay, and the second one is post-production costs incurred in the Bakken. What's that about?
We're going to talk about the various costs around oil, gas, and water, and how those are incurred to get the oil and gas to market.
All right, and the next one is the Hess tariff model, which the commission's heard a lot about. What are you going to talk about on that issue?
Just the overall design of the Hess tariff model, the Hess midstream tariff model.
Okay, the next one, there's third-party volumes on Hess midstream systems. What's that referring to?
We'll talk about the different services, level of services provided to the third parties, and how it is actually to the benefit of Hess Bakken and the working interest owners.
And the final topic there is commercial benefits of Hess midstream systems. Please summarize what you'll talk about on that issue.
So they'll be talking about the different oil, gas, and NGL export options and how Hess HTC has anchored many of those projects to the benefit of the working interest owners and the basin in general.
All right, well, let's start with the first of those topics, which is the entities. If you look at slide 3, the commission has seen this one before, and I don't want to repeat anything that's already been said, so let me just ask a couple of follow-up questions here. That first entity is Hess Bakken. That's the upstream entity that's actually producing the oil and gas, right?
That's correct.
How much of an interest does Hess Bakken have in a well like the subject wells?
It has a paying interest of between 70 to 75% on average.
And why does that vary?
They just different working interest owner percentages and different DSUs, and also the type of royalty.
Then the next entity there's Hess Trading Corporation, which Mr. Gatling talked about. That's the marketing entity.
It is
And then Hess Midstream is the midstream entity, right?
correct.
Now, does Hess have operational control over each of these 3 entities?
It does.
Are all 3 of these entities wholly owned by Hess Corporation?
No, the ownership for Hess Midstream is shown there on the top right. 38% Hess Corporation, 38% GIP, and 24% is owned by the public.
Okay, we've heard a little bit about GIP. What is GIP?
As John Gatling described yesterday, it is a private equity that invests around the globe in different infrastructure projects.
Does Hess have any ownership of GIP?
No,
Does GIP have any role with respect to the day-to-day management of Hess Midstream?
no.
Are there any activities for which GIP approval is required for Hess to be able to do something?
Yes, there's a series of different transactions that they are involved in. So it's not like buying and selling any sort of material assets, entering into a new line of business, a lot of financing and kind of like corporate governance. They're involved in all of that.
Are you personally involved in the process of seeking approval from GIP?
I am. So I have regular kind of interfaces with my counterpart over there, as does Mr. Gatling. So anytime there is a transaction or any sort of business that would require their input or their approval, usually we test it out ahead of time and talk to them, get their input, such that when we do go to the board, then they know about it, so that it's easier to get their approval. And of course, we also have the independent directors looking after the public in that board process.
And how much does the public own of Hess Midstream?
24%.
Now, in your experience in seeking approval from GIP, is GIP a rubber stamp?
Absolutely not. They're an extremely sophisticated investor. And so, like I said, that's why we look to get their input early on, and they'll usually challenge things, and there's a good back and forth with them.
If Hess Upstream wanted to reduce Hess Midstream's tariff rate or eliminate the gathering agreement or anything like that, could it do so without GIP's approval?
Absolutely not. That was one of the issues that Mr. Gatling talked about yesterday. So that we would not have to leave the room, but we would have no say in that. So if there's going to be any change to those agreements, then the independent directors and GIP would ultimately make that decision.
If non-operating working interest owners were not required to pay their share of post-production costs charged by Hess Midstream to the upstream entity, what would happen to their share of those costs?
The share of those costs would then be incurred by Hess Upstream or Hess Bakken, and it would just make the wells less economic for Hess Bakken to drill out.
And what does it mean, practically speaking, if wells are less economic?
Then ultimately you're going to drill out fewer wells in the future.
let's go to the next slide, which is slide 4, please.
Okay.
And I don't want to spend a lot of time on this, but could you just give the commission an overview of what is this intended to reflect?
So again, the Bakken is an oil basin, an associated gas basin. However, to get the oil to market, you also have to handle the gas and ultimately dispose of the water. So this slide is just showing all the various costs that are incurred to ensure that you can get the oil and gas to market.
Okay. And does this fairly summarize the kinds of services that Hess Midstream provides to Hess Bakken and
It
HTC?
does. It does.
So let's talk a little bit about who's incurring these costs and how they ultimately get charged back to non-operating working interest owners like Sinclair and Missouri River.
Okay.
Before we walk into that, once Hess Bakken has produced the hydrocarbon to the mouth of the well, is it possible for non-operating working interest owners to take that hydrocarbon stream in kind?
Yes, any party can ask or elect to take in kind at the well.
And have other non-operating working interest owners and other Hess wells done that?
Yes, we have numerous wells in which a working interest owner has elected to take in kind.
And have Sinclair or Missouri River ever taken the hydrocarbon in kind from the subject wells?
No.
So let's talk about the scenario here where the non-op is not taking it in kind and Hess is handling their production and marketing their production for them. Did you prepare a slide showing the chain from production to charging of the costs?
Yes, slide 5.
Okay, and I brought a blow-up of this because I think we'll bring through it. May I put that on the easel?
You may.
Sacrifice Dan for this one. That happens. Can you all see that okay? Yeah, okay. Now, Mr. Fraley, let's just start from the far left and work our way to the right. The first step is what?
So Hess Bakken, the operator and the producer of the wells, they sell the oil and gas at the wellhead to HTC.
And do they do that pursuant to contracts?
They do.
And are those contracts the HX 1 and 2 in your binder?
Yes, they are.
What happens after that? What's step 2?
Okay, so HTC, the marketing company, they contract for midstream services starting at the well pad. And those midstream services are sometimes with Hess Midstream, sometimes they're with ONEOK, Targa, could be any sort of, many different midstream companies.
And what are we looking at on slide 6?
So we're looking at there what I just spoke about. So the first step being on the left-hand side there, Hess Bakken is entered into the contract to sell the oil and gas and NGLs to Hess Trading Corporation, the marketing entity. And then when you look at that arrow going down, that is HTC entering into midstream contracts with other third parties such as Highland and ONEOK. And then on the right-hand side is the contract with Hess Midstream.
And I see, you say it's the contracts with Hess Midstream. I see other entities under that, like Hess North Dakota Pipelines LLC. What are those entities?
Right, so Hess Midstream, that's the parent company, and it has numerous subsidiaries, and those subsidiaries own the actual assets, and that's who HTC has entered into the contract with.
And there's little tiny screenshots there. Is the gas gathering agreement HX 6 and the crude oil and gathering agreement HX 5?
Yes, it is.
And then the gas processing and fractionation is HX 8,
Yes,
and the export services agreement is HX 10.
correct.
And those are all written contracts.
They are.
Are you familiar with those?
I am.
There was some testimony over I think it was on the first day of this hearing, in which the applicant's witnesses talked about not having any insight into these contracts. So I just want to ask you a couple of questions about that. Does HESM attach these agreements to its SEC filings for the public to see for itself?
Yes, it does.
My other question was, I see that HIBIC, well, I think you told me earlier that HIBIC participates as a non-operating working interest in other wells in the Bakken, right?
It does.
When it does so, is that with operators like Continental, for example?
Yes.
When you do that, do those operators like Continental ask Hess Bakken for its input on the midstream agreements that, for example, Continental is entering into?
No, I've never been asked by any of our operators if, for my input on any of this.
Okay. Let's go back to your flow chart here. The third step was HTC sells downstream. What's that mean?
Okay, so HTC, as we've talked about, they contracted for the midstream services. That would take the oil, gas, and NGLs through the midstream system. So then you're at the tailgate of the plant or the tailgate of the oil terminal. And at that point, HTC enters into numerous different sales contracts. Sometimes it sells in the market, and then sometimes it has capacity on downstream pipelines. We'll talk about that a little bit later. So we have kind of a multitude of different options. And when it's sold downstream, then that could be going to Chicago, could be going to Ventura, Canada, Mont Belvieu, kind of all over the place.
Okay. What happens next? What's the fourth step?
Okay, the fourth step is then we take all those various contracts, so all those different sales prices from the different markets, and we do a weighted average around that price, and then of course the cost that it took to actually get it to those markets. So that's called our WASP, and then we pay that to HIBIC.
Okay, and I had one question about that. I had a couple, actually. One is, do you remember yesterday, one of the demonstratives that Mr. Copsing used, it was, and I don't know if the commission has it, it was number 33 of Mr. Copsing's demonstratives. I've got copies in case you don't want to dig through it. Would you like me to pass some of these out? They're in, you have them in the binders already from applicants. My question is simply, it talked about marketing fees being involuntarily netted out of Missouri River's oil, gas, and NGLs. And it describes that the various Hess affiliates purchase the crude oil, natural gas, and NGLs produced by the subject wells below prevailing values at a profit margin and resell the products for prevailing rates. This action creates a cost to MRRC. And my question is simply, is that accurate?
No, what we do is what I just described. We sell the products either in the basin or downstream at the actual market, like I said, like at Ventura, at Chicago City Gate, wherever there's an index, and then this is just a classic net back that we do.
Now, this process where HTC is incurring the costs and charging them back to HIBIC, is that memorialized in any documents?
Yes, it is.
And take a look at your next slide, slide 7.
Okay.
What are we looking at here?
It's a gas plant statement.
And is this a screenshot from HX34?
It is.
And what is a gas plant statement?
So by well, it goes through and says how much the volumes, the different products, kind of the breakout between the plant products and the gas itself. And then it also details all the various fees associated with getting the gas and NGLs to market.
And where can the commission find the gas-related fees on the gas plant statements?
The bottom left, but it's blown up there as well.
Okay. And that's, for example, the processing fee, the electric fee, things of that nature?
That's correct.
Okay. We'll come back to the gas plant statement in a little bit. So let's move to the fifth and final step of the flow chart. HIBIC pays working interest owners. What's that referring to?
So after HTC has paid the weighted average price minus the cost all to HIBIC, then HIBIC distributes it on a pro rata basis to the working interest owners.
And what are we looking at on slide 8?
That is the revenue statement that's received by the working interest owners.
So that's reflecting that final step.
Yes,
And is this revenue statement a screenshot from HX35?
it is.
And we'll talk more about the revenue statements with Mr. Gauri Kumar later. But does that kind of complete the chain from production to HIBIC? HIBIC making the production and ultimately HIBIC paying working interest owners both their revenue and charging them their share of the post-production costs?
It does.
Okay. So let's now talk about how these post-production costs get set. Are all the post-production costs that Hess incurs set by contract?
Yes, they are.
Does each one of these costs or fees get calculated in the exact same way?
No, we have three different types of fee mechanisms. We have pass-through, fixed fee, and tariff model.
And is that reflected on slide 9?
It is.
Now, did you prepare a table showing how each of the fees from the gas plant statement is tied to a contract?
I did.
And does that table also show how each of those fees is calculated pursuant to one of these three fee mechanisms?
Yes.
Okay, and is that on slide 10?
Yes.
So just, if you look at slide 10, please, just walk us through and orient us to the table. What's the first column?
First column just goes through the name of the different fees, or of each fee.
Okay, and are those the fees on the gas plant statement?
Yes, it is.
Okay, and then what are the second two columns?
Second two columns is the actual contract that each of the fees derives from. And then on the right side, it's the fee mechanism, whether it's pass-through, fixed fee, or tariff model.
So let's go through each of the different mechanisms and explain what they mean. Slide 11 has some yellow highlighting. What's that intended to reflect?
So those are the pass-through fees.
So give us an example to help illustrate what a pass-through is, please.
So like the electricity would be, say, Montreal Williams. It's the fee that Hess Midstream has received directly from the co-op, and then that's just charged through directly to HTC.
And do you often use electricity for purposes of compression, for example?
Yes, more and more. Before we had gas compressors, but just due to the environmental impact, we have moved much more to electric compression.
And so those are fees that you're being charged by the utility company?
Yes.
And just give the commission a sense of the order of magnitude of an electric fee for compression alone, or for compression, for electricity alone.
Yeah, for the gathering and processing, and it was in the plant statement, I think, there before. It can range, usually it's around 50 cents a scuff.
So that's a pass-through utility. I also see you've highlighted something called non-HESM invoices. What's that referring to?
So this is when HTC has direct costs associated with export.
Okay, and so give us an example of what that's referring to.
So that could be like WB on the NGL side. That could be any of the fees associated with REL. It could also be on the residue side, the WBI fees, getting it out of market. We're getting it to Northern Border. So all the costs that are incurred directly by HTC for export.
Now, when you're entering into these agreements for example, on WTI or Northern Border,
WBI.
WBI, Northern Border, do you ever enter into things called MVCs?
Yes, we do.
What is an MVC?
So as Mr. Gatling described yesterday, it's kind of a minimum floor. Generally, with downstream pipelines, they call it also a sender pay, and it's usually at 100%. So that you make that commitment, and what that commitment does is it backstops and kind of finances the building of that pipeline, the building, maintenance, and operation of that pipeline. And then Hess does this with its balance sheet, because generally the pipeline will be looking for some sort of adequate assurances and letters of credit associated with it, so it can be quite expensive.
Why is that beneficial to Hess to enter into these MVCs?
Because it provides us with firm capacity, and I mean the two things it's kind of all for naught if we do all the spend all the money on producing the well, do all the midstream, but then we're not able to export the product. So number one goal is to have flow assurance coming out of our gas plant and out of our terminals.
Do non-operating working interest owners share in the benefit of these MVCs?
Absolutely.
What's the risk of MVCs like this?
The risk is when the volumes don't show up. And when the volumes don't show up, then someone has to pay that MVC.
Non-operating working interest owners share in the benefit. Do they also share in the risk of an MVC?
No, they don't.
Why not?
Hess has just made the decision that it would pay 100% of the MVCs. So if it's not associated with the physical volumes, then we don't charge it back to the working interest owners.
Okay, we'll come back to MVCs again in a little bit, but let me just ask you this while we're on the topic of these pass-through costs. Is there any sort of markup on any of these pass-through costs, whether they're utility bills or non-HESM invoices?
No.
Slide 12, you've added some blue highlighting. What's that referring to?
So they're fixed fees.
And what do you mean by fixed fee?
So it's a calculated number that's a per unit fee. So dollar per scuff, dollar per barrel. So it's for added services. So not every molecule. So it's added services, but it's a pretty small part of the overall fee structure.
Okay, well then let's go to the tariff model, which has been, the subject of some discussion. Did you highlight the various fees charged by the tariff model or calculated by the tariff model on slide 13?
Yes, I did.
So let's kind of start at a high level. At a high level, what is a tariff model? When you're using that phrase, what are you talking about?
Right. So it's ultimately kind of the fees for the services that are provided. As Mr. Gatling explained yesterday, it's the way that these tariff models are set up. It's a 20-year agreements. Starts with the cost of service, and then has a fixed fee period associated with it. During the cost of service period, it's designed for the midstream to invest, maintain, and operate the system to ensure that the HES forecasted volumes get to market, and that HES midstream receives a reasonable return on its investment.
Okay. Now, do you have in front of you a large set of papers?
Yeah, your favorite document?
Yeah, so I handed this out yesterday during the examination of Mr. Tile. This is HX18. And what is HX18?
This is the tariff model.
And I believe this one's for 2021, is that right?
It is.
Now, are these usually kept in Microsoft Excel format?
Yes, they are.
And we looked a little bit at this. I'm going to talk a little bit more about this today. But if you look at slide 14 of your deck.
Yes.
Slide 14 is what the commission saw with Mr. Gatling. And so what I'm hoping to do over the next few minutes is connect the dots between that relatively simple kind of schematic on slide 14 and the actual tariff model. Are you prepared to do that?
I am.
Okay, so let's start with the simple schematic and let's just expand it a little bit. So let's expand that top box where it says capital and op costs and look at your next slide, which is slide 15, please.
Okay.
This is now expanded and it's got some lines in there. And let me just ask you to define these things. Initial capital, what is that?
So that was the capital that had been spent before the contracts were signed in 2014.
Acquisition capital, what is that?
So that's just saying that acquisition capital won't be treated any different than other capital. So this would be, for example, Hess Midstream bought the Summit system or system that was operated by Summit Midstream that was gathering Hess production. So it's just ensuring that that acquisition capital that's tied to the Hess production would also be included.
Build-out capital, what's that?
So build-out capital goes into what Mr. Gatling was talking about, that kind of coordination between the upstream and the midstream with the development plan, which is the nomination, and it talks about the volumes and the drilling that's going to happen, and then, kind of the handshake then with the midstream that will be building out the system plan to ensure that all those volumes get captured. So that's the build-out capital.
Okay, maintenance capital, what's that referring to?
Maintenance capital is, of course, you want to maintain all of this valuable infrastructure that you have built. So that's things that have kind of a lasting impact beyond a year. So think about going and retooling a compressor station or any of the kind of the having to replace maybe a segment of the pipeline or something like that.
Now, why is it important to have all these kinds of capital in the tariff model?
Again, because you want to encourage the midstream to make those investments to ensure that the HES production gets to market.
The next line down is operating expenses less electricity pass-through. So let me just start by asking, what's operating expense and why is it part of the tariff model?
So the operating expense is just kind of to run the day-to-day, make sure everything's flowing correctly and the way that it was intended. So think about pigging and things like that, those sorts of costs. Again, if you're not regularly doing that, then the system is not going to perform the way that it was intended to, and you could have constraints and end up flaring or having to shut in your wells.
Why is that part of the tariff model?
Again, you want to encourage the midstream to be making those investments.
And it's structured as OpEx less electricity pass-through. Why?
Because as we talked about before, the electricity pass-through gets charged directly through, so it just gets taken out of the tariff model.
Now, how do OpEx and maintenance capital actually get plugged into the tariff model, and has that changed over time?
Right, so it has, so originally it was as an estimate, the OpEx and the maintenance capital. It came in that way because the midstream was an MLP and it needed an element of risk, and therefore it was put in as a forecasted number. And then that forecasted number was between the upstream and midstream was part of that development plan, system plan process.
And was that set out by contract?
It was, and as Mr. Gatling talked about, it's a kind of a very rigorous process that's happening, every year, happens, multiple months through the years, kind of back and forth.
Well, and that's where I was going next. My question is, and I think you alluded to this earlier about system plans and development plans. What is that, and how do those give you comfort about the accuracy of those forecasts?
Right. So, it's an annual basis. It starts with the upstream putting together that nomination or development plan about where they're going to go out and they're going to drill the wells and the activity that they're going to have. And then it's the midstream responding by saying, hey, here's the build out that we will do to make sure that all of your products get to market, which includes, the operating and the maintenance capital to ensure that everything flows the way that it's intended to. And again, it's an annual process, right? So there's a lot of rigor that goes into it. But there's also a lot of knowledge from prior years. So when there was that estimate or forecast being done, it's with a lot of insight about what the prior years what it looked like.
Now, has this process that you just described, not on the system plans, the development plans, but the use of projections, has that changed over time?
It has.
And how did it change and why?
Right. So in 2020 during COVID, there was a plan to do a turnaround of the Tioga gas plant and expansion. It was deemed that because of COVID and we didn't want to risk having it be delayed for a period of time, we went ahead and delayed that for a year, the actual construction and turnaround associated with that. So that turnaround cost had been put in as a forecast for the year because when the budget got put together, it was intended to be done. It then got delayed, and because it got delayed, then if we would not have changed the way that it was done, then it would have been counted in 2 different years. The midstream board, the independents, GIP, everyone agreed that was not what was intended. Again, this was for a risk element for the midstream, and also the midstream was no longer an MLP. So due to those 2 factors, it was agreed that that it would be trued up from then on.
And is that how it's done today?
It is.
Okay. So let's go to the next slide, which is slide 16. And I see you've built out that box a little bit more by adding some purple text. It says add backs, and projected non-HIBIC revenues. So let's just take those in turn. Add backs, what is that?
Right, so we've kind of gone through the gross cost before. What this does is it ultimately makes it a net cost. And what it does is it takes the revenue that's being generated from the HES operated production and it reduces the overall kind of cost bucket.
And then projected non-HIBIC revenues, what's that about?
So again, that's I had mentioned the benefit of having third parties in the system, and this is referencing the third parties.
Okay, so let's talk about that a little bit more, and flip to slide 17, please. What are the benefits of these non-HIBIC volumes?
Okay. So first, going back to the development plan, system plan process, anytime that happens, and of course, that's not just looking out for the next year, it's looking out for the entire contract period. So anytime that the upstream is looking to go drill in an area, then we go and look to see if there's any third parties in that area as well, and then just have a natural synergy. So if you're building out a pipeline and, you know, it was going to be an 8-inch just with the Hess production, you could upsize it to 10 inches, or if there's, you're looking to build a compressor station. So it's ultimately just trying to find synergies in the system to lower the kind of the per unit cost.
Then number 2 is reduction of tariffs. I think you've covered this already, but briefly, what are you referring to there?
Well, again, by bringing third parties into the system, what that ultimately does is you're increasing the kind of the denominator. So if you increase the denominator, it's a per unit tariff, right? It's $1 per scuff. So if you can bring in more volumes, like these third party volumes, on a very efficient basis, then it just ends up reducing the tariff cost that is going to be incurred by Hess Upstream and the working interest owners.
Okay, and then number 3 is anchoring building optionality. What's that about?
So that's what we were talking about a little bit before, and we'll talk about near the end, is just having more volumes in the overall system allows Hess to then use its balance sheet to support the building of export, so different takeaway options for the basin.
Okay, and we'll come back to that. Now, the commission heard some testimony from Mr. Atala yesterday about the difference in the rates for third-party services using HESM systems as opposed to the rate that HIBIC itself pays. Did you hear that testimony?
I did.
Now, do the third parties, and does that third-party rate reflect the same service that HIBIC itself is receiving?
Absolutely not.
Okay, tell us about that, please.
So Hess has priority into the system. But again, as I was describing there before, you want to get as many volumes into the system as you can. So if there is any excess capacity, then you look to fill that excess capacity because it ends up driving down the rate for everyone on a go-forward basis. But then thinking about the third parties, and specifically the example you asked about, that was the Robb Lake facility. And Robb Lake, the way that they had built their plant was that the residue gas coming out is a 1240 BTU, which does not meet the FERC pipeline, the Northern Border spec. You know, they're looking, WBI and Northern Border are looking to have about 1,100 BTU gas. Therefore, Robb Lake was taking that gas to Hess, and Hess was basically cleaning it up. So taking the ethane out and then being able to send the residue gas that was now pipeline quality to Northern Border.
Okay, now, you mentioned, so it's a different actual service that's being provided, true?
It is. I mean, and there's no liquids. There was nothing in that. That was just a ethane and methane stream.
Okay, and then the other thing that you mentioned was something about priority, and we've heard a lot about priority in MVCs. Do third parties using the HESM infrastructure have the same priority as HIBIC does?
No, they do not.
Now, is that a theoretical issue, or is the lack of ability to access midstream infrastructure something that actually happens?
It actually happens. Have a few examples to go through. So I think Mr. Donovan in his opening mentioned this, that kind of it's akin to a, you know, having, you know, being the first one on a flight versus somebody standing around with a standby ticket and hoping and praying that they get on a flight. When you have firm capacity, you know you're first in line. When you're interruptible, who knows what's going to end up happening. So in this example here,
And are you on, what slide are you on?
page 18.
Okay, slide 18.
Slide 18.
What are you showing here on slide 18?
This is the third party that was that comes into the Hess midstream system. That's Crescent Point. those volumes from Crescent Point, when they started doing some of their drilling, it was at the same time that a lot of the Hess production came online. And because of that, there were a number of months, and we'll talk about the GOR increasing and things later on, but there ended up being a lot more gas than there was availability in the system. And because of that, they ended up having to flare on their pads about 50% of their gas for a number of months.
And that's because they didn't have priority and you did.
That's correct.
Okay. Now, that's on the HESM system, right?
That's right.
Have you experienced, as HES operating on other third-party systems, non-HESM systems, do you always have priority on those non-HESM systems?
No.
And have you ever been forced to curtail, shut in, flare as a result of not being able to access those third-party systems?
Yes, we have. And Mr. Gatling talked about that a little bit yesterday. So, we have Kinder Morgan, One Oak, Targa. We've got a number of different midstream companies that do provide services to us. Summit before, and we ended up buying them out because of the poor performance. With Kinder Morgan, there was a number of that's been going on for many years with that contract. And yes, we've had a number of wells that they were flaring, and it actually resulted in us, or it has resulted in us, a number of times having to shut in the production. And as we've talked about, this is mostly an oil play or an associated gas play. And if you shut in the well, then of course that kind of destroys your economics because it's in the oil basin.
Now, you mentioned earlier gas to oil ratios.
Yes.
The commission's familiar with gas to oil ratios, I'm sure. Are you familiar with them as well?
Yes.
And have the gas to oil ratios stayed constant here in North Dakota for, in your experience?
Not at all.
And where are they trending?
Up.
What does that mean?
I think every year, we get a little, every year it just keeps marching up higher and higher.
What does that tell us about the availability of gas infrastructure, midstream infrastructure in North Dakota?
It's critically important.
And what does that tell us about the value of priority service as opposed to interruptible service here in North Dakota?
Yeah, it's critically important. If you need we have stricter and stricter regulations. Mr. Gatling talked about that as well. Not only the state, but these different federal regulations that people are talking about. So having that priority space and being able to get your gas and NGLs in a pipeline are critically important to be able to produce the oil.
Let's go back to the tariff model. Slide 19, please. This is the same one that we looked at earlier. And I'd like to go from that top box to the next box, which is volumes. How do volumes factor into the tariff?
Yeah, so I think maybe I got ahead of myself a little bit. The volumes, it's ultimately a per unit tariff, so cost per volume. And therefore, the more volumes that you can attract to the system, the lower the overall tariff is.
And how do you go about projecting your volumes in any given year?
So from the upstream, that's part of that development plan process, right? So then the upstream will bring to the midstream, like I said, not only the drilling plan that it's going to have for the next year, but for the remaining contract period. Of course, the earlier years are going to be a little bit more kind of accurate, but yeah, it's the drill out for the next, 10 years.
We talked about the MVCs that HES has on the non-HESM systems, when we talked about the pass-throughs.
Yes,
Do you also have MVCs on the HESM systems?
we do.
Do those MVCs also benefit working interest owners, non-op working interest owners in the same way that we talked about earlier?
Yes, they do.
And do non-op working interest owners share in the risk of the MVCs on the risks of the MVCs on the HESM systems?
No, they don't. So just like the downstream pipelines, Hess they receive the benefit of this, but they are not charged any of the cost. That is all incurred 100% by Hess.
And Mr. Gowling was asked yesterday about whether or not Hess actually pays costs pursuant to any of these commitments, and he said yes. And is that consistent with your understanding?
Absolutely.
And just give the commission a sense of the amount that Hess has paid in MVC costs over the last 8 or 9 years.
So remember, he talked about these MVCs are 3-year rolling MVCs. So obviously, it's very difficult to forecast what's going to happen 3 years ahead of time when you have price swings, you have COVID, you have things like that. But it's been, every year, it's been in the tens of millions,
So over the last 8 years or so, we're talking
hundreds
maybe
of millions.
hundreds of millions, and have non-op working interest owners paid a dime of that.
They have not, and they benefit the non-ops because they go into that revenue kind of deduction, that add back.
You also heard some testimony about the POP contract at Robinson Lake.
Yes.
Now, as commercial director, are you familiar with the POP contracts?
I am.
When you have a POP contract, do the midstream costs that you're incurring show up as fees on a revenue statement or on a check detail?
No, they're taking your product, your oil and your gas.
Let's just talk about the economics of a POP contract. What happens under a POP contract when the commodity prices are low and the contract has an economic out clause, like the one that we looked at a couple days ago?
Right. So then usually what's going to happen is, and most midstreams have kind of moved away from that and gone to fixed fee. And the reason they did that was that they weren't making any money. So an economic out clause allows them to somewhat put a gun to the upstream, the producer's head, because they're saying, hey, we don't have to take your gas, so you're just going to have to flare it.
So that happens if the commodity price is low. Is a POP contract a good deal for working interests when the commodity price is high?
Well, no, because then they're taking the oil, the valuable liquids, the NGLs, the gas, and they're getting to keep that. So that's effectively what your fee is.
The final box on slide 19 is, says return on capital. What's that referring to?
That is the reasonable rate of return that is then provided to the midstream for its investment.
And why is that part of the tariff model?
Again, it's encouraging and ensuring that there is a return on the spend. So if you're not getting a return on your investment, then you're not going to get anyone to invest.
So now let's go from the schematic and let's start to build the model back up to HX18. Look at slide 20.
Okay.
What I'm hoping we can do is show how the contracts actually connect to the tariff model itself. And what are we looking at here on slide 20?
Right. So this is cover page to the second amended and restated gas processing and fractionation agreement. And then on the right side is the article and excerpt of the fees
Yeah.
section.
And this is HX8, right?
It is.
And what does this provision of the contract tell us about how this particular fee is calculated?
Yeah. So it says the customer, which is HTC, shall pay to the provider, Hess Midstream, a fee in accordance with the terms of this agreement. And then it looks to the aggregate volumes. So it's looking to the Hess operated volumes and the third party volumes. And then you multiply that by the combined processing fee, which is further described in Exhibit G2.
And do we have G2 on slide 21?
We do.
Tell us about what G2 from the contract is telling you to do with respect to the combined processing fee, please.
Right. So there's two different things going on here. You take the Hess operated production and the estimated volumes associated with that, along with the tariff fee that's been calculated every year. And then you have the third party volumes, and those are the ones that we go out and negotiate. So like say the Rob Lake one, and the fees that we get associated with that.
Okay? And does the contract provide any guidance on how to set up the tariff model to do the return on capital calculation that you talked about earlier?
Any guidance on how to set up the return on capital?
How to do the math to make sure that the numerator set up the right way and the denominator set up the right way? Let me withdraw and ask a different
Yeah.
question. Does the contract provide any guidance on how to connect this calculation to the tariff model itself?
Yes, it does. So you do this calculation, and then ultimately that was the netbacks, that we saw before. So you're adding in the revenue associated with all of these volumes to reduce the overall kind of cost that you then get the return on capital.
Got it. Okay, thank you. Now,
Yeah.
take a look at slide 22. What is slide 22?
Slide 22 is the example fee calculation.
And is this part of the contract itself?
It is part of the contract.
And what is this showing?
So this kind of does a simplified version of the document that's in front of me. So it goes through and describes how to calculate the fees.
Okay, so now let's just, so put the slide to the side if you would, and take HX 18, which is the printout of the tariff model from 2021. And the first page just reflects that it was produced in Excel. And let's just walk through this for a moment. Slide, the first page of HX 18, what is that?
First page. So it is the tariff rate summary.
And what is a tariff rate summary?
So it goes through tariff by tariff, and it talks about what the fee is for each year.
Okay, and then pages 2 through 5?
So then this goes through all the different MVC calculations that we've talked about, the nomination throughputs, shortfalls that again, that's the what Hess has paid for 100%.
Okay, and then page 6 is what?
Page 6 then is the various inputs that go into the model.
Okay, and then on page 7, there's something called input actual. And that goes all the way from page 6 to, it's about 160 pages, right? What is this section called input actual?
So these, effectively, this is all the investment that has been made through the years.
All right, and then we finally end up on page 165. And how does page 165, and let's just give the commission a moment to catch up. How does 165 line up with the example fee calculation that we see on slide 22?
So it's the same document, it's the same calculation.
At the end of the day, are non-operating working interest owners like Missouri River and Sinclair paying any costs, post-production costs, that are higher than what Hess Bakken itself incurs?
No.
As somebody who has a role both on the upstream side and the midstream side, is there any benefit to the upstream side to inflating the tariff?
As we described as I described at the very beginning, Hess pays around 75% on average, and its ownership in the midstream is 38%. So it'd be illogical to want the fees to be higher.
All right, now, I'd like to turn to your final subject matter, which was the commercial benefits. And if you would please, well, before we go to slide 23, let me just ask you about this. Mr. Gatling talked a fair bit about the operational benefits of the infrastructure, and so let's just translate that into the commercial benefits. And at a high level, as the commercial director, what are you looking at in terms of being able to market the production? What are your goals?
So number one is flow assurance, because again, if you can't, you can spend all the cost on the upstream and on the midstream, but then ultimately, if you can't export your product, then it's all for naught. So you need to have flow assurance.
Okay,
And then number two is price optionality. So you want to be able to get to as many markets so that you can kind of do that arbitrage and play between the different markets.
let's go back to 2012 or so. In 2012, what kind of options well, did Hess have a lot of options to get gas and NGLs to market?
No, it's basically it had one. It had two different connections.
And are you looking at slide 23?
Sorry, yeah, I'm on page 23. On the left side, the residue, you basically had Northern Border. So we had a private line, and then you had the WBI kind of legacy system tying into Northern Border. So you had one outlet.
And what about NGLs? Did you have a lot of options there?
No, there it was relying on truck and rail. So, and if you had weather conditions and things like that, you could get shut in.
And I think you kind of, that's where I was going. Why was it a challenge to have limited options to be able to get the gas and the NGLs out of the basin? Why did that present like an economic challenge?
Yeah, because no one had kind of built out. Nobody had anchored the projects. You had the rising GORs, and you just didn't have a lot of options to be able to move the product.
At the time, were there any plans to develop more infrastructure to get the gas and NGLs out of the basin?
Yes.
Take a look at slide 24. What is that showing?
So the plans, Hess expanded, actually, we kind of, I guess, tore down the old plant and then rebuilt the 250 million scuff plant with the fractionation, the 60,000 barrels of fractionation. And this just represents the various kind of third-party export options that Hess used its balance sheet to essentially finance through the various commitments, the MVCs, the sender pays that we talked about before, so that they would build and provide that optionality and flexibility.
Have you heard the term anchor shipper?
Yes.
And what does that mean?
It's what I was just describing. So, a pipeline company will not go out and build. What they usually do is they come start talking to the customers they think ahead of time that will anchor their project so that they can take that to their lenders and say, hey, we're going to have renters or whatever come and use the space. And they'll usually do that ahead of their open season even. So Hess is anchored. Basically everything you're seeing there on the page, Hess was anchoring that and using our balance sheet to ensure that got built, which obviously benefits the working interest owners, but it helps the entire basin.
This was 2012, over the last 10, 11 years, has Hess continued to anchor the development of gas, both residue gas and NGL projects in the basin?
We have
Are you on slide 25?
25, yeah, I'm slide 25. So then when we went from the 250 up to 400, that now produces Y grade. We didn't expand the frac further. So again, we backstopped in the project, the One Oak project, as well as most recently the Cheyenne project, so the Bison project that will get you over to Cheyenne.
Okay, and then early on in your testimony, you talked about this being an oil play with associated gas, and so I just wanted to spend a moment on oil optionality as well. What is slide 26 showing?
So just it's just the Hess philosophy. The overall philosophy is that, again, flow assurance, number one, and then having different markets that we can take advantage of. So that's what this is showing. So there's the pipelines and then the rail options.
And can you give the commission any examples, real life examples of why optionality matters in the context of oil too?
Yeah, so for a number of years, we were railing crude over to the PES refinery in Philadelphia to take advantage of some Brent pricing. That facility has since burned to the ground, so that's no longer a market that we can access. However, for flow assurance and for price, we still have many other options.
And if you hadn't had those options and your prime customer had burned down, what would you have had to do?
You'd ultimately have to shut in if you had nowhere to take the product, or you'd probably just sell it for a discount.
And would selling for a discount be a good deal for Hess or the non-operators?
No.
Okay. Now, at a high level, talking about oil and gas, why is this export optionality a good deal for Hess and the non-operating working interest owners?
Ultimately, it helps us to achieve the highest price, and that's good for Hess and the working interest owners. And then, as we talked about, having that firm space on all of this, ensures the product gets to market. And then in the downside, again, is if you overcommit and you have those MVCs, that Hess picks that up 100%.
And do non-operating working interest owners share in that same price that you get?
Yes, they do.
Pass the witness.
Good morning, Mr. Fraley. We met last summer in Houston.
Yeah, I remember.
It was warm.
Was. Usually is.
Yeah. Mr. Naresh asked you some questions about Hess attaching copies of contracts to public SEC filings. Do you remember that?
I do.
Those contracts are heavily redacted, aren't they?
I would not say heavily.
You'd say redacted?
Yeah, there are certain sections, I think very limited sections that are redacted.
The economic terms, for instance?
I believe the IRR is one, yeah.
And if Hess is interested in making its contracts publicly available, do you know why Hess insisted on a protective order in this case with attorney's eyes only provisions?
I have no idea.
Okay. And for instance, the giant exhibit, HX 18, says at the bottom, confidential attorney's eyes only. You see that?
I do.
Okay. And does attorney's eyes only mean to you that parties can't look at this document?
You're asking me to make a legal interpretation?
You are a lawyer, right?
Yeah, I don't practice as a lawyer anymore, so inactive status, I gave it up.
And you don't know what attorney's eyes only means?
I assume that's, means that it's supposed to have only attorneys looking at it.
Mr. Naresh asked you a question about any benefits from inflating a tariff rate. Do you remember that?
Yes,
And you said there was no benefit to the upstream side, right?
correct.
You'd agree with me that the benefit to inflating a tariff would be to the midstream provider, right?
Benefits of inflating tariff. I guess in that hypothetical,
Is it true that Hessam makes $2.7 million per day?
sorry, on that last question, I mean, if it's gonna drive your customer, your upstream customer, inflating that tariff, it's gonna make your upstream customer drill less wells, then it wouldn't be good. And that's why you see a lot of times there's renegotiations of contracts, because the midstream fee becomes too large, and therefore the upstream can't justify drilling out. So it's not always beneficial.
You'd agree with me that a benefit to inflating a tariff rate would benefit the midstream provider?
Could, it depends on the circumstance.
Okay. Is it true that Hessam makes $2.7 million a day?
I don't know how much it makes a day.
Are you aware of any company in North Dakota that's more profitable than Hessam?
I didn't look or prepare for that.
Did Hess solicit bids from any third-party midstream providers for the services that were ultimately provided pursuant to the gathering and processing agreements with the Hessam entities?
Sorry, could you say that again?
Sure. We've talked about the gathering and processing agreements
Right.
in this case. Did Hess solicit bids for those services provided pursuant to the agreements from any third-party midstream providers before entering into the agreements?
So there's things called, in the agreements, conflicting dedications. So there are prior agreements that Hess had with other third-party midstreams.
Did you ask those other third parties to bid on the services that were ultimately provided to the gathering, pursuant to the gathering and processing agreement?
I'm not aware. It was, this is before my time in the Bakken, but again, yeah.
If it happened, you don't know about it.
I don't know about it.
And to your knowledge, Hess never sought the approval or input of any working interest owners before entering into the gathering and processing agreements?
Yeah, I'm not aware of that process as a operator or as a non-op, that happening.
And we talked a little bit about Global Infrastructure Partners. You're familiar with them?
Yes,
And it's true that Global Infrastructure Partners and the public did not own any interest in Hessam when the gathering and processing agreements were initially entered into, correct?
that they didn't own any interest in Hessam.
Right.
Hessam isn't publicly traded.
Can you just ask it again? I don't think he's understanding.
Sure.
Yeah.
When the agreements, gathering and processing were initially entered into,
Yes,
Global Infrastructure Partners and the public did not own any interest in Hessam, correct?
Are you saying in like in Hess Corporation?
No, in Hessam, Hess Midstream.
No, they did not own any interest in Hessam.
That interest was acquired after the agreements were entered into.
Oh, yes, sorry. Sorry, I was thinking Hibbik when you said Hessam before. My apologies.
Okay. But I'm right. The interest that.
Yeah, you're correct. They did not own any interest in Hessam.
Okay. And would you agree with me that Global Infrastructure Partners, for instance, would have no motivation to reduce the tariff rate under the gathering and processing agreements?
Again, I'd go back to the answer I gave before. If the rates were at such a level that the upstream didn't have a well inventory because it was too expensive, then that would be a reason why they would want it to be reduced.
So in other words, if the tariff rate got so high that nobody can make any money, that would be a problem.
So, and you see that in the market where there's, yes.
And you'd agree that Hess is guaranteed, or Hessam is guaranteed returns of 12 and 14% on gathering and processing services, right?
Yes,
And that return is not just on capital expenditures, it's also on operating expenses, right?
no,
It's not on operating expenses.
no.
Okay. If you could look at, it's your slide 22. And you have your reading glasses. There's a section, in slide 22 is an example tariff fee calculation, right?
It is.
And there's a section called cost estimates, right?
Yes,
And the first cost estimate category is initial capital. Second is system acquisition costs. Third is committed build-out costs.
yes,
Fourth is maintenance capital estimates.
yep,
And fifth is operating expenses.
I see that.
And all those cost buckets get added together in line I, right?
Yes,
Which trickles down through the formula into the required cost recovery section, right?
yeah, I think when you look at, and again, I probably need to get stronger glasses, but that I, you then subtract out M, I think it's M there, right? So you do that and it comes up with N. And then when you look at the NPV, it's N, so you've subtracted out your revenue at that point. And the revenue is always higher than the operating cost. And therefore, you've already deducted out the operating cost.
So your position is that operating expenses don't recover a rate of return because revenue is higher than operating expenses?
Yes.
You don't know how the rates of return in the contracts were determined, do you?
My understanding is the same as what Mr. Gatling said yesterday, that we were looking for the company was looking at the lowest return that would still attract private and public investors.
Last summer in Houston, you didn't know how those numbers were determined, correct?
That's correct. I've since had conversations with people.
And the tariff rate is recalculated annually?
Yes, it is.
And you'd agree with me that Hess does no annual research to make sure that the tariff rates for any particular year are fair market rates, right?
Sorry, could you repeat that?
Sure. So the tariff rate recalculates every year under the contracts, right?
Correct.
And you'd agree with me that Hess doesn't do any research each year to make sure that the tariff rate for that year is a fair market rate?
We abide by the contracts.
You just rely on what the contract says?
That's correct.
Under the gas purchase and sale agreement, Hibbik has the right to request audits of Hess Trading, right?
Yes, it does.
And to your knowledge, that's never happened?
Hibbik auditing HTC?
Yes.
Not formally. I'd say that, we have internal audits, so that, yeah. so not formally.
You talked about and I may be phrasing it wrong, and if I am, I'm sure you'll correct me. The minimum volume commitments don't get charged to non-ops. Remember saying that?
Yes.
Something like that?
Yes.
Where in the agreements, either the gathering or processing agreements, is that provision included?
In the gathering and processing agreements?
Right.
So the gathering and processing agreement is between HTC and Hess Midstream.
Right.
So it's when HTC is, the chart behind you, when HIBIC then pays the working interest owners, it just doesn't, it has agreed, or it's decided that it would not charge the MVC back.
In other words, it just does it. It's not required by any contract.
You could probably say it was an actual and reasonable charge, but they've decided, the decision has been made that if it's not tied to physical volumes, that it's not going to be charged back to the working interest owners.
And Mr. Naresh asked about the financial impact of those minimum volume commitments on Hess, and you said its cost has hundreds of millions of dollars,
It has.
and that amount is still less than Hess's gain on selling its partial interest in Hess to GIP, correct?
It's getting to be pretty close.
Okay. Still less though, isn't it?
Yes.
You'd agree with me that if the tariff or third-party volumes are greater, let me step back to set the stage. There's dedicated production estimates each year, correct?
Yes.
And if the tariff or third-party volumes, the actual volumes are greater than those dedicated production estimates, the actual volumes don't count to reduce the tariff, right?
Okay, so, yeah, because I heard Mr. Atala talk about this as well. So, so there's guardrails kind of in the contract, because again, there's the tension between Hess Midstream and Hess Upstream as they're going through that, kind of that rigorous development plan, system plan process. So because the upstream is the one that makes the nomination every year, there needs to be the guardrails that Hess Midstream has, and the protections is the MVC that we talked about just now on the low side. And then on the high side, it was saying anything above 100% nominations, to the point you were making. And the protection there is that if there wasn't that mechanism, then Hess Upstream could say, hey, I'm not going to have 10 volumes coming through. I'm going to have a million. And then, again, it's a per unit tariff, so then your tariff drops down to nothing. So it's a protection mechanism that Hess Midstream has, because the nomination is made by the upstream.
Hessam surely would not want the tariff to drop down to nothing, correct?
Hessam?
Yes.
I don't think the independent directors and the shareholders and the people who have invested in the company would want that, no.
Okay. And I lost track of your answer, and you've been here long enough to know there's a thing called redirect, and Mr. Naresh will get to ask you lots of questions. So let me ask it again. If the tariff or third-party volumes are greater than the dedicated production estimates, the excess of the actual volumes don't count to reduce the tariff.
That's the guardrail I just talked about.
And in making those dedicated production estimates, in your words, you would sure as heck rather be low than high, correct?
That's right.
And you can't recall any year where the actual gas received was less than the estimate, correct?
The actual gas received is less than the estimate. Sorry, what estimate are you talking about?
The dedicated production estimate.
No, I think there's probably been some periods that happened.
You remember me asking you about this in Houston?
Can you get a page in line?
Yeah,
I'm
123.
gonna give him a copy
line
of his.
4. Sure, please.
Say it again, please.
123, line 4. Let me know when you're there, Mr. Fraley.
Sorry, 143. Okay.
I think you said you couldn't recall a year where the gas actually received was less than the estimate. Question, mark. Answer, so again, this is more in my personal capacity. but when we review kind of each year, kind of our forecast and how they have done against actuals, we trigger a lot of MVCs. But I can't recall us ever going, HDC, and I can't recall it ever going over the 100%. Was that the question I asked and the answer you gave?
It appears to be.
Okay. And you'd agree with me that the Tioga gas plant is not currently operating at capacity?
Not currently.
Okay. And Mr. Naresh asked you a question about working interest owners taking in kind from Hess?
Yes.
You said that happened.
Yes.
Is that a recent development?
I even mentioned it, yes, it is.
Okay. Because when I asked you that question last summer in Houston, you said no working interest owner in the Bakken had taken in kind from Hess.
Right. So at that time, it had not happened.
So is one reason a working interest owner would take in kind concerns about high production costs and producing overhead?
I don't know why they would take in kind. I think one option could be that they had, I don't know. It could be a variety of reasons.
Okay. And is it true that Hess does not take any gas in kind on its non-operated wells in the Bakken?
I believe we actually do have a couple of wells that we've taken in kind in the past.
Is that also a recent development?
No, I had gone back and asked the question after the
So you
deposition.
may have just been wrong in your deposition.
It's only a couple of wells, so it wasn't a major thing that I really knew about at the time.
Mr. Naresh asked you some questions about third-party rates. And we both agree the third-party rates are lower than the tariff rates, right?
We do.
Okay. And Mr. Naresh asked you about whether the services are different, and you said that they were. And your example was Robinson Lake sends gas at 1240 BTU that needs to be reduced to put it on a PERC pipeline, right?
Yes.
But not all the third-party gas coming to Tioga is from Robinson Lake, is it?
No.
Okay. In fact, we know that because of your Crescent Point example, right?
Yes.
Okay. So even for the gas coming from Crescent Point, the rate you're charging for that gas to be processed is still less, far less than the tariff rate, right?
The gas that actually gets there, a lot of it gets flared.
And you talked about the importance of priority and waiting in line to get on a flight, but Tioga's not at capacity, right? We established that.
Well, right, but you have to get to the pipeline first, then a compressor station, and then to the processing plant. So just because the processing plant isn't full doesn't mean that there's no constraints in the overall system. It's actually very complicated.
But when you get to the gas plant's not at capacity, right?
Not currently. It will be, no. Yep.
Are you familiar with a letter filed with the commission, I believe on Monday or Tuesday, from Riverbend Energy and Alcaraz Energy?
I'm not familiar with that.
Haven't heard about that? Okay.
I've heard the name Riverbend.
Okay. Well, they make some allegations in here that I'm just gonna ask whether those apply to my client. And on page 2 of their letter, they write, HBI charges far more than other operators in North Dakota for well operation services at the working interest owners' well sites. Is that happening with my clients?
Could I see a copy of
Sure.
whatever?
It's on my computer. I can print it out.
Okay, can you just read it again?
Sure. HBI charges far
Can I
more.
look at it with you?
Yeah, sure.
Yeah.
HBI charges far more than other operators in North Dakota for well operation services at the working interest owners' well sites. Is that happening to my clients?
So this is an allegation that's
This is
being
an allegation.
made by a party?
It is.
Not that I'm aware of.
They continue. HBI also unilaterally imposes on working interest owners excessive costs from its affiliate, Hess Midstream, for constructing, operating, and earning a return on investment in midstream assets, including but not limited to the multi-billion-dollar Tioga processing plant. Is that happening to my clients?
Not that I'm aware of.
And last, in Hess Corp's zeal to transfer more and more value to Hess Midstream, HBI has failed to A, negotiate reasonable, competitive terms to deliver oil and gas production to market, or B, consider whether capturing more gas or paying to construct new infrastructure is even sensible for working interest owners. Does that apply to my clients?
Sounds like they're confused. Again, we pay 75% and receive 38, so there'd be no zeal.
No further questions.
Any redirect?
No redirect, thank you.
All right, thank you. Any staff questions?
I just want to clarify some things on the slide you have up here.
Yes.
So, the first circle, it says Hibbik sells at wellhead to HTC. Is that sales point, the lacked sales meter?
For the oil, yes, and then the gas sales meter.
Okay. And the fees we're looking at here are incurred under HTC contracts after that initial sales point of the gas from Hibbik to HTC.
Right, so the way that it works is that the purchase, so Hibbik sells the oil and gas under those two different contracts to HTC, and then the various, cost associated with that is what we were talking about, gets netted back. So there's all the different value coming from the various contract that's selling downstream, and then the cost associated with it is taken out of the sales price.
Right, and those fees are under the HTC and various midstream contracts.
So those are part of the fees, but yes,
Okay, thank you.
welcome.
Michael, you didn't get into your water costs, but you did have some listed in some of your exhibits.
Yes,
What
sir.
happens to water if it were to go to, say, a frack, where you'd use production water to frack a well? Does Hess utilize any of that?
I think we've done it in one example, so we are starting to trial that and look at that. Especially, if we can have that synergy that we're about to kind of build out to that well anyway, right? So then when it fracks, well, we could take the water over there, use it for the frack, and then once it's producing, then we can actually then gather, right? So it goes the pipeline goes one direction at first, and then as soon as you've actually fracked and it's actually producing water, then we could have it go the other way. So we see there's a synergy in doing that.
So what do you do as far as charges? Does the well that you're taking the water from, does that get billed out to all of the working interest owners?
The well that we're taking the water from. So far, I believe we just took all the costs because we did a pilot. So this has not been something that we've kind of spread out throughout the basin
Okay,
yet.
but according to your tariff, what would happen if you started taking your production water and using it to frack? Would the working interest owners of those wells that you're taking that water from and going to your frack, would those owners get charged for disposal costs?
If we took it over. So right now, that's not in the contract. So that's not anticipated in the contract. So if we were to do that, then we would have to make an amendment to the
Okay, so
contract.
right now, they would get charged for it, even though the water was utilized for beneficial use in a frack, right?
So there'd be, they would pay the gathering fee, but they would not, to get from the well site to the producing well site to the injection well site. They would pay for the use of the gathering system to get there, but they would not pay a disposal fee.
And what happens to the wells that you're fracking with it? Do they get charged for that produced water that you're using to frack with?
Yeah, again, we've only done the pilot at this point, and so we haven't set up that structure. So I think we had one well, and I believe we incurred all the cost for that. Because, right, if we weren't using the frack water, we would have been having to go and pay someone to bring in the frack water. I'd have to go back, apologies, I'd have to go back and look to see how that accounting was
Okay, well,
actually
the
done.
purpose of my questioning is, do you charge on one end and then you charge on the other end, so you're kind of double billing on water that's being used for beneficial use?
Well, right, so again, we've only done a pilot at this point, so this is not something that's been done, but we would not be looking to in any way, double dip.
And you're saying that the tariff doesn't account for that right now?
Right, so right now the tariff would have the gathering charge, you'd get the gathering charge, but you would not pay for the disposal because you're not using the disposal.
Does any of your produced water go into any EOR projects, water injection?
Not currently.
You talked about the tariff on the gas compression and operating and so forth, transportation. Are costs to fractionate at the Tioga Gas Plant, are those passed on to the, in the tariff itself for the gas?
Yes.
But the working interest owners and non-ops, they're not benefiting from any of that, are they?
Yes, they do, because of the purity products and the fractionation. We go out and market that and get a premium for the fractionated product that we sell. So there's a kind of the local sales market, so we have a team that is in charge of doing that, so selling the various purity products.
So they're also getting a portion of
They
the
get-
propane, butane, and so forth that you're selling?
Right, so in that step, sorry, where we say we calculate the weight or the sales downstream and that HTC calculates that average price, they get the uplift or the benefit of those higher sales proceeds associated with that product has already been fractionated.
There's been talk, of course, about the guaranteed rates for gas gathering of rate of return of 12% and gas processing of 14%, right?
Yes, sir.
What are the actual rate of return, do you know?
I don't know.
But it's going to vary. It's not limited to 12 and 14, right?
The calculation in the tariff model, is Mr. Tala and Mrs. Adair will be talking to. It's targeted so that it will ultimately get you a 12% rate of return over the cost of service period for the piece that is not so for the costs that are subtracting out the residual value. Right, so that portion of the assets, if you will, that get utilized in the cost of service period.
Why wouldn't you know what the actual would be? I mean, I could see if you're recalculating it every year, that's a snapshot in time. But throughout the year, it's not going to remain that, right?
Well, I guess to answer your question, I'd say it's like either the 12 or the 14, depending on the contract, because it's calculated, it recalculates every year to guarantee that rate of return, no higher, no lower.
What would increase that rate? What would a large volume of gas over what was estimated, or what would increase that rate of return?
So, again, it's a guarantee, it's a fixed rate of return, right? So it's not going to, the model itself recalculates so that you get that rate of return. So for the gas gathering, it's a 12%. So it's not going to go higher or lower. It's going to recalculate to make sure that you get that return.
But you're not recalculating every day, right? So I'm
No, so sorry. So,
talking
okay,
about
I see what you're
throughout the
saying.
year.
So throughout the year, yeah, it could start to go higher or lower, but then that's the function of the recalculation, right? Because then
No, but my question is, what is the actual for that year? On a yearly basis, for like 2022?
right. So
What was the actual?
right. So I mean, maybe Mrs. Adair could talk more intelligently on this than I could. But then, if let's say for a year it did, I don't know, you were getting above like getting a 14% rate of return. Well, then the model at the end of the year will say, okay, they got 14 this year. We're going to recalculate, so then the fees will go down going forward.
You talked about the the add backs, slide 16. I didn't understand that, and I didn't catch all of your testimony. Why don't you explain that again? What are the add backs?
Right, so the add backs are the revenue, so just as you were asking about what the return is. So you have the total cost, but then how you're getting that return is through the revenue. So that's that add backs, which is the HES production. And then the other, that other line there, the non-HESM, that is from the third parties. So you're getting that, say that guaranteed rate of return, let's say whatever number that was, let's say it was, the total amount was like 100. What happens is as the tariff model each year, you get the revenue in, then that 100 is reduced. So it just gets lower and lower every year. And then by the end of the cost of service period, then the revenue will have, you know, been, will have paid off that total amount of kind of CapEx that gets the rate of return.
You talked a couple times about the gas being taken from Robinson Lake because it's higher than the requirement to get into northern border, the BTU value. Are the costs to reduce that and take the ethane out, are they built into the tariff that is charged to all the working interest owners in your wells?
Sorry, are you, the cost to make it pipeline quality,
Right.
right? So the way we built our system was so that we would be able to access the various markets. And then, yes, the ethane extraction, which we derive a lot of value from because we take that purity ethane up the Vantage pipeline and sell it in Canada at a pretty good premium against natural gas. Yes, there's a cost associated with that, certainly, but then there's a lot of value associated with that, and that all goes back to the working interest owners.
Okay, but I don't think you understand what the question was. The tariff, when I looked at it, all the data, and there's a lot of data there, in your model, it appeared that the electric costs of the gas plant are charged in the tariff.
So
I'm wondering, the cost to extract that ethane from these wells that aren't even part of the non-ops, it's coming from a different plant even, is that charged back in the tariff? Because they're actual costs of the plant, but it has nothing to do with them.
Completely understand. So, right, to be able to service any third party that comes into the system, there's a cost associated with that. So yes, both the cost and the revenue associated with those third parties goes into the tariff. However, anytime we look at that and negotiate a rate, we run the economics, of course, to make sure that this makes money and reduces the fees for Hess upstream and the working interest owners. So if the fee was so low that an analogy would be like if you had a house, right, and you had some empty space in your house, would you want that a person to come in and, like, say, rent out one room? If they probably wouldn't pay the same charge you are as the owner of the house, but they're reducing your overall cost, and therefore you will bring them in because that additional revenue they're bringing in helps you pay down your kind of tariff burden or that guaranteed rate of return. So yes, in your example, that additional cost, the electricity, would be incurred and charged out, but that is less than the additional revenue that is going to be received from having that third party. Does that make sense?
No, it's pretty confusing because the longer you talk, the more confused I got.
Okay, so overall, when you bring a third party in, we run economics to make sure that there's more revenue than cost associated with it.
Well, I understand, the concept of what the gas plant's making money on.
Yep.
Of course. But it's a simple yes or no that I guess could suffice. These working interest owners that are bringing gas into Tioga Gas Plant, they are charged a tariff that's based upon the gas plant costs, right? I mean, that goes into the tariff.
It is.
rate.
It is.
So I'm wondering when you bring in other third-party gas that has nothing to do with them,
Right.
and you're processing it, there's costs at the Tioga gas plant to do that. Are those costs
Yes.
figured into the other's tariff?
Yes.
Gas tariff?
And that's
And if
what-
they are, why? I mean, because they get no benefit from it.
They do. They get a benefit, and that's what I was trying to explain. So the costs come in, but there's also revenue associated with those third-party volumes, right?
Okay, so where in your tariff does it account for the ethane that's going up into Canada, that they're getting a benefit from that?
where in the tariff model? So they're not charged the tariff to go up to the ethane contract. That's one of the fees that we talked about, one of the pass-through fees. So HTC pays that fee directly, right? And then it gets the sales price. So you have the sales price minus the cost to get it up to up into Canada.
So you're telling me that the working interest owners of the other wells, even the non-ops on the Hess wells that go into the Tioga gas plant, they are benefiting from the Robinson Lake gas coming in to the plant?
Yes, yes, they get, so, right, so the working interest owners, again, when we look at any third party, we don't bring the third party into the system unless it lowers the tariff rates that are gonna be paid by the working interest owners.
When does the Vantage contract end?
Vantage contract ends at the end of 2024, and we've extended that for 5 years, so end of 2029.
Where would the ethane go if you didn't extend those contracts?
You would probably lose value because it would go into the One Oak pipeline, which their tariff rate is 29 cents a gallon. And that's less than what ethane has been trading for quite a while.
You indicated that the POPs are not good for producers. I believe that's what you said, right?
Yes,
And if you're getting, the POPs are a percentage of proceeds.
correct.
So is the operator charged for any compression or processing or transportation fees?
The way that they're charged is by the midstream company taking, the value of the sales of the product when it's sold.
Okay, so is that a yes or a no?
So-
Are they charged transportation, processing, and compression?
They are, but they're charged not by a fixed fee. They're charged by by them taking the gas from you, the gas and the NGLs.
So they're getting a percent of the proceeds when it's sold, right?
Correct, and the producer is not getting then 100% of the proceeds of the products that are
I
sold.
understand that. But is the producer under a POP contract always gonna get some revenue, no matter what the price is for the products? Or could it go negative?
I would think most times they would get, there's going to be some value associated with it unless the transportation cost, I think they would always get some value.
So why would that be a bad contract for producers?
Well, as I was explaining before, if there's an economic provision in there, an economic out like the one that we were talking about with Rob Lake, then the midstream company can just say, hey, I'm not making enough money here, and therefore I want to renegotiate. Or, because, again, they can go back and say, hey, I'm not going to take your gas, so you can just flare it.
On your exhibit HX18, I'm just looking at page 1.
Okay?
Year 2023. When I go down to the gas gathering for Hawkeye, Goliath, and Red Sky, why are those numbers in the upper portion, those rates are different than below? You have tariff rates on top, and then on the bottom you say Hess tariff rates. What's the difference in the two?
I'm sorry, could you point out the two again?
Okay, well, I'm on page 1,
Okay,
and then on the very, it's kind of separated here by, it's got tariff rates on the upper portion, and then the last 4 lines, right above that, it says Hess tariff rates. Okay?
oh, at the bottom.
Yeah. Why is there what's the difference in the tariff rates that you've got up on the upper portion and the Hess tariff rates on the bottom?
Right. So this goes back to that slide that I walked through with the the combined processing fee. So what you have there is, we wanted to encourage bringing in third-party volumes into the system. And because of that, right, you go out and you're finding whatever third parties you can to bring into the system. So that rate that you're going out and negotiating with the third party, right, is going to be less because it's a lesser service, right? So when you bring that in, then you have to look at the fee that is also then charged to the Hess operated production. So you have a third party rate, and then you have a Hess operated rate. Again, we only bring in the third parties if it will ultimately lower, when we do the next recalculation, it will ultimately lower the Hess operated and the working interest owner fees.
So when I look at the tariff rate, we've got a gas processing and a gas gathering fee, right?
Yes.
Is there any other fees that go into that tariff rate?
So there's a gas processing rate, as you said, and then there's a gas gathering rate. The plant statements on that page that we went through kind of detailed the various fees associated.
And we've got compression fees, but they're somewhat minor compared to these two that I just mentioned. If you add those together, you're talking right around $7 or so, right?
Think so.
So what's the gas worth in 2023?
So this is not only the gas, but it's all the NGLs as well. So then that's detailed in the statement, that is provided. And it's based on the contracts as well, so.
Are the non-ops in the year 2022 or 2023, are they typically charged for the gas that you're taking, or is there a benefit at the end of the day on their revenue statement?
Sorry, could you repeat the question?
The non-ops, I just want to focus
Okay.
on them. When they get their revenue statement every month,
Right.
is the gas a negative value or is it a positive? Have they made money on the gas that's been sold?
There'd be some months that it'd be positives, and then I'm sure there's some months that it's a negative.
Okay, and what is about the price, that the break-even price? Can you tell me that?
I mean, you just mentioned that you just mentioned those fees. I think Mrs. Adair probably would know that better than I would, with the break-even prices through all of this, but, yeah, I'm not quite sure. I mean,
So you can't tell me if typically they're making money or not, whether or not, on the gas itself, the non-ops?
on the gas itself, no. I mean, I think as we've been talking about, we see this as an oil basin, so it's really the value from the oil and making sure that the system continues to flow.
But there has been numerous negative values for gas. Wouldn't you agree with that?
I believe there have been months in which it's been negative.
And what happens when it goes negative? Do you take those revenues from the oil revenues then?
It goes to as an administrative fee, and then.
But it's taken from the oil revenues, right? I mean, you don't just have to
That's-
call them
that's
for
correct.
gas, and
That's
you
correct.
carry a negative from month to month to month.
That's correct.
It comes out of the oil revenues.
That's correct.
So, actually, isn't that a type of oil curtailment? I mean, if you're taking their oil from them, wouldn't that be like an oil curtailment to them? It'd be the same on
I think
paper.
it'd be, if you want to look at it that way, I think it's a very minor oil curtailment versus actually having to shut in a well. Again, I think,
But you haven't done the math on it to figure out what
I
the
mean,
value.
there was the math that I think earlier, both sides had said that the oil revenue accounts for well over 99% of the economics of a well. So it's got to be very minor.
I could see how it could be even more than that. It could maybe be over 100% if it's a negative value for your gas.
No, I was saying that the value you get for the oil ends up being more than 99% of the value of the overall well. So if we're talking about some small amount of fees that goes from the gas over to the oil, then I don't think that's going to have a big impact on the overall economics of the well.
And what do you consider a small amount? I mean, we've seen values of minus $12 an M for some of the gas processing that Hess has charged, which certainly is a major loss on gas gathering. I'm just pointing out that it appears that there is some type of negative effect on the oil revenues to non-ops, especially if the gas is not worth anything and they're having to pay to get it processed.
Yeah,
Okay, thank you.
Mike, on slide 7 of your presentation here, you have a bullet there that's drawn out, and it breaks it down, shows your processing fees, your electric fees for refrigeration, so on and so forth. You see what I'm referring to there?
I do.
Is that same level of breakdown, I believe that should follow, and you can correct me, that's what I'm asking for slide 8, is that same level of information provided to the interest parties? To be able to see each one of those different breakouts, or is that combined up into one when you actually get their, or when they actually get their statement?
So Mr. Gawakumar will be able to give more detail about the revenue statement. I believe that there's less detail because it goes into those 4 categories. The Hess system is using the same system for royalty owners as it does for working interest owners. So I believe, he can correct me if I'm wrong, but I believe it just goes to those 4 categories.
So would you be able to tell me then why you're showing it so broken out here, but then what they see isn't broke out? Or maybe that is, again, a question that he can reply to.
Yeah, I would defer to him.
Okay. And then just for my own understanding a little bit more, the MVCs, you had stated that, I think you stated Hess, takes that cost, that they don't charge that out to the different interest owners. Can you elaborate as to why that would be? I guess the business side, that seems a little weird that they wouldn't pass on costs just like you do everything else, or is that cost somehow tied in a different part of this?
No, I mean, in no way is the charges going back to any of the working interest owners or anyone else. I think that the company took the position that they would only charge on physical volumes. And therefore, anything that was not associated with the physical volume, that we went out and got this capacity and we didn't actually utilize it, that we wouldn't charge it back to the working interest owners and royalty owners.
And you had stated that you feel, or that you believe that's several $1 million worth over a period of years.
It's tens of millions every year, and it gets into the hundreds of millions over so far the contract period. So it's significant.
Okay, thank you.
Michael, in your presentation, your slides, 23, 24, 25,
Yes, sir.
26, you spent a significant amount of time talking about export optionality. I'm wondering if you can give me a specific example where Hess Trading or Hessam or Hess Transportation use this to the benefit of Hibic and the non-operated working interest owners. For example, did it, someplace where this optionality shifted crude oil or natural gas from one export market to another, and there was I guess you'd say a
Sure.
rollback profit or advantage to Hibic and the non-ops.
Right, so again, going through the, the calculation, the working interest owners and Hibic, they get the weighted average sales price. So whatever that sale is in the ultimate market, they get all that value minus the cost to get it there. So,
Just a second, if I could interrupt you. When you say weighted average, you don't track which market a specific oil goes to. You do the weighted average of all the options every month?
all the actual sales.
All the actual
All the actual
sales
sales,
out of North Dakota for the
Right.
month? And they
Right.
get the weighted average of all those sales?
correct.
Okay.
So I'd say, yeah, like I gave the example about the ethane contract. So that ethane contract is at Chicago City Gate plus, I think it's 5 cents a gallon. So that's much, much higher than anyone else is getting for their ethane. Most people, if you take it down the Y-grade pipeline to Mont Belvieu, that's a negative value. That's all shared with the parties. The fractionated products, we have truck and rail sales, so those are sold at a premium versus paying the 29 cents a gallon to take it all the way down to Mont Belvieu. And the oil sales, again, we are the largest shipper on DAPL, and that derives the best net back, getting it down to Nederland, Texas. Versus, the different rail options that people have. The rail is just much more expensive to use rail. So, yeah, there's a myriad of different benefits that we've provided from this. And then, of course, let's say if, DAPL would have got shut down or one of the pipelines got shut down through some sort of catastrophic event, then, again, we're not going to have to shut in our wells because we have built other options to be able to take it to. Right, and we've done that with the Hess balance sheet, and then if we got too much firm capacity, again, we pay for all that through the through the MVCs.
So we've noticed recently that Clearbrook price is a premium to WTI and Netherlands, Texas. Has Hess shifted its crude oil and its weighted average to Clearbrook?
Not right now. We haven't. We have historically had capacity on the Enbridge pipeline, and if that were to continue, and we saw that as a trend, then yes, we would look to access that market. But we do have connections to Enbridge, and for many years had a commitment on that pipeline.
All right, thanks.
Any additional questions?
May I ask 2 follow-ups?
You may. We're getting close to kind of the time where people need to take a break, so are you going to have any additional questions?
I do not have any questions,
Okay.
depending on what Mr. Vivian asks.
Of course.
Mr. Fraley, does the cost of fractionation ever exceed the value of the resulting products?
The cost of fractionation. So the overall cost, so the overall costs are just embedded into the tariff model. So I wouldn't think so. That'd be surprising, but.
You're not
I would-
sure?
So, yeah, I'd be very surprised. I would just say that.
And you said someone is now taking in kind from Hess Bakken. Who is that?
Who is the counterparty? XTL.
That's the only one.
That's the only one.
Thank you.
All right, it's 9:55. Let's take a, I guess, a 5 or 10 minute break, and we'll try to keep things moving. So we'll go off the record. All right, it's 10:08. We'll come back on the record. I've been informed that we have at least two individuals that like to make public comment, so I'd ask council to clear a space briefly so that we can do that now as opposed to later in the day, if that's okay with council.
Mr. Hearing, do you have an understanding about how long these will go?
I'm about to find out.
Okay. Okay. Well,
I would like, I mean, obviously, we want to finish today.
Yeah.
So I'd like people to, if they have written comments, it would be great if they could submit them into the record, and if they want to summarize their written comments, that's great, but my preference is that they keep their comments short so that we can keep moving on.
understood.
Okay. Okay, so first on the list, I have a Peter A. Massett. And Mr. Massett, if you have written comments, you, I guess, provide them to Bethany, and then they can be distributed to the, put in the record, and the parties can have access to them also.
Yeah. Hey, Ross.
All right, Mr. Massett.
Hello. Thank you, Mr. Examiner, for hearing public comments today. My name's Peter Massett Jr. I'm owner of and president of Deep Rock Resources LLC, P.O. Box 831, Bismarck, North Dakota, 58502. And thank you for hearing comments today for case 28637. Deep Rock Resources LLC is a working interest partner with many of the well operators in the Williston Basin. Deep Rock has several non-operated working interests in wells which are operated by Hess Bakken Investments II LLC. I'm here today because we have many of the same issues that Sinclair Oil and Gas Company and Missouri River Royalty Corporation have regarding reasonable and actual costs for Hess-operated wells. When reviewing my company's revenue statements for Hess-operated wells, I found what I believe are excessive post-production costs, which results in the negative pricing for the gas sales that we've discussed today. And I'm asking the commission today to use its regulatory authority to determine proper costs for the operation of the wells in dispute prescribed by the North Dakota Century Code 38-08-08. Thank you.
Okay, Mr. Massett, your comments are noted for the record. Next on my list is Mr. David Dropdahl.
He doesn't wish to speak.
Okay. How many other individuals wish to speak today? Two more? And have you signed the witness register? Okay, so next. And just could you identify yourself for the record and spell your name, please?
My name is Wayne Harris, WayneHarris. And I'm a representative of the Stephen H. Harris Family Limited Partnership, who's a non-op working interest partner with a number of Hess wells, as well as several other affiliated companies that also have working interest in non-op Hess wells. And I'd just like to say that our story is almost identical to what Peter Massett and Ryan Copsing and Missouri River Royalty and SOGC have presented already. And ours is just a much smaller scale. And we respectfully reiterate that we'd like the Industrial Commission to examine these, what we feel are excessive deductions from our revenue checks, specifically transportation, processing, compression, and admin costs. And you guys are doing a good job so far, and we really appreciate that. And we'd like to thank Missouri River Royalty and Sinclair, or SOGC, for taking on this David and Goliath situation. I also would like to just close on, I once heard a story about a 6-foot man that drowned in a lake that averaged about 5 feet in depth. And I can tell you that we feel like we are the 6-foot man that's about to drown in a 5-foot average depth lake. And that's all I have to say.
Okay, thank you, sir. Your comments will be noted for the record. And anyone else?
Mr. Examiner, Clark Crawford, P.O. Box 2283, Bismarck, North Dakota, appearing on behalf of Northern Energy Corporation. I'll be very brief. I just want to share some numbers from a check statement from Hess. This is a monthly check statement for the month of June 2020. My gross value of my oil and gas was $90,797. The owner deducts, which should really be called Hess deducts because that's where the money goes, $80,204.51, leaving me with $9,522. The deducts were approximately 88%. That's all I have.
Okay, thank you, sir. Anyone else would like to make public comment? All right. So you can call your third witness.
We will, thank you.
Hess calls Ram Gauri Kumar.
Thank you, sir. Could you spell your name for the record, please?
RAM, Ram. Last name is GOWRIKUMAR.
Could you raise your right hand, please? Do you solemnly swear or affirm under the penalties of perjury that the testimony you're about to give in this matter will be true and correct to the best of your knowledge and belief?
I do.
Okay, thank you.
Could you please introduce yourself to the commission?
My name is Ram Gaurikumar, and I am the finance director for Hess's Bakken asset.
And Mr. Gauri Kumar, did we prepare some slides to help the commission understand your testimony here today?
Yes, we have.
And for the record, this is HX 87, which are at it's the next tab after the Fraley slides that we saw earlier today. And as the commission is orienting itself, Mr. Gauri Kumar, would you please flip to slide 2 and give the commission a brief summary of the subject matters that you're going to cover here today?
Firstly, I'll be talking about the type of costs that Hess Bakken incurs as, as the operator of these assets, of these wells, and how these costs are charged to the working interest owners. Secondly, and more specifically, we go into the producing overhead, specifically as to how Hess calculates its producing overhead costs.
Okay, well, let's start. You use the phrase Bakken asset. What do you mean by that?
So Hess is one of the larger operators in the Bakken Basin, and the Bakken asset itself is the largest operated asset in the Hess portfolio. And in the Bakken, Hess basically develops and produces oil and gas, and gathers, compresses, processes, transports, and market these hydrocarbons.
And let's just draw some distinctions here. Generally speaking, who is responsible for the costs of, for example, drilling a well?
For the cost of drilling a well, it would be the working interest owners that participate in the well.
Do royalty interest owners get charged any of those costs?
No.
And is Hess itself a working interest owner?
Hess is a working interest owner, typically the largest working interest owner in the wells it operates.
And you also talked about things like gathering and processing. Who is responsible for those kinds of costs, which I'll just call post-production or midstream costs?
Right, in terms of the post-production costs, it would be the working interest owners that are responsible for their share of the post-production costs. In certain cases, depending on the terms of the leases, royalty interest owners may share some of those costs.
Missouri River and Sinclair have brought this application. Do you know whether they own non-op working interests in the subject wells?
They do own non-op work interest in the subject wells.
And just about how much is their interest in these particular 8 wells?
For these 8 wells, Sinclair owns about 26% work interest ownership, and Missouri River has about 9% work interest ownership in the subject wells.
And in 2023, so this year, has Missouri River continued to participate in wells drilled by Hess Bakken?
Yes, they have.
About how many?
Looking at it until May 2023, looks like they have participated in 7 wells that Hess has balloted to them.
Now, we've heard about some of the documents that Hess provides working interest owners that reflect these costs and the revenues. What kinds of documents does Hess provide to working interest owners like Sinclair and Missouri River about the applicable production costs and about the applicable post-production costs?
Generally, there are 2 types of documents that are provided. One is what you call JIBs, so joint interest billings. They typically contain kind of like costs to develop and produce. So when I say produce, is to bring hydrocarbons from subsurface to the wellhead. So those type of costs that are incurred in that part of the business is included on the joint interest billings. Now there's another document that Hess provides, which would be the revenue statement. Now any costs associated with, handling the hydrocarbons from the wellhead to the sales point, so it to be post-production type activities, and hence post-production costs, those are included on the revenue statement that is provided to the owners.
Now, is there any way for there to be the same costs included on both statements? Like, is there a possibility that there would be some sort of double dipping where post-production costs are showing up on revenue statements and JIBs, for example?
That would be impossible,
Why?
because these 2 types of costs that is incurred in terms of developing and producing hydrocarbons, they are captured separately in a separate module within SAP versus costs incurred in terms of post-production activities. So those are, again, separate cost and goes into a separate module, and there can be no double dipping or duplication of those costs on either side.
Okay, and you use the term SAP. What is SAP?
So SAP is an enterprise resource planning tool that we use in Hess. We use it as our accounting system. There's also other uses for it, for example, materials management, plant maintenance. It's basically a critical software for our business operations.
And do you input your actual costs into SAP?
Actual costs are captured in SAP.
So you talked about 2 kinds of documents, revenue statements and JIBs. Let's start with the revenue statements, and let's look at slide 3, please.
Okay.
And is slide 3 a screenshot of HX35?
It is.
Okay, and what are we showing here?
So this is an extract from a revenue statement. So this is a February 2020 revenue statement that is sent to Sinclair Oil and Gas Company.
Okay, and the commission's heard a little bit about revenue statements from Mr. Fraley and from other witnesses as well, actually. Just orient us, what is a revenue statement?
So revenue statement is a statement that is provided to the owners to basically show the revenue earned for the various products that are sold for that month and the associated post-production costs incurred with those same volumes.
And do you use the same format of revenue statement for both non-op working interests and for royalty interests for purposes of these revenue statements?
Yes, we do.
And why is that?
So we have one format of the revenue statement that we have, gotten SAP consultants to configure the statements for us. So we maintain one format of the revenue statement for both working interest owners and royalty interest owners.
Okay,
Maintaining 2 separate formats is going to be extremely costly and difficult.
let's go through this left to right, just just to help the commission understand what you show on these. If you look at the far left, there's something that says prod date, and next to that, is that the production date?
That is correct.
Okay, and then next to that is prod code. What is that?
So prod code would refer to the type of product itself that is shown on the revenue statement.
And it uses numbers? How is somebody supposed to understand what those numbers are?
Right. So if you look at the top of that slide, there is a legend box that has a heading product codes. So basically, if it starts with a 1 series, it basically will refer to oil, and it's reported in terms of barrels. So if it's a 2 series, that would be gas volumes reported in MCFs. 3 series would be condensate in barrels, and 4 series would be plant products or NGLs reported in gallons.
Okay. Then there's a group of columns with a topic called gross interest on the left, and then to the right, there's owner net interest. So let me just ask you, gross interest, what is that referring to?
So that would be on the left side of the statement. The columns headed gross interest. So that would basically provide data or info as to the gross data of that particular well. So basically, what is the total volume that is produced from the well? What is the total value of the products that were produced from the well? What is the total deducts associated with those volumes? And what is the total net value? Again, this is gross data, and any owner that participates in this well would have the same data showing up on the left side of the revenue statement.
Okay. And then the right side is owner net interest. What is that?
That's correct. So the owner net interest would be the specific owner's information associated to that well. So for example, let's say this particular owner, Sinclair, has a 15.9% net revenue interest as shown on this revenue statement. So any information that is shown on the right side of the statement would be specific to the owner. So it would be their respective proportionate share of the gross value, respective proportionate share of their deducts, and the taxes and the net value.
Okay. So DISB decimal, that's the first column under owner net interest. What is that?
That would refer to the decimal ownership of this owner that is used in this calculation.
Okay, so for this particular well, for this particular month, for this particular non-op, which is Sinclair, they would own, what, about just under 16% of an interest?
That's correct. As shown on this extract of the revenue statement, I believe in total they have a bit more on this well, but this is probably the third tract of the interest in this well that is shown on the revenue statement.
Okay, and then to tie it together, if somebody wanted to understand how much they received in any given month, say this one here, for gas, how would they do that?
So for gas, we are going to look for a product code that starts with 2. So that would be row 1. So it says 204, so any information that appears on that row would be related to gas. Now, if you want to see what's the net revenue that was obtained for gas products, you go to the rightmost column on the statement. So there'd be negative $52.13.
Okay, and then if we want to do the same thing for NGLs, what would we do?
So NGLs, that would be plant products. So you look for the product code that starts with 4. So that would be the second row on the statement in terms of how much this particular owner earned for that month in respect of NGLs. You look at the last column, that is $14.70.
Okay, and then if we want to do the same thing for oil, walk us through that, please.
So oil would be the last row, product code that starts with 100. The rightmost column shows a net value earned for oil for that particular month. That would be $10,347.95.
Okay, now you've highlighted here in yellow something called deduct code in the top right, deduction codes. What is that?
So the deduct code as shown on the revenue statement, we have the legend that is shown up there. So those are basically the 4 categories that the state requires operators to use for royalty interest owners, and that's what we use in all our revenue statements. So we basically split that into the 4 categories. So 10 for transportation, 20 would be the processing category, 30 would be compression, and 40 would be admin costs.
Okay. And why do you use these 4 categories?
We use these categories since all the operators in the state are required to use these 4 categories, and that would be starting from sometime mid-2019, I believe.
Okay. Now, did you prepare a slide to show the commission what kinds of costs fall into these 4 categories?
Yes, we did.
Okay, is that the next slide?
That would be the next one, slide 4.
All right. And just orient the commission, please. Slide 4, what are you showing?
Slide 4, basically this would be for gas and NGLs. We are showing the type of post-production costs that are categorized within those 4 categories.
Okay, so we've got 4 columns: compression, processing, transportation, and administrative. And then there's a dotted line. So am I following correctly that above the dotted line, those are the costs as they relate to residue gas, and below the dotted line or dashed line is the cost related to NGLs?
That is correct.
All right. And I want to ask you about this a little bit. You mentioned that you started doing this in 2019 or so when the statute was passed, right?
That's correct.
What did you do before?
So previously, we had all deducts under one column. I believe we called it other deducts.
Okay, and why'd you do it that way? And when did you change it?
So there was the format of our revenue statements at the time, and we changed it in mid-2019, basically to comply with the regulations of the state.
Okay. And did you tell working interest owners and royalty owners about the change that you made to the revenue statements?
Yes, we did.
I'm handing you a document marked HX 117. What is this document, Mr. Gary Kumar?
This is a letter from Hess Barker Investments, LLC, to a royalty interest owner. It's not named, but this is the standard letter that we used to send at the time to a royalty interest owner.
And why did you send it?
It's basically to highlight that we are making changes as to how the royalty statements appear, and these changes are in line with the amendments to the North Dakota Administrative Code.
Okay. And this is a form letter where it says, "Dear royalty interest owner," right?
That's right.
Did this letter go to non-operating working interest owners receiving revenue statements as well?
I believe it did, yes.
So would a copy of this have gone to Sinclair and Missouri River back in or around May of 2019?
That's correct.
Okay. So at that point, you started using the 4 buckets that are reflected on slide 4, is that right?
That is correct.
So let me just ask you some questions about some of them. I think most of them are pretty clear, but I had a couple of questions about some of them. Let's start on the far left on compression. And for gas, you list compression and gathering under the compression bucket. Why?
That's correct. Well, we didn't have a gathering category per se. I mean, we could have used transportation, but we have also assigned transportation for fees associated with getting products from the wellhead to the from the tailgate of this of the gas plant to the sales point, right? So transportation fees would be associated with that services. Now, if you look at the rest of the categories, it felt logical to include gathering under the compression category. And so gathering in this perspective, it would be fees associated with gathering from the wellhead to the plant inlet.
Okay, so am I tracking that gathering refers to wellhead to plant inlet, transportation refers to plant tailgate to points downstream?
That is correct.
Okay. And then I think the other ones are, well, I guess my other question is, for NGLs, there's no charge for compression? Why?
That's correct. I mean, the way that we categorize cost by product at the time, and we did this until until end of 21. So pretty much all the compression, gathering, processing fees that are incurred we showed that under the gas product, right? It was, it was in the form of wet gas, and we basically recognize all those costs under one product. So basically, NGLs, you'd see there's very little fees associated with NGLs in those period. And typically for NGLs, you'd see a transportation fee and a loading fee if it's transported using rail or trucking. But there will be no other fees that you see under NGLs. All the fees associated with gathering services, transportation services, gas transportation and processing services would appear under gas. So it would not be, it would be common to see the gas product showing a negative number, but the NGL volumes would show a positive number. So you got to look at the value in combination.
And so the gas stream before it's being processed is wet gas.
That's correct.
And you could put the cost related to the processing the wet gas and gathering the wet gas under either the 200 product code or the 400 product code, and you put most of them under the 200 product code. Is that right?
That's right. So all gathering fees, all processing fees were included under the 2 series product code.
Okay. And then on the far right there, it's called administrative. And was that one of the 4 buckets that the statute specified?
That is correct. That'd be one of the 4 buckets.
And then I see, focusing on gas, that you have a difference pre-22 and then from 2022 to future. And I guess by pre-22, that's referring to 2019 to 2022, right?
That's correct.
Okay. So let's talk about the gas admin bucket. It says negative balances WI only for pre-2022. So first of all, what is WI only referring to?
So WI would refer to working interest. So this would be a category where it's only the working interest owner that gets the charges.
Okay. So for admin costs before 2022 for gas, why did you include negative balances? What's that referring to?
Right. I'll explain what negative balances are first. So negative balance arise when the total post-production costs exceed the revenue associated with the product, right? So in this case, it'd be cost higher than prices of the product, and this could happen when prices of the product are on the low side. So any negative balances that occur in respect of this situation, and the costs that I'm talking about are post-production costs that are incurred, in the transportation, compression, processing, and gathering. Any amount that exceeds revenue is shown under the administrative category, right? So the originating service would be the gathering, processing, transportation services, but that portion of those services that exceed revenue for the product for that month would be shown under the administrative category.
Okay.
And,
Oh, go ahead.
to expand on that, so that would be the working interest share. Now, if the same happens for a royalty interest owner, where the cost exceed the revenue associated with the product, that portion of the cost, the same negative balance, would be charged to the working interest owner that bears those costs on behalf of the royalty interest owner, and that would again show up in this administrative cost category.
And so am I tracking correctly that those negative balances are never charged to royalty interest owners?
That is correct.
And why is that?
It is our view to protect the royalty interest owners, so they do not go below 0.
Okay. Why did Hess put those, at least up until 2022, put those negative balances under the admin category as opposed to somewhere else?
The version of SAP that we were using at the time and the way the system was configured, there was no SAP solution at this point in time when we went with these new categories. So we had to find one of the categories which were not being charged to the royalty interest owners so that their interest is protected. So we need to find a category that only the working interest owner gets charged to. So hence why we separated and treated it that way and showed it as such on the revenue statement.
Now, when the underlying lease is a gross lease, like a state lease, what impact does that have on the payments or the deductions to working interest owners?
For a state lease, that would be deduct-free. So any post-production costs associated with that portion of the lease will be charged to the working interest owners that basically took the state lease.
So for the subject wells, do you know whether there were any such state leases in the 8 subject wells?
There is.
And do both Missouri River and Sinclair have interest in those state leases for the subject wells?
They do.
And do you have a sense, having reviewed the title opinions that were produced in this case, what percentage of the interests derive from the state leases?
Based on the title opinion, about half of Sinclair's interest in the subject wells were obtained from state leases. And from Missouri River, it was about a quarter of the interest that they obtained were from state leases.
Okay. Now it looks from slide 4 that you did something different starting in 2022. What happened?
That's correct. So starting from 2022, we got SAP consultants in. They had a solution, and basically we worked to reconfigure how these costs are shown on the revenue statement. So the change that you see from 2022 onwards is any of these negative balances would not be shown under the administrative cost category anymore, but they would be shown in the respective category that they originate from. And we were able to make the configuration without affecting the royalty interest owners, that they still don't go below zero, right? We still protect the interests of the royalty interest owners.
Okay. Just a couple of questions on NGLs. What goes into the admin fee for NGLs?
For admin fee for NGLs, is basically the nominal marketing fee that is charged, and it's only for those NGL sales that are railed or trucked.
Okay. Just a couple of follow-up questions. Is there any marketing fee associated with the marketing of residue gas?
No,
That's charged to anybody? Yes.
none.
Okay. And you say for marketing fee for NGLs, it's rail or truck only. Does Hess also transport NGLs by pipe?
Definitely. There are NGL sales that occur via pipe.
And is there any marketing fee associated with that?
There is no marketing fee associated with NGL volume sold by pipe.
And are any of these marketing fees charged to royalty owners?
No, royalty interest owners do not get charged a marketing fee.
Mr. Fraley showed the commission a gas plant statement. Were you here for that?
That's right.
Okay, and we don't have a gas plant statement in your slides, but the commission asked a question about why there's a different breakdown of the costs in the gas plant statement than what is on the revenue statement, right?
That's correct.
Why?
You mean why we don't show that
Why is
detail?
why is that exact same breakdown from the gas plant statement not on the revenue statement?
I think I was explaining earlier, we were required to use these 4 categories for royalty interest owners. I mean, we are using the same format of the revenue statement for royalty interest owners and working interest owners. But, if and when working interest owners need any further information or breakdown of the post-production costs that are charged on the revenue statement, we can provide them, and it has happened in the past. And, basically what I'm saying is certain folks have requested for it, and we have provided that type of breakdown on a spreadsheet.
Okay. That's revenue statements. I'd like to shift to the joint interest billing statements.
Okay.
And is slide 5 an example of a joint interest billing statement?
That is correct. Slide 5 would be an example, would be an extract of a joint interest billing statement that is sent to Sinclair Oil and Gas Company for the month of December 2019.
And can we call that a JIB? Take your time.
Yes, we can, and that's the common term used.
It'll
in
make
the
us
industry.
popular with the court reporter if we use jib. And is this slide here an extract from HX 32?
It is.
Okay. Could you just walk the commission through what a jib is showing here on slide number 5?
So this is an extract from a joint interest billing. It basically shows the type of, I call it capital. Basically, any cost incurred to drill and complete, set up facilities for the well, and any cost that is incurred in terms of, production costs incurred in terms of getting the hydrocarbons from subsurface up to the wellhead.
Okay. Does this list all of the production costs that are charged to non-operating working interest owners?
A JIP would have all the production costs that are charged to working interest owners.
And I just had a couple of questions for clarification. There are a number of them that start with ALL, period, right?
That's correct.
What is ALL, period, an abbreviation for?
It's an abbreviation for allocations. Like, for example, I mean, if you look at under the heading P001039630, line number 4, starts with A00116, it says all FAC. That basically stands for facilities allocation, right? So this would be in respect of, this well, or, there would be a group of wells that share a common facility. I'm guessing it's on the pad. So any costs that are incurred on those facilities, for example, let's say there's some maintenance work that was done on the facility, that cost will then be allocated in equal share to the wells that produce into that facility, right? So that's what the facilities allocation stand for.
So all means allocation, not all, right?
All period is an abbreviation. It stands for allocation and not everything.
The last line there under the P001039630 line is operating overhead.
That is correct.
Is there any difference between operating overhead and producing overhead?
They are the same.
Yeah, the same, okay. Does Hess, as a company, incur costs that are not charged to non-operating working interest owners?
Definitely.
Can you give us some examples of the sorts of things that are not charged to non-operating working interest owners?
I think we heard MVCs earlier. That would be one type of cost. Charitable contributions, corporate social responsibility type activities that would not be charged to working interest owners. Generally, these are the type of items that is done from a Hess corporate perspective and benefits Hess and not the working interest owners. So they do not get charged to the working interest owners. Now, other examples would be legal fees would be one, business development, strategy and portfolio, treasury, risk management. Those would be corporate office costs. Those would be type of examples, activities, costs that do not get charged to working interest owners. So it won't appear under joint interest billing or a revenue statement for the matter.
We heard a rather colorful example yesterday of an executive in New York that's sitting around selling stocks, and I don't know if there is a kind of person like that in the Hess organization, but would somebody like that, would their salary be charged to non-operating working interests in North Dakota?
So that would come under the corporate office. So none of the corporate office costs, so that would be the CEO, CFO, COO, basically the New York office, none of those go into a joint interest billing statement or a revenue statement.
Okay. Are you familiar with the concept of a direct charge as opposed to an indirect charge?
I am.
What's the difference?
Basically, a direct charge, I think it's self-explanatory. It's basically costs that you can directly associate to a particular joint property, in this case a well, and it relates to activities that directly benefit the well. Whereas indirect costs would be, costs related to activities that you can't easily identify to a specific joint property, but it indirectly benefits the joint property, right? So that would be indirect costs.
And did you prepare slide 6 to help illustrate this to the commission?
I have.
Slide 6 has a number of green boxes. Which ones of these are direct charges? And just walk us through this and how this helps illustrate the distinction between a direct and indirect charge.
There are several boxes on the slide, example, utilities, facility expense. I think we saw that example on the Jeep just now. Production expenses, materials and supplies, repair and maintenance, and certain salaries and wages would be examples of, direct costs that will be charged directly to a well. Now, for example, let's say, there is a workover that is performed on a well. So any materials and supplies associated with that workover, any salaries and wages that is associated with, operators that are directly associated or working that workover, any cost of, vendors or crews that are required to perform that workover, that would be examples of direct costs that you can directly associate with a particular joint property, in this case that well, and it gets charged directly to that well, and the well gets benefits from that activity.
The bottom right is one called producing overhead, and that, I think you told us earlier, is a synonym for operating overhead, right?
That is correct.
And is that a direct cost or an indirect cost?
Producing overhead would be an indirect cost.
And just define that for us. What is, when you're using the word producing overhead or operating overhead, what are you referring to?
So basically that stands to define, costs associated with activities that you can't easily identify to a particular well, but it indirectly gets the benefit of those activities. Now, examples of those activities would be well planning, land administration, accounting, procurement. Those are examples of services that are not particularly associated with that well, but indirectly benefits that well. Like for example, let's say you need land administration services to identify, to get the title opinion, set up the deck, make sure we've got the right ownership interest. You would need accounting services. Now you can't associate accounting services to a particular well, but you can associate accounting services to the asset, and that is an indirect benefit that the well benefits from having those accounting services. Otherwise, the right cost or the right revenue wouldn't be able to be associated with the well. Now, the operator incurs these type of indirect costs, and and the operator is entitled to be reimbursed for these type of services that benefits the well. Now, as I mentioned earlier, there are going to be certain costs that the operator incurs that does not benefit the well. That's not what I'm talking about, right? So there's going to be these indirect costs that are incurred that benefits the well that will be included under the producing overhead rate.
Now, whether or not these charges are direct or indirect, does Hess mark up any of these costs before charging them to non-operating working interest owners?
No, we don't.
So you just gave some examples of producing overhead, and does slide 7 help illustrate the examples that you just gave?
That's correct.
And so just give the commission, please, a bit of a flavor of the kinds of costs that factor into producing overhead, and then we'll talk a little bit about Bakken upstream as well. So let's start with the other ones, and then we'll talk about Bakken upstream.
We have a few examples of basically cost center groups that provide services to the Bakken asset that indirectly benefits the Bakken asset and the wells. And for example, ND Executive Management. Now that stands for the basically the asset leadership team, and certain executives within the asset are included under the ND Executive Management Group. For example, they provide asset management, asset stewardship services, setting targets, setting metrics, making sure that various parts of the asset teams are aligned and working together. You heard Mr. John Gatling's testimony yesterday, how that works. You know, making sure that we are getting or driving the best value possible and operating this in the best way possible. So that would be services that is provided under the ND Executive Management. I'll take another example, human resources. We need people, we need crews to perform basically the work for us to operate the asset. You know, getting timely resourcing, getting the quality, the proper type of resourcing, that would be the services that's provided by human resources. In terms of supply chain, getting making sure we've got the right contracts in place, getting the right prices negotiated that is beneficial to us, making sure that the right materials are available, the right resources are available as and when needed. You know, that would be services provided by supply chain. Now, just you know, stating some of those examples, I mean, again, going back to these are indirect costs. You can't directly associate these to particular wells, but it indirectly benefits the wells. And these are the type of costs for services that are included in our producing overhead rate.
Okay. Then one of the boxes here is Bakken upstream. What is that referring to?
That's correct. So Bakken upstream is a bit different. Now the other boxes that are shown here are embedded within the Bakken asset. Now there are certain services that are provided at the enterprise level, right? So, and those services that are provided at the enterprise level benefit various assets. And Bakken upstream will get its fair allocated share of those costs of the services that are done at an enterprise level, right? So that's what this box represents. It basically gets allocations from central support functions.
Okay. Now, I want to come back to how that allocation works. But let me ask you about the difference between joint operating agreements, well, wells with and without joint operating agreements. Does Hess operate any wells in North Dakota where its relationship with working interest owners, non-op working interest owners, is governed by a JOA?
There are.
Okay. And when there is a JOA, how does Hess determine the applicable overhead rate, producing overhead rate?
When there is a JOA, the JOA typically specifies what the producing overhead rate is, and that rate escalated, you know, for escalation factors depending on the years. It would be that rate that is applied and charged to working interest owners.
Now, the subject wells at issue in this matter, do they have a JOA associated with them?
The subject wells do not have a JOA.
And in your experience, is that unusual here in North Dakota?
No, that would be the most common method in North Dakota.
Does Hess participate as a non-operating working interest owner in any wells in North Dakota?
Yes, we do.
And is that often without a JOA as well?
That's correct.
Now, when you're participating as a non-op in a well without a JOA, does the operator typically negotiate their producing overhead rate with you?
No.
We talked about the wells at issue here not having JOAs. Do you permit audits in wells without JOAs?
We do.
Now, there's been some testimony in this case about an audit and whether or not an audit was requested, whether it was before or after this matter was initiated. Let me ask you this. In September 2020, did Martindale, which is Mr. Atala's firm, reach out to Hess to request an audit?
They did in September 2020.
At the time, was Hess in contact with Martindale with respect to audits requested by other clients?
We were in communication with an auditor from Martindale at the time, which was in respect to another audit that they were doing.
So September 2020 was still COVID times, right?
That's correct. So 2020 was during COVID times. It was sometime in March that we shut down the office when we initially shut down the office, we thought it was going to be a week or two. And, there's basically uncertainty throughout 2020. I mean, eventually we opened up the office about 2 years later, right? And it's always uncertain when the offices were going to be opened back up. In fact, I think Martindale, one of the auditors from Martindale, who requested the audit in September 2020, that same person was in our offices in respect of another audit when, the week that we closed down. So they were well aware.
Okay. And what impact was the office shutdown having on audits?
Audits were getting backlogged because typically I think audits were done in person at the time. And, certain type of audits will have to be done in person. And given the office was shut down and it was uncertain as to when the office was going to be opened back up, basically the thinking was, hey, we'll reschedule these audits, we'll put a hold on any statute limitation terms, and allow these audits when we are back in the office.
And did Hess say that to Martindale?
No, so the request was in September 2020. So we were in communication with one of the auditors. So basically, it's the same auditor that requested for the Sinclair audit. They were basically trying to finish up the audit that they were doing back in March when we shut down the office. So we were in constant communication as to, hey, are you going to let us back in? Is your offices open back up? So they were well aware that Martindale, that our offices were not back up. We were not allowing audit until we do so.
Okay. And what happened next?
So next in November 2020, a petition was filed against Hess.
And what impact did the litigation have on Hess's ability to host an audit?
Right, so when a litigation is filed, basically that goes into the legal discovery process, and naturally there was no audit to be done.
Let's go back to how Hess determines the applicable rate for producing overhead in wells like the subject wells without a JOA. And so let me ask you a real general question. What's Hess's goal in calculating its producing overhead rate in wells without a JOA in North Dakota?
For wells without a JOA, the goal of Hess calculating the producing overhead rate is to make sure that Hess does not, as the operator, does not over or under recover its billable costs.
Now, in 2015, 2016 or so, did there come a time when Hess realized it was under recovering its producing overhead costs?
That is correct. It was around 2015 and 2016 that a review was performed in terms of the actual cost Hess was incurring in this type of, in terms of this indirect cost that benefits the wells, and comparing that to the overhead rate that we were charging at the time, and we realized that we were significantly under recovering our costs.
Once Hess realized that it was under recovering its actual costs, what did it do?
Once we realized we were under recovering, we undertook, basically it was a significant effort to calculate what the overhead rate, what the right overhead rate should be, so that Hess does not under recover or over recover its cost. And following that work in 2017, we applied the updated producing overhead rate to all wells that did not have a JOA in the Bakken.
Was that done on a prospective basis or a looking backward basis, or both?
It was done on a prospective basis. There was a lot of discussion as to, hey, do we go back and recover these costs that we didn't recover previously? And we took the view that we'll make the change prospectively. So that would be 2017 forward.
Let's look at slide 8, please. And does slide 8 provide, at a high level, an overview of that recalculation process that you just described?
It does.
Okay, so let's just walk through this, and then we'll, at a high level, and then we'll dig into the details a little bit. Step one says establish overhead cost pool. What's that referring to?
So step one, establish overhead cost pool. That in general terms, it means compiling all the cost that is incurred by Hess-Barken. I mean, we are not making a determination at this point whether they are billable or should be included in the producing overhead rate or not, but basically compiling all the costs that are incurred by Hess-Barken.
Okay, and where do those costs come from?
So we source that from SAP, again, which is our accounting system, and these are basically our actual costs that are recorded in the accounting system. So for the 2017 producing overhead rate calculation, we use the 2016 actual cost.
Step two is what?
Step two would be determining the percentage or portion covered by producing well overhead. As I was explaining earlier for step one, we basically compile all the cost, not necessarily whether they were billable or not, right? So that goes into step two. So step two is where we make that determination. There's basically two parts to this. We, based on standard industry practice, corpus guidance, and so on, we determine what type of services and what type of costs associated with those services will be considered billable, right? So any portion that is not considered billable would be excluded from the overhead rate calculation. The next component to this is we look at, in terms of the effort levels that was performed by each of these cost center groups, what portion would not be included or would not be in support of the Barken upstream asset, and we exclude that portion. So it's only that portion of time and effort that supports the Barken upstream asset is included in the overhead rate calculation.
Okay, and the third step is what?
The third step would be getting the resulting cost amounts. Basically, that is the result in step one multiplied by the result in step two. In step two is basically a percentage, so you multiply by that percentage. And the total resulting amount, you divide that over your producing well count to establish a per well, per month overhead rate for the year.
Now, just before we dive into the actual calculation, just give the commission a sense of the time it took and the resources it took to be able to do this exercise.
The first time we did this, it was extensive because we've not done this calculation before. So it was basically researching how this calculation should be done or could be done, what would be the best method that aligns with kind of like the way that Hess is organized, the way that we capture our cost, and it pretty much took the better part of a year to land on this 2017 overhead rate calculation.
And did you consult both internally and externally on this project?
We did. So again, there were several folks within Hess that were involved. Primarily the folks that were performing the calculation itself was from the Barken finance support team, and they were supported by the joint venture accounting team, and there are internal corpus experts that looked at this as well. We even engaged a third-party corpus expert just to make sure that, from a third-party point of view, that, the method that we are calculating this is appropriate.
So let's go to the next slide, please. And slide 3 is another one of those documents for which reading glasses might be required. Does this look like a screenshot to a spreadsheet, which has been introduced as HX30?
That is correct.
And just at a high level, what is this document showing?
Council, are you referring to slide 9 or slide 3?
I'm sorry, slide 9, if I misspoke, apologize.
So at a high level, I think I talked about the 3 steps just now. So it shows the performance of those steps and also what are the type of costs that are included in the overhead rate calculation. right? So you see step 1, establish overhead cost pool. Now the last column in step 1, which is column I as shown on the spreadsheet, that would be the resulting cost from the step 1 process. Step 2, determine percentage covered by producing well overhead. This was what I was explaining earlier as to we look at what portion of the time and effort spent by people within each of these cost center service groups would be in support of other business apart from Barkin Upstream. And through the elimination process, we arrive at the last column under step 2, that would be column O. Now the final step would be taking column I and multiplying that with the percentage in column O to arrive at the portion of overhead cost, or the portion of cost that goes into the overhead rate calculation. Now towards the bottom of the final step, you'd see the calculation done to arrive at a per well per month rate. And in this case, we arrived at the $2,021 per well per month rate in the final step.
All right, now there's some highlighting in yellow and some highlighting in blue. Why?
So those are different types of cost center groups. I think I'd like to point out something else as well, just to orient us on the spreadsheet. Now, if you look to the left, which shows a line number, the first column, it goes from 5, 10, 12, 29. Now, this is basically a collapsed version of a spreadsheet. Now, the collapsed version meaning that there are more details to the spreadsheet, there are more detailed rows. Now, for example, let's say ND, Environment, Health, Safety, it shows row number 10, which means lines 6 to 9 would be summed up under row 10, right? So row 10 is a cost center group. What is collapsed is a cost center itself. Now, in terms of the information that you see on the spreadsheet, that would be the sum total or the average of the rows that has been collapsed, right? So you're not really missing out on any data. It's just an easier way to view this.
Okay, and I think you were just about to explain what the difference is between yellow and blue.
That's correct. So the yellow rows reflect the asset embedded cost center groups that we saw on slide 7 earlier, that we talked about in slide 7 earlier, right? So those are asset embedded cost center service groups. I would term them, for ease of understanding, as people cost centers. Now, within each of these cost center groups, basically it captures the cost of people within each of those groups, each of those teams. Now, they in turn would attract certain allocations from central support services, right? So they would maybe we'll cover that after
Yeah.
I do the blue.
Yeah, why don't you do the blue?
Right. So the yellow one, I guess for purposes of now, let's call that those are people cost centers of people that are embedded within the North Dakota asset, the Barkin asset. Now the blue rows represent the asset cost centers. There are no people sitting in these asset cost centers. This is the asset itself. Now any services that are obtained from the central support functions that is outside of the asset team, any costs associated with those services will be allocated to the asset cost centers, right?
Okay. Now, in step 1, I don't want to go through this in great detail, but there are a number of columns there, some of which refer to tier 1 as opposed to tier 3. What are those? Just generally, why are you referring to different tiers?
So tier 1 and tier 3, they both refer to allocations. Now tier 1 allocations would be, now both these allocations come from central support functions. Tier 1 would be a group of central support functions. Tier 3 would be a different group of central support functions. They don't overlap. If you are in tier 1, it comes through tier 1. If it's in tier 3, it comes through tier 3. So there's no duplication of costs here. Now tier 1 allocations would be mainly associated with people type services. For example, let's say IT service delivery, IT security, human resources, office space, that would be associated with people services, and the allocation driver, the typical allocation driver for tier 1 type allocations that comes from the central support functions would be headcount, right? So based on those headcount, it will be allocated to each of the people cost centers that we see in the yellow rows. Now, tier 3 is a different type of cost. That will be costs that are associated with managing the asset. Like, examples of that would be central procurement, accounting shared services. They perform services for the asset, not the people. So the typical allocation driver for that would be expenditure or volumes, depending on the cost center that sends out those costs. Now that would be tier 3. Again, these are various different types of central support functions. They don't overlap, and they have their own allocation process. So that's what you see on the tier 1 and tier 3 columns.
Okay. And then there's several references to reorg. What is reorg referring to?
That's correct. We do have several columns here. So for example, there's a ND reorg adjustment that shows up as column B. There's a tier 1 reorg under column D, tier 3 reorg under column G, right? So back in 2016, given where prices were at the time, we were going through a reorganization exercise within HES. So in simple terms, there was a reduction in the workforce. Reduction in the workforce, and we were getting some savings out of the reduction. Now that projected estimated annual savings was included in our overhead rate calculation, right? So basically we were passing on that benefit through our overhead rate, even though it hasn't actually been realized yet. These are estimates of those savings that we included in our overhead rate calculation for 2017.
Okay. So let's walk through, I'd like to focus on, so that's step 1. Let's talk about step 2 for a moment. And I would just like to talk through that allocation process that you've described earlier in general. Now I'd just like to put some details on it. And so let's just take 3 of these categories and just illustrate how the step 2 process works. One that you talked about earlier was ND executive management, which you described. How does that step 2 allocation process work for that group?
So I'll start by repeating what I said earlier, which is this step 2 section, we perform that on an elimination basis, right? So you eliminate kind of like what are the services that you performed and eventually what gets included in the overhead rate. So first of all, we determine for the ND executive management cost center group that 56% of the time and effort that is spent by the people within the group would be non-billable in nature. So it means that it benefits HES, not necessarily the working interest owners in the wells. So based on the determinations, 56% of that term that's non-billable, 22% based on the makeup of that cost center, we determine that to be in support of the midstream business, and 4% associated with the legacy wells, which are the conventional wells before we started drilling in the Bakken. So on that basis of elimination, we arrive at the 18% in the last column. So it's only 80% of time and effort of the folks in the cost center group is determined to support the Bakken asset and billable in nature and will be recovered through overhead.
Okay, so that 18% is 100 minus 56 minus 22 minus 4?
That's correct.
Okay. So let's do that same exercise for one that has a different allocation setup. Let's do ND well factory execution. Please describe that that line and why the allocation works the way it does.
Well, factory execution would consist of the drilling and completion teams. Now, we determine that 100% of the cost would either be recovered through a direct charge or through the drilling overhead rate. So none of that cost is included under the covered by overhead column. So none of those costs gets included in the overhead rate calculation for the reasons I mentioned just now.
Okay, and let's just do one more where you might come to the same conclusion, but you get there a different way. And let's do ND commercial. What is that, and walk us through the step 2 allocation for that?
That'd be line 104. So ND commercial, that stands for the commercial team. And we determine that the nature of the activities or services that the commercial team provides is largely in benefit of Hess. So we made the determination that 100% of that cost would be non-billable in nature, and hence 0% shown under the overhead, the covered by overhead column.
Okay, and let's just do one more, and let's look at the one in blue, Bakken upstream, where you end up with 100% covered by overhead. Why is that one covered 100% by overhead?
So Bakken upstream, as I explained earlier, they basically get allocations from central support functions, and we determine which portion of those costs would be billable in nature. And this is in support of the producing assets, and we determine that, and these are allocations to Bakken upstream. So we assign 100% of those costs to be included within the overhead rate calculation, after making the determination that what portion of cost is billable and unbillable, and we have made that elimination in step 1.
And just to be clear, is there any overlap between the costs in the Bakken upstream row and the costs that are above?
No.
And then on the final, on the far right, I see there's something called final step and then initial 2017 estimate. What's that referring to?
So final step, at the bottom of final step, you see the $2,021 per well per month rate. So that was the final calculation for the 2017 overhead rate. Now, initially in 2017, so this was back in January, we had a rate calculated, and that was the 1717 that you see under the initial 2017 estimate column. And we attached that rate to the Bakken wells that did not have a JOA at that time. We continued to review our calculations, and we identified there were 2 sections or 2 areas where we should have included those costs in the producing overhead rate calculation, but we didn't. So it was sometime in March, I think, we made a correction to this final number that is calculated that is shown as 2021 per well per month.
And then since then, have you escalated the rate?
That is correct. So since then, we have applied the corpus escalation rates that are annually issued in April, and apply that escalation percentage. So basically, we treat this as the base rate, that allows Hess as the operator to recover its actual cost, and not over or under recover, but to recover its actual cost. And every year since then, we have applied the escalation rate.
At the end of the day, what's Hess's goal in how it calculates its producing overhead rate?
Hess's goal would be to make sure that its billable costs associated with the services that it provides to the joint properties is recovered, and it neither under-recovers or over-recovers these costs.
And does Hess ever try to make a profit off of charging producing overhead?
No.
Last housekeeping thing, I neglected to actually move HX 117 into evidence, so I'll do so now, and beyond that, just pass the witness.
No objection.
Exhibit is received.
Good morning. Do you mind if I just call you Ram?
You can.
Thank you. So you talked about admin costs, the admin cost deduction that Hess uses. And I think prior to July 2019, Hess didn't use that breakdown. It used or it didn't label its deducts, correct?
It called it other deducts.
Correct, yeah.
Right.
And then that was changed in response to a regulation that was promulgated by the commission.
It was changed based on the requirements of the state, yes.
And I'm looking at the regulation, It indicates whenever payment is made for oil or gas production to an interest owner, all of the following information must be included on the check stub. The amount and purpose of each owner deduction made identified as transportation, processing, compression, or administrative costs. Those are the categories that Hess uses.
That sounded like the 4 categories that I mentioned, yes.
And I think Assistant Director Hicks noted earlier that this regulation only applies to revenue statements for royalty owners. Is that your understanding?
I believe so, yes.
But Hess uses these categorizations for working interest owners too. I think you talked about it had to do with SAP. Is that right?
That is correct.
So I want you to take a look. This is, I'm going to hand you applicant's Exhibit A23. It's already in evidence, but just so that you don't have to look through the binder. This was an email chain that was discussed earlier in the hearing. And I just have a couple questions. If you want to flip to page 2, there's an email from Longvo of Hess to Jessica Thomas of Missouri River Royalty Corporation. First, do you know Longvo?
Personally?
Yeah.
Yes, I do know.
Oh, okay. And he's a Hess revenue analyst.
I believe so. I don't remember his title.
Okay.
Yeah.
So Mr. Vo states, I'm looking at the second paragraph there, quote, "The admin cost is not a true administrative cost." Do you agree that Hess's admin cost deduction is not a true administrative cost?
Yes, I was explaining earlier what we show under the administrative cost bucket are basically post-production cost that arise from gathering, compression, processing, and transportation services.
Okay, thank you. Now I'm gonna hand you another exhibit. This is,
Done with this one.
yep, done with that one. This is a copy, this is applicant's Exhibit A56. It was also discussed earlier. This is a letter from Hess's counsel, and relevant part, I'd have you flip to page 5. It's the, not quite the last page. And I think this has been discussed already as well, but there's a request 3F and then Hess's response. And take your time and read through it if you need to, but this purports to describe what Hess's administrative fees deduction consists of. And I just want to know, once you've had a chance to read it, is this accurate?
So you're talking about 3F, is it?
Right below 3F, Hess's response to 3F.
Got it?
Okay. And is that accurate?
That is?
Okay. Is that consistent with your slide 4?
That is consistent with slide 4.
Okay. And actually, while you're looking at it, your slide 4, I think you testified to this, but so Hess does charge a marketing fee as a component of its admin cost deduction.
Not for gas,
Correct. For
But-
NGLs.
but for NGLs that are railed or trucked.
Okay. And that's only charged to working interest owners, not royalty owners.
That is correct.
And just, I guess when I'm saying royalty owners, royalty and overriding royalty, or just royalty?
Royalty and override.
Okay. And so this marketing fee is charged only to working interest owners for NGLs. Is that even on fees incurred to market royalty owners, NGLs?
I am not sure of that. I'm not sure of that. I wouldn't think so, but I'm not sure.
Well, I mean, if there's a marketing fee that is incurred for NGLs that's charged to royalty owners, this one isn't, where would that show up on here?
Can you repeat that question?
So Hess, when it sells its NGLs, at least some portion of that is attributable to a royalty owner's interest, so the royalty owner's NGLs. And if there's a marketing fee incurred to market those, this one is only charged to working interest owners. Do you know where the royalty owners one would show up?
There wouldn't be a charge.
Okay. And I actually had another question based on this. So the gas, so product code 2, I'm still looking at slide 4. There's a negative balances component in the gas, for the gas product, but there isn't for the NGLs product. So what happens if NGL balances go negative?
So at the time, so this is pre-22, all the compression, gathering, processing fees associated with wet gas as the unprocessed hydrocarbon was charged to the gas product, right? So highly unlikely you're going to see a negative balance on NGLs.
Oh, so you think it's unlikely that, so there are costs charged, extraction and fractionation and transportation. You're saying it's unlikely that that would exceed the revenues from NGLs?
That is correct. And if there is a negative balance that occurs in NGLs, now that negative balance is calculated on a combined value for wet gas products. So that would be the combine of residue gas, the combination of residue gas and NGLs. So it's a combined revenue for those two products and the combined fees, post-production costs associated with those two products. It's done in a combined calculation, right? So that's how the negative balance is arrived at.
Okay. So for example, if NGLs were negative but gas was positive, it would use that positive balance to offset the negative NGL balance.
It does. It's done in a combination, yes.
And if both were negative, that entire negative balance would be shifted. The royalty owner's not taking negative on the combined gas stream.
That's correct.
That's okay. So, looking back at Exhibit A56, this is the letter from council.
A56? A56?
Yes.
Got it, okay.
Yeah, there's a couple of exhibit
Yeah.
numbers.
That's the letter for me.
Okay.
So, in Hess's response here, there are three subparts, and we can talk about, I guess, each of them in detail if necessary. Actually, I'll let everybody grab a copy. And I'll focus your attention on subpart 2, which says in relevant part that the admin cost deduction includes, quote, any transportation, processing and/or compression costs attributable to a royalty or overriding royalty owner to have a negative balance if subtracted from the revenue attributable to the royalty or overriding royalty owner's share of the combined gas stream. Did I read that correctly?
Yes.
Okay. And your, I think, slide 4 and/or your in your testimony, you indicated there were some different there time periods that might be involved. Pre-2019, we didn't have a breakout that included admin costs. And then post-2022, this, I think, subpart 2 is no longer reflected in the admin cost deduction. Is that correct? And I'll ask it a little bit simpler. So pre-July of 2019, Hess didn't have an admin cost deduction on its statements.
That is correct.
Okay. And then it sounded like 2022 and forward, Hess, well, still has an admin cost deduction, but it doesn't include this negative, what is described in subpart 2.
That is correct.
Okay. But for both pre-2019 and post-2022, Hess was shifting these costs in the manner described in subpart 2 on A56.
As I sit here, I can't speak to pre-2019,
Okay.
but post-2019, even with this change made in 2022, in terms of treating of those costs, it was done in the same way.
Okay.
So basically what I'm saying is, whichever method, whether the method that we showed from 2019 until 21 or post-2022, the cost, the post-production cost that is charged to the working interest owner would still be the same, whichever method that we use to show it. It's just how it is shown. The cost itself would be the same.
Okay. Now, I want to make sure I understand subpart 2 here fully. Actually, before we talk about that, we've heard a few times, and I think you testified about this, regarding some state of North Dakota leases that don't allow deductions. Is that correct?
That is correct.
Yeah,
I call them deduct-free.
Deduct-free. And I think you said half of applicants' leases or interest in these wells arises from these deduct-free leases.
For Sinclair,
Okay. And for Missouri River?
about a quarter.
Oh, okay. So then for Sinclair, the remaining half, and for Missouri River, the remaining 3/4, those leases do allow deducts.
As I sit here, I can't
Okay.
say whether they allow deducts or not.
Okay.
Yeah. I didn't look through those lease terms.
So the shifting of costs that occurs under a deduct-free lease, right? The royalty owner, the state of North Dakota, isn't paying any deducts. That's not what subpart 2 is talking about, right?
No, that is not.
Okay, that would be covered by subpart 1. Or, I mean, either subpart 1 or just the processing, transportation, and compression charges on the statement.
You could say under subpart 1, I think.
Okay. Oh, I mean, a simpler way to put it would be subpart 2 only applies when a royalty owner goes negative, and the state is never going to be at risk of going negative if it has a deduct-free lease.
You are correct.
Okay. And we did talk about this, but so it says the owner's share of the combined gas stream, that would be the owner's share of revenues from residue gas and plant products.
That is correct.
And I guess condensate, if there is any. I don't know that we saw any, but the total gas, or is condensate included in the combined gas stream?
I am not sure. I believe the combined gas stream would be gas and plant products. I've not seen condensate on the revenue statements
Okay.
before, but I could be wrong. But generally, combined gas stream would be residue and plant products.
So, HIBIC charges or passes on to royalty owners and overriding royalty owners transportation, processing, and compression costs according to their lease.
Can you repeat that question?
So HIBIC does charge royalty and overriding royalty owners transportation, processing, and compression costs.
It does, depending on the terms of the lease.
So the deduct-free lease, state of North Dakota, it doesn't. But if the lease allows deducts, it charges the royalty owners those deducts.
Correct.
And sorry if this is overly redundant, but so so not talking about the state of North Dakota, but those other royalty owners, when the royalty owner's share of the combined transportation, processing, and compression costs for a given month and a given well exceed their share of revenues for those plant products, then at least some of those costs are shifted to the working interest owner.
Correct.
And specifically, that's, the amount that's shifted would be the difference between the costs and the revenues.
Correct.
I think that's the negative balance. That's the word that's used here.
That's right.
Okay. And this allocation that's talked about in subpart 2, that's not based on any lease terms, correct?
Based on sub 2.
Yep, subpart 2.
I am not sure. I don't think so.
Okay. Or, I mean, sort of the same question, it wouldn't be based on the terms of an overriding royalty assignment, if we're talking about overriding royalty owners.
I can't answer that. I'm not sure.
Well, it's not based on a statute or regulation as far as you're aware.
That's correct. I think Hess took the view to protect royalty interest owners' portion and not to deduct any cost exceeding revenue from the royalty interest owners.
I think it was Director Helms asked Mr. Macbeth the other day whether the provisions of a JOA would allow HIBIC to make this allocation. And just to be, I think you've already answered this, but the allocation that we're talking about, that's not based on a JOA.
My understanding of a JOA, it does not cover provisions around revenue allocations or sharing.
Okay.
That would be that would relate to kind of cost related to drilling and completion, and any cost to production cost, not post production.
I think you indicated in your testimony that HIBIC does own non-operated interests in the Bakken.
HIBIC owns non-op working interest in wells in the Bakken, yes.
Do you know who operates those non-op interests?
Several other operators in the Bakken.
Do you know any of them by name?
I can name a few. ConocoPhillips, Grayson Mills, Kraken, Continental.
Does XTO?
I believe so.
XTO, I think, was mentioned earlier with Mr. Fraley, who said that they take their gas in kind. I don't think he knew the explanation for that. Do you know why XTO takes its gas in kind?
No, I don't.
I'll object to the commentary. I don't think that's reflected in the testimony.
I'll rephrase the question. Or
Yeah, do you know why XTO takes its gas in kind?
No, I don't.
You also talked about audits. I think you referred to a couple specifically. One was the audit that was requested by Martindale on behalf of SOGC. That was in September of 2020. Is that right?
2020.
Okay. And then there was another audit that you said Martindale was performing at the time. Is that correct?
That is correct.
Do you know if that, for that audit, was it an audit of a well or wells for which JOA was in place?
I am not sure. So let me clarify my previous question. They were not exactly performing an audit at the time when they made the September 2020 request on behalf of SOGC or Sinclair.
Okay.
I mean, because we were not having,
Okay.
yeah, we were not hosting any audits at the time since the office was closed. But there was verbal communication between the Martindale auditor and someone from Hess as to, you know, the situation that we were in at the time. And that person was performing another audit. I am not sure whether the audit has a JOA or otherwise.
Okay. So, and I think you had said something about Hess was looking to reschedule audits to time it such that it would be when people were back in the office. Is that correct?
That's correct.
Do you recall, did Hess try to reschedule the SOGC audit?
The one requested in September 2020?
Correct.
There was a petition filed in November of 2020, and given the petition was filed, we basically allowed the legal, what do you call, the discovery process to take place.
And I'm just wondering because you said that Martindale requested the audit for SOGC in September. This was filed in November 2020. I guess obviously the audit didn't happen, so I'm wondering what the response was in September 2020.
So the same auditor that requested for the September 2020 audit was in communication with someone from Hess on a different audit that the person was performing prior to when we shut down the office. It was the same conversation as to when can we continue this audit, when would the Hess offices open back up, right? So even though there was no written communication to the September 2020 request from SOGC, it was the same person that we were speaking to within Martindale with regards to timing of another audit, right? So they were very well aware of the situation, you know, the position that Hess took on audits at the time, and that our offices were not opened at that point.
What position does Hess take on allowing audits in the absence of a JOA?
So so most of these wells, there's no JOA, and you know, JOA normally has a right to audit.
Yep.
But given the practice within the industry among operators in the Bakken, it is basically standard practice and has happened over the last few years, where you are allowed to go in and audit if you are a working interest owner in a well, right? Hess has performed joint venture audits in the past, and we have allowed audits of similar kind from working interest owners in the past. There's normally a few things we look at. For example, let's say in the past, has there been reciprocal audits performed, or has there been audits not allowed, right? If someone does not allow us an audit, then we do the same. Then we don't allow that person to come in and audit. But that's rarely the case. Secondly, we look at whether the working interest owner is in good standing. For example, there's no long outstanding receivables. The bills are paid on time, so that's something else that we look at. Last but not least, usually if it's a request by a working interest owner that has a minimal working interest, and there's a larger working interest owner in that same well, we normally ask them to liaise with the largest working interest owner to perform the audit, unless the larger working interest owner kind of relegates that, you know, right or, you know, that duty to the smaller working interest owner, then we allow them to come in. I mean, the reason for that is we don't want to entertain multiple audits of the same well. Just gather as a group, come in and audit once, and we'll respond to those audits.
You mentioned something about it might depend on whether the owner is in good standing. Are SOGC and MRRC in good standing?
I'm not sure about the billings as to whether they have paid in time or not. The other consideration to make is if there's an outstanding petition or litigation, and whether there's an ongoing discovery process, that would be another one to consider.
So, and I think this may have come out in testimony. If it's not, I guess I'll just ask. Did applicants ask Hess to perform an audit after this application was filed?
So the request came in September 2020 through Martindale. We were liaising with the same auditor from Martindale as to the timing of when we allow audits. By the time we could respond to SOGC's request, there was a petition filed in November 2020. After the petition was filed, we allowed the legal discovery process to take place.
So, I guess, so had SOGC and Missouri River held off and waited and not filed their application, Hess would have allowed them to audit?
I would think so.
I want to talk about overhead, which you discussed towards the end of your testimony. I think this is consistent with what you said, but HIBIC relies on guidance from COPUS to set its overhead rates. Is that correct?
I would say refers
Okay.
to corpus as one of the guidance to calculate its overhead rate.
And HIBIC adjusts its operating overhead annually using COPUS's escalation percentages.
We do.
I want to actually, before we can get too far into that, I want to go back and ask another question real quick. Do you know how many audits in 2022 did Hess allow on non-JOA wells?
As I sit here, I can't talk to it.
Okay. All right. Getting back to overhead. I think you just said HIBIC uses the COPUS escalation percentages to adjust its overhead rate year after year.
We use the annual corpus escalation percentage and apply that to the producing overhead rate.
Okay. I missed the very end of that. We apply it to,
The producing overhead
okay.
rate.
I think it sounded like you said basically Hess treats the 2017 rate, the recalculation rate, as the base rate, and then it escalates that according to COPUS.
Correct.
And there was a base rate on the application wells, at least prior to 2017, but that was changed as a result of the recalculation process that you discussed.
There was a rate prior to the 2017 rate that was applied, and those rates were certain to not sufficiently recover Hess's billable overhead rates. Hence why the 2017 calculated producing overhead rate was applied.
Okay. I think you mentioned that in 2017, when it did the recalculation, you said there was reliance or there was reference to COPUS standards. Is that correct?
We did refer to corpus standards,
Okay.
yes.
Any specific standards?
For the method to calculate the producing overhead rate,
Yes.
we refer to AG 23, which is an accounting guideline within the corpus standards.
I have a copy of AG 23. It's applicant's exhibit A66.
Thank you.
Okay. So this is this is AG 23. Is that what this is what Hess referred to?
This is AG 23.
Okay. If I look at page 3 of AG 23, down towards the bottom, there's a Roman numeral 3 guideline, and then there's something called an overhead matrix that's referred to. Do you see that?
I do.
And it refers to the overhead matrix as a review of items to be considered in overhead negotiation. Is that right?
It does.
Okay. And then actually, if we flip forward a few pages, I think the overhead matrix starts on page 6. Is that right?
That's right.
And the heading of the matrix says basically the same thing, items to consider in overhead negotiation. Is that right?
Yes.
So if you flip to page 5, there's one full paragraph, and there's some bolded language. That bolded language says, while the overhead matrix in this publication is not intended as a set of recommended guidelines to interpret or classify costs under existing agreements or prospective agreements where the parties did not utilize the matrix, it can be used as a tool for renegotiating the rates in existing agreements. Did I read that correctly?
I believe so.
And again, on the application wells, there was a rate set for overhead when the wells were initially drilled and produced. And then in 2017, the rate was recalculated, correct?
Correct.
And I understand this refers to agreements, and it's my understanding that Hess's position is it was permitted to recalculate because there is no agreement in place for the application wells.
That's right.
Okay. Are you aware of anything in AG 23 that suggests it was intended to be used outside of negotiations between an operator and a non-op?
Not specifically, but I'll point to page 3 under Roman 2 problem, the last paragraph. In summary, the objective of both parties is for the operator to recover the costs it incurs in providing overhead goods and services. The operator is not expected to under-recover nor over-recover its overhead costs. Now, there is no JOA to these wells, right? So we refer to AG 23 to find a method to calculate an acceptable overhead rate, or a acceptable method to calculate the overhead rate. That's what we relied or referred to AG 23 for.
And by an acceptable overhead rate, you mean acceptable to Hess?
An overhead rate where the operator does not under-recover or over-recover its costs.
If you want to turn to page 36, there's only, I think, 40 pages, so it's towards the end. This is in the FAQ section. Page 36 toward the bottom, there's a question. Can overhead rates be amended by fewer than all parties to the agreement? This is similar. I mean, there's no agreement, obviously, but this is similar to what Hess did. It amended the parties' rates, or the overhead rate.
Ask that question again, sorry.
I said, this is similar to what Hess did, acknowledging that there's no JOA for these wells. Hess amended the overhead rate.
I object to the question. Could you just rephrase it, please?
Well, I guess, so the question is, can overhead rates be amended by fewer than all parties to the agreement? Would you say that Hess amended its overhead rate for the application wells?
Has amended the overhead rate for the subject wells.
Okay.
But the question that we are referring to here, I mean, if I read the full question, it's can overhead rates be amended by fewer than all parties to the agreement, right? And there is no agreement.
Yep.
There's no JOA.
And so in answer to this question, AG 23 wouldn't provide any guidance about what to do in the absence of an agreement.
That is correct.
Okay. If you'll turn back to page 34. At the bottom, it's question number 9. It says, help, the overhead rates seem too high or too low. This is perhaps a thought that Hess had in 2017. The overhead rates are too low.
We identified that the overhead rates were low, yes.
And then this question goes on to say, what are some items that I can negotiate? What is AG 23 suggesting an operator do when its established overhead rate is too low?
Again, AG 23 speaks to this in a situation where there is a joint operating agreement.
So, even though there's nothing to suggest that AG 23 should be used in the absence of a JOA, that's how HIBIC used it, correct?
Repeat that question, please.
I mean, and I think you've said this, there's nothing in AG 23 that suggests it's intended to be used in the absence of a JOA. Fair.
Yes.
But that is how HIBIC used it in the absence of a JOA.
We referred to AG 23 to find a methodology to calculate the producing overhead rate. Right? There's, as we saw earlier, as I testified earlier, it's a pretty involved calculation. It involves a lot of considerations as to what qualifies for overhead rate, how the overhead rate needs to be calculated, how you set an overhead rate. We refer to AG 23 to look at the methods of calculation and to see which basically would apply to how Hess is organized, how Hess captures its cost. Instead of finding some random method to calculate it ourselves.
Well, would you agree with me that overhead by its nature is imprecise?
It's true, yes.
Okay. And based on what we've been looking at in AG 23, would you say it's imprecise because it's a matter of negotiation?
It's imprecise because of the nature of overhead. These are indirect costs. So overhead is, for example, let's say step 2 in terms of determining what's the time and effort spent on, on Barken upstream or supporting midstream or non-billable activities. I mean, those are estimates. That's by default, estimates are not precise. I mean, it's close, but it's not meant to be. We're not meant to be splitting hairs on this.
If you, sorry we're flipping around so much, but if you flip to page 3, in about the middle of the page, there's a paragraph that starts other factors. I'm just going to read this. Other factors that complicate the development of a standardized process are companies' different treatment of costs and interpretations of what constitutes overhead. Of course, these factors demonstrate the need for dialogue to reach a clear understanding of the goods and services covered by the overhead rates. Do you agree that there's a need for dialogue to reach clear understanding of the goods and services covered by overhead rates?
In the case where there is a JOA, where this AG 23 applies, yes. These subject wells do not have a JOA.
If I go to the next page, page 4, one moment. So I'm looking at the last full paragraph, and it's the final sentence of that last full paragraph. It reads, "It is hoped the parties use the matrix," this is the overhead matrix, "as a framework to engage in dialogue and document their agreement by checking the appropriate columns and using the comments section." Is that how HIBIC used AG 23?
It would be the same answer as I provided earlier. AG 23 applies when for wells where there is a JOA in place.
Okay. And
The subject wells do not have the JOA.
so if you look at, it's on your slide 9. This is applicant's exhibit A57 also. This is Hess's producing well overhead rate calculation, correct?
For 2017.
And I think you alluded to this. This is a spreadsheet with lines that have been hidden for purposes, for display purposes.
That's right. It has been. It's a collapsed version of a spreadsheet.
And Hess never provided the native version of this spreadsheet to applicants, is that correct?
I'm not sure of that.
Okay. And Hess never provided the data underlying this spreadsheet to applicants, is that correct?
I wouldn't know that.
Okay. So, obviously, Hess didn't negotiate with applicants to recalculate its producing overhead well rate in 2017.
Hess did not negotiate the overhead rate. Hess calculated the producing overhead rate to make sure that the Hess was not under or over recovering its overhead costs.
And Hess didn't give applicants any notice of this recalculation.
No, we did not.
Okay.
Apart from, I mean, it did appear on the joint interest billing when it's applied.
Yeah, it showed up on the bill.
Right.
Would you say that Hess didn't want applicants to know about this? The calculation itself?
No, I wouldn't say that.
Okay.
Do you, I mean, I can expand.
No, I don't need you to. Here's a copy of, this is just a larger copy of applicant's exhibit A57, which is the producing well overhead rate. In the bottom left-hand corner of A57, there's a label that says confidential attorney's eyes only. Do you see that?
I do.
So the former hearing officer issued a protective order in this case in April of last year. And in that protective order, it says that a party can designate information as attorney's eyes only when it contends in good faith that the information is highly sensitive, confidential information that could result in irreparable harm to the producing party, Hess, if disclosed to the party receiving the confidential information, applicants. So do you agree that HIBIC would be irreparably harmed if the information on this spreadsheet was made available to applicants?
Object, it's calling for a legal conclusion.
Do you think HIBIC would
I'm
be?
sorry, could you restate the question?
Do you-
Or are you restating the
I
question?
am restating. I'll restate it. Withdrawn, I'll restate it.
Okay.
Do you think that HIBIC would be harmed if applicants saw the information on this spreadsheet?
I can't say whether they will be or not. It's similar with any audits, I guess.
take a look back at AG 23, and like this is our A66. I'm looking at page 3. This is the second to last paragraph in subpart 2. It says, quote, "At the end of the negotiation, in the
Sorry,
ideal..."
where, page
Oh,
3 is it?
Page 3, sorry.
Okay, which paragraph is it?
If you look, the second to last paragraph in part 2 problem starts
Okay.
with regardless of. Okay. So it says, "At the end of the negotiation, in the ideal world, the parties should be able to answer the question, what am I getting for my overhead dollars?" Do you think that with respect to the subject wells, the applicants are able to answer that question?
It says at the end of the negotiation,
Yep.
right? So again, my answer for this would be there are no JOAs for the subject wells for which this AG 23 would apply from a, there has to be a negotiation standpoint.
Okay, thank you. I have one more question. It's going to go back to what we talked about earlier. We were looking at on the overhead statement, revenues, deducts. Do you know for the application wells, have the applicants ever received a positive per MCF net settlement value for their gas, for the combined gas stream?
I didn't review that information. They might have, but I did not review that information.
Okay, I don't have anything further.
Any redirect?
None.
Any staff questions?
Can I make a statement? Sorry.
It's okay.
Just a minute.
Let's wait for the questions.
I just had one question. You indicated that Hess does have non-ops with other operators. Are you aware, has Hess ever requested similar information on those statements to try to figure out costs and so on that they were being billed for?
I am not aware.
Do you know what method that those operators use? Do you know if they follow COPIS or how they determine it?
You mean for the producing overhead
Correct.
rate? I don't, and we have not requested for it. We are not.
Thank you.
Yeah, we don't ask. There's no negotiation that we are part of before we get charged for it.
Ram, I'm looking at slide 3. You had acknowledged that the deduction codes that you've listed here, that you're not required, well, let me back up. You indicated that those were from royalty statement regulations of the Industrial Commission. Several times in your testimony, you indicated that these were required to be on this form because of our regulations. And that conflicts with what you just said with the royalty statement requirement that the commission has. I just want to point out that you shouldn't say that the revenue statement to the working interest owners have to be in these 4 categories because the Industrial Commission requires it under a royalty statement. Those are 2 separate things. And it was never the commission's intent to try to break down deductions into these 4 categories for royalty owners on revenue statements.
Correct. I did not mean to. I'm not sure whether I said that, but no, this was the state's requirements was for royalty interest owners. It wasn't for working interest owners.
Right, but I just wanted to note that a couple times you did say the revenue statement has them on here because of the commission requirements. And I just want to point out that you shouldn't be putting it in that category.
Agreed.
The net value of gas, when we look at that, you've got the gas code of, or the product code of 204, and that's for your gas stream, right?
That is correct.
Okay. And then you've also got 400, I assume that's your NGLs?
That is NGLs, yes.
Okay. And when I go down to that second to the last line where it says 400 product code for the NGLs, it says the price of 31 cents.
That's
Is
correct.
that the price per gallon that
It is
you're
per
getting
gallon.
for it? Is that typical that it's that low?
On a per gallon basis, there was a price back for the December 2019 production month.
Okay.
But we have seen prices of NGLs fluctuating. Like, for example, in 21, NGL prices were much higher than what we saw back in 2019.
Okay. And when I look at the net value of the gas, it's minus $52, right?
The net value for gas for that month, yes, $52, minus $52.
Minus 52. And then if you add the value of the NGLs for $14.70, and then if you divide that by, in this case, the net gas of 4.54 MCF, you get, it's more than $8 deduction per MCF, right?
So you're taking the total $38, divide that by
Divided by
total
4.54.
volumes. 4.54 would just be the residue gas volume.
It looked like that was the net volume for the owner, was the 4.54.
Yeah, we'll need to include the volume, the 5397, which is in gallons, to the volumes as well. That would be the NGL volumes.
Okay, so irregardless of that, I mean, we're still looking at quite a negative per MCF, right?
That is correct for these wells, and this would be Sinclair ownership, which also has the 50% of that would be the state lease.
Okay, and then looking at the oil, which is, I believe, the last line, it's got a product code of 100 there, right?
That's right.
If we look at the owner's deductions, that's about $9 or so per barrel of oil for the transportation charge, right? The deduct code is 10. I'm wondering why that's so high. Why is it $9 a barrel to transport that crude oil?
How are you getting the $9, sorry?
If
That-
I look at just the owner net interest, that section,
Mm-hmm.
and then the product code is highlighted in yellow.
Okay.
10 is the transportation, and then just to the right of it, it says owner's deducts,
Mhm.
2167.
That's right.
So the owner's deducts for transportation of 235 barrels of oil was $2,167. So I divided that by the total volume of 235,
Got it.
and I got $9.22 per barrel to transport that crude oil. And I'm wondering, where was that oil transported from? What transportation charge is it? Is it from the well down the pipe flow line to the sales line at DAPL, or is it going to some other state, or why is it so high?
So the fees that would be included in here would be oil gathering and an export fee and third-party transportation fees, for example, DAPL. All that would be included in the $9 per barrel average that you calculated.
So it's
just
not
now.
all transportation then? It's a number of different fees
That's
under
correct.
the transportation code.
That's right.
Going to slide 4, you indicated several times that you never charged the royalty owners a negative value for their gas. There's been several people in the past that have testified in front of the North Dakota Legislative Assembly and indicated that they had major negative gas values that were taking their oil revenues away on royalties. Is that something you used to do in the past, or why would they say that? I mean, it's the opposite of what you're saying. Why would they make those statements in front of the legislature?
Are these royalty interest owners?
They're royalty interest owners.
I don't know. We have never done that, and there's not been a change in how we handle this.
Okay. And under slide 9,
I would like to clarify or
Go ahead.
expand on my answer. So I think I did mention this in my testimony, but the oil value for royalty interest owners is protected from the combined gas stream as well. So if there's a negative balance on the combined gas stream, that is restricted to the gas stream. That is not deducted from the oil revenue for royalty interest owners.
okay, well, maybe you should tell the royalty owners that made that statement instead of me, but.
Right.
Is it typical that the overhead rates that you calculate are going to be much lower when there's a JOA in place versus you using COPUS and guidelines on your own?
Not necessarily.
I mean, it appeared from past testimony that that was the case, because every time we compared the JOA calculated overhead, it was much less than the Hess recalculated one in 2017.
In most cases, this is just general practice. I don't think anyone sits down and calculates their producing overhead rate, because this is an extensive amount of work. And typically the overhead rate is achieved in JOAs. They are typically achieved via negotiation between various parties.
By what now?
By negotiation between the involved parties. In so far as I've seen, I've not seen anyone come up with a producing overhead rate calculation, because it's a very extensive and involved calculation.
Okay, well, that wasn't my question, but as far as the evidence that we have, it just appeared for me that it was much lower if you didn't have anybody else, negotiating with you. But under slide 9, if we look at the orange area, you've got line number 86. It says ND field and plant operations.
Correct.
And we're talking about the overhead calculation.
Mm-hmm.
So the plant operations, what type of plant are we talking about? Is it the Tioga gas plant, or what is it?
This was the way the organization was back in 2016, 2017. I am guessing that this call center group would have the field operations and also the plant operations at the time. So that would be the gas plant, the Tioga gas plant.
Okay.
I believe so.
So the number that you came up with was $2,021, right?
The eventual calculation, yes.
And did you indicate that you recalculated that in March of 2017?
That is correct.
Okay, and that increased to, what, by $600 a month or so, right?
$300 a month.
Okay. So did you also use the plant operations in it for overhead?
Yeah, if you look at the field and plant operations row, there's no cost associated with ND field and plant operations that eventually gets included in the overhead rate calculation. So if you look at column P, which is the last colored column, there's 0 in that cell.
Okay, so that would have been probably calculated in the gas tariff rate then, is that right? Instead of here for overhead?
That is correct. So if there's anything that is associated with the midstream, it would have been included under that cost. And anything related to field operations does not get included in the overhead rate because we considered that, because those are billed as direct charges.
Okay, thank you.
Ram, I got a couple questions on that same page, number 9. I may have missed it when you were explaining it, but can you give me some detail on line 110, North Dakota supply chain? 40% of that is ending up in the overhead, and it's the second largest item. So what goes into North Dakota supply chain?
So basically the type of services they provide would be contract negotiations, procurement, making sure we've got the right negotiated rates, we've got long-term agreements in place. Those would be the type of services associated with the embedded supply chain. When I say embedded, it's embedded within the asset team. Now, in terms of the percentage that is shown there, what makes it into the overhead rate calculation would be the supply chain team that supports field operations. Now, the supply chain team that support basically, let's say, drilling and completion operations, that percentage of time and effort would be in the column N, covered by drilling or construction overhead, right? And then there's a portion of the supply chain team that was determined to support the midstream business. So at the time it was 14%. So based on the elimination, the portion of supply chain team that supports the field operations associated with the operating the wells was determined to be 40%, and 40% of the supply chain cost center group cost gets included in the overhead rate calculation.
Would it be accurate to describe that as the purchasing team?
It to be, yes.
Okay. So it's the individuals, the human resources that negotiate contracts and purchase materials
That is
for
correct.
operating the wells.
That is correct.
Okay. And then help me out with line 5, North Dakota Executive Management. What goes into that? Because you've got the executive management and then you've also got the general manager.
Right. So this is the title for the call center service group. I'll explain what's within that call center service groups. So executive management, that would include the, again, these are all asset embedded executives. I remember the VPs would have been under the ND executive management. And when I say VPs, it would be the VP for Bakken, right? Not anyone above that. For example, we have the senior vice president of global productions. We've got the COO. We've got, the corporate office. That would not be part of this ND executive management. I remember back at that time, for example, the lead for human resources based in Houston, the lead for EHS based in Houston. We had a few infrastructure folks that were based in Houston that were included within that ND executive management cost center group, right? So that is a makeup of those folks. Now, in terms of establishing how much of what they do would be billable in nature and gets included under the overhead rate calculation, based on the elimination process, we established that more than half of what they do would be in benefit of Hess only. That is, it won't be in benefit of, other parties. And we also determined that based on the makeup of that call center, about 22% of the people and the time and effort spent by the folks in the call center would be in support of the midstream business, so it doesn't go into the overhead rate calculation. Similarly, about 4% would be in support of the legacy asset. We did have some legacy wells at the time that we were operating. And the remaining 18% would be the derived portion that would be considered of billable type services that would be included in the overhead rate calculation. So that would be the ND executive manager. Now, if you want to go to the general manager,
Right. How does he differ?
right?
He or she?
So again, this is not one person,
Okay.
you know, and the naming of the call center group can be a misnomer here. There are several services embedded under this ND general manager call center group. Office services was part of that. The field inspectors were part of that. Regulatory and permitting group based in the minor office was part of that. And the general manager was part of that. I mean, there's one person, but all these other groups were reporting into the general manager at the time. So again, based on that determination, you know, about 75% of the time and effort spent by those folks were in support of the midstream business, another 5% in support of the legacy wells, and the remaining 20% was determined to be in support of the Bakken asset, Bakken upstream asset.
Okay, thank you. One more then. I don't think you vetted what goes into North Dakota finance. That's line 102, and it's one of the green boxes on page 7.
That's right. So, North Dakota Finance, that will be my team now. I just took over the team back in 2017. Now, these are 2016 costs. So the types of services that finance provides are tracking cost, reporting of cost, stewarding the process of cost management, getting the folks in the business to understand what their cost is, tracking performance, ensuring internal management reporting is accurate, creating AFEs, making sure we've got the right cost objects in place, AFEs created in place to make sure we capture costs in the right place, and we make sure that we share those costs and revenue accurately. That would be what my team does. In terms of time and effort basis, we determine that about more than a third of the time would be spent on basically HES specific purposes, so that would be 37%. And also based on the makeup of the team and time and effort, 18% of that would be in support of the midstream business. And about 4% of that would be in support of the legacy wells. And there's a portion of the team that supports the drilling and completion activities. So it's determined to be about 26% that is assumed to be included in the drilling overhead. And by elimination, about 15% of that would be in respect of services that would benefit that would indirectly benefit the joint properties, and that 15% of the cost is what makes into the overhead rate calculation.
So all the accounting functions fall under that, making sure that you're.
These would be the finance support team. Now the accounting functions in terms of, let's say, joint venture accounting, revenue accounting, production reporting and measurement, those are shared services that is outside of these asset embedded teams.
Okay.
Now that's what I call central support teams, and now those type of accounting services would come through the tier 3 allocation that shows up under the Bakken upstream row. So yes, so those type of shared services support the asset and they get allocated to the assets. And it's treated consistently across the HES portfolio. We have assets in the Gulf of Mexico, we have assets in Guyana now, we have assets in Southeast Asia. So based on consistent allocation drivers, they are allocated in the same way every month, every year.
Thank you.
Any additional questions?
Yeah, Ram, there's no JOA covering these wells, so the producing overhead rate that has set initially, how, you said you don't do this calculation for every well, how was that set?
That's a good question. I don't know the answer. Us around within HES, there's no one around, that knows what that answer is.
Okay, so how is it set today on a new well?
So for a new well, we perform this calculation on an annual basis. So let's say for a well that came online in 2018, we perform a similar calculation based on 2017 actuals for 2018, and we attach that 2018 rate to a new well that came online in 2018.
Okay, thank you.
I just have one clarifying question. When you talked about, your testimony was that in 2017, you conducted an analysis to evaluate the overhead. And when you say you're talking about HIBIC?
Yeah, I didn't specifically perform the calculation. So back in, so the work was done in 2016.
Okay.
And that was done by the Barkin Finance Support Team that supports HES Barkin.
Hesbach
HIBIC,
Investments. Okay. Any other questions?
I do have one more. Mr. Crawford came up and gave us an example of a June 2020 monthly check, and I believe that, didn't get all the numbers written down, but it was like we'll just say an 80% deduction in his revenue. So I assume that if that was a Hess well, their revenue would have a similar deduction at that time?
You mean for HES?
Yeah.
Yes.
Okay, thank you.
Well, I'm not seeing any individuals or any staff people with any additional questions or any clarifying questions from council.
None for me.
Hearing none, it is after 12:35. Council, do you know for your last witness how long that might take?
An hour and a half. For direct, yeah.
So it looks like we'll be able to finish today. So can we try to keep our lunch break to 30 to 45 minutes? Is that? Let's shoot for 30, see if we're all back and we're ready to go, and if we need a little extra time, that's okay too.
30-minute lunch?
Let's shoot for 30 and
1:15 would be good.
1:15, I think.
1:15, that's fine, okay.
Very good. Thank you.
Just have a donut and we'll be back here.
All right, we'll go back on the record. It is approximately 1:21. Counsel, you can call your next and last witness.
Oh, we have one housekeeping matter. There was some exhibits that were excerpts that they wanted us to provide the full document, so may I approach?
What exhibits are those?
Which number was it? 33, 34, and 35. 33, 34, and 35.
No objection.
We'll receive those.
So good afternoon, Mr. Hearing Examiner Paul Forster from Crowley Fleck, and I will now call to the stand Ms. Lisa Adair.
All right. Ms. Adair, welcome. Could you state your name for the record, please?
Lisa Adair,
And spell it, please. I'm sorry.
Lesaadair.
All right, Ms. Adair, could you raise your right hand, please? Do you solemnly swear or affirm under the penalties of perjury that the testimony you're about to give in this matter will be true and correct to the best of your knowledge and belief?
Yes.
All right, you may begin.
Yes, and Mr. Hearing Examiner, I missed one housekeeping issue from Ms. Adair. I think we voiced it yesterday, but the council stipulated that the expert reports would just be stipulated into evidence. So at this point, I'd move to put in Hess Exhibits 37, 38, and 39, which are the three reports that Ms. Adair has issued in this matter.
No objection.
Those exhibits are received.
And Ms. Adair, were you retained to serve as an expert in this matter
I was,
by Hess?
by Hess.
I'm going to start off with just walking through a little bit about your background, and I'll have you flip to Hess Exhibit 37. Let me know when you're there.
I'm there.
Is that the initial report that you issued in this matter?
It appears to be.
And then I think there were two other subsequent supplemental reports that you issued, correct?
That's true.
And if we flip back to Appendix A on Hess 37, that has a CV, your qualifications.
It does.
Okay. And I don't want you to go through that line by line, but could you just give the commission a bit of an overview of your background, starting with your educational background, please?
Sure. I have a bachelor's degree in chemical engineering from Oklahoma State and an MBA with a concentration in finance from Southern Methodist University.
And tell the commission about your work experience in the oil and gas industry.
So I started working in the oil and gas industry in 1982. I held, I guess you might call it trainee position for ARC Oil and Gas Company at that time, and I finished my degree in 1993 and then went to work for them full-time. Spent a year on their engineering development program with additional education, and then and moving around to different departments in the company and learning how the company worked. And then I went to work in a gas processing plant, worked in and around that plant every day for the next 6 or 7 years, and held various positions in engineering, maintenance, supervision, operations, and I took on some major project roles in capital projects. And then I transferred into the reservoir engineering group and did all things subsurface for about 1.5 to 2 years. And then I moved to Dallas and went into the crude oil marketing group. So got experience doing commercial negotiations and working with other companies. And at that time, I moved to Muse Stansel and became a consultant, and I've been a consultant in the industry since that time.
Please tell the commission a bit about your background serving as a consultant in the industry.
So Muse Stansel and my current firm, Pearson Adair, we work in similar ways between the wellhead and the end user along the energy value chain. We don't do reserves engineering or subsurface engineering, although we do work around those assets a lot, and from time to time they come into our evaluation work. So transactional work, contract evaluation, due diligence, just valuation of companies, looking at projects for investors, owners, engineers, all varieties of things you can think of in oil, gas, and natural gas, some in the electricity sector, but all along that value chain. And working both in technical and economic areas. And we usually tell clients that we add the most value where those two things overlap, technical and economic.
Technical, economic. Have you also testified as an expert witness in those areas?
Yes, I think I started testifying in 1992 or 93.
And I think Appendix B to your report contains a summary of recent testimony. I don't need you to walk through that line by line, but suffice to say you've testified as an expert witness in a number of matters.
Yes, I think this list probably comports to the federal rules, so probably the last 4 years is the time of this report. So I think the list, I mean, I've been doing this for decades, unfortunately. I hate to say that. So the list is pretty long, yes.
Have you testified recently as an expert witness in North Dakota?
I did. I was here for the Vitesse hearing.
And let's now move to the subject matter of this case, Ms. Adair. What were you asked to do in this case?
I was asked to assess the applicant's claims, and specifically with respect to the production and post-production costs that are necessary for the operation of the wells, Hess's wells in North Dakota.
And
Also to reply to Mr. Atala, to look at Mr. Atala's opinions and comment on those.
And concerning post-production costs, did you specifically look at the gathering and processing charges that applicants are challenging on gas?
Yes, we focused on the gas, well, really all gas-related fees, gas gathering and gas processing, tariff models and compression and those sorts of things.
And then in terms of production costs, did you specifically look at the producing overhead charge that we've heard about?
Yes.
And I'll move to qualify Ms. Adair to testify as an expert witness on the topics covered in her reports.
Any objection?
No objection.
Great, motion's granted.
Now, Ms. Adair, what information did you rely on in the course of doing your review and preparing your opinions in this matter?
So there's been quite a bit of production in this matter. So obviously the documents that were exchanged by the parties, public data and information, interviews with Hess employees, kind of a variety of employees, but a number of Hess employees, deposition transcripts. Those are the things that pop immediately to mind.
Did you do a site visit as well?
We did do a site visit, and that's a part of where, when I was alluding to talking to Hess employees, every Hess-operated site that we visited, we were able to speak with Hess employees that were there and managing the facilities, along with people in other jobs at Hess we've talked to as well.
We'll get into the specifics in a couple minutes, but can you just tell the commission at the outset, at a high level, what opinions you've reached regarding Hess's post-production gas costs that are being challenged by applicants?
Yes, the costs are actual. They have a basis in what's actually happened and the money that's actually being spent, and they're reasonable from the standpoint of the way in which the facilities are constructed and they operate, and the rates of return that are included in the tariff models, for example.
And can you also tell the commission at a high level what opinions you've reached about Hess's production costs and specifically the producing overhead rate that's challenged by applicants?
Right. So we did review the producing overhead whole methodology and how the teams went about allocating and constructing that analysis. So we talked with several Hess employees and then reviewed the information that you all saw earlier and found those to be based on the actual costs that were incurred and reasonable for the wells that are operating in North Dakota.
Thank you. Did you assist in preparing any demonstratives to assist in your testimony today?
I did.
I'm going to hand you now a copy of Hess Exhibit 88, which I believe was already admitted into the record this morning. So that'll be the 88 in the Hess Exhibits binder. And then once you get to Hess 88, I'll have you flip to page 3 of that document.
Okay.
And Ms. Adair, the first question I want to ask, and I know Mr. Gatling has already discussed a bit about the constrained environment for midstream services that existed at the beginning of the Bakken play. Did you hear that testimony?
I did, yes.
Does your report contain any data that validate his observations?
Yes, and on slide 3, this is the North Dakota Pipeline Authority forecast, if you will, as of January 2016. This speaks to the oil capacity limitations in North Dakota at that time, and note that quite a bit of the oil was actually leaving the basin on rail at that time, and hence one of the reasons that Hess had the rail terminal for oil operating as early as 2011, but obviously there were restrictions on capacity to move oil from the basin.
And do you have an understanding as to whether the Bakken is primarily an oil play or a gas play?
It is. It is primarily an oil play, and I think a lot of the data and information you all have already seen this week confirm that.
Okay, let's turn to slide 4 now, and we just talked about oil takeaway capacity. What's shown on slide 4?
Slide 4 is a similar forecast. I think it was prepared maybe at a later date than, I think it's closer to the end of 2017. But looking at the gas side of the business and looking at the production and gas capacity additions over time, and noting how close a line it's been between capacity and production, and also the flaring that's happened just because the capacity couldn't keep up with the production over time.
And this slide is specifically showing processing capacity, correct?
That's correct, and I think as Mr. Fraley mentioned this morning, to get your gas processed, you first have to get to a plant, and so recognize this is only one part of that value chain. If you can't get through the gathering system, you can't get to the plant either. So
Now, were gas gathering and gas processing both a constrained environment in North Dakota at the beginning of the Bakken play?
yes, very much so.
And you mentioned that this is an oil play. Why would there be a need to worry about gathering and processing the gas if this is an oil play?
So a couple of reasons. First, we know in 2014 there is the flaring targets. So that's one reason. The second reason is that there are air emissions limitations, VOC limitations, and so by drilling spacing unit, those also have to be managed. And I think, prospectively, Mr. Gatling talked about the Quad O methane restrictions that are looming, and all of those things are pointing to maximizing gas capture and minimizing flaring.
Focusing for a moment back on the beginning of the Bakken play, was there a wide recognition in North Dakota regarding the need for additional midstream investment toward the beginning of the Bakken play?
Yes, absolutely.
And was that something that was recognized both by industry and by state officials?
Yes.
Let's turn to the next slide, slide 5. Did Hess make significant investments in midstream infrastructure in that time frame that looking back 10 years or so?
Yes. In fact, we talked a little bit about TGP expansion in 2014, and this slide speaks to that event. The lean oil facility, which wasn't capable of recovering ethane, was shut down, and the new cryogenic facility, more than doubling the capacity, was started up that event was recognized by, for example, Senator Hoeven, who talks about appreciating the investment Hess was making in North Dakota, recognizing the expansion that's doubling the capacity to produce natural gas and recover 3 times the amount of propane while reducing flaring. And he talks about it being a huge win for the state and the country. And in particular, the NGL recovery capacity is important because every drop of liquid you can take out of the gas creates capacity in the gas pipelines, and allows more gas to leave the state.
Let's turn now to slide 6.
Okay?
And we mentioned your site visit that you did for this case a moment ago.
Yes.
When did that happen, your site visit?
The end of July 2022.
And does this slide show some of the facilities that you visited during that site visit?
Right. So each of the call-outs on the slide was a site that we were able to either see from the road in the non-Hess operated facilities, or actually go in and tour and interview the folks who were operating these facilities.
And did you also, in addition to visiting the Hess facilities that are shown here, did you also view a nearby Sinclair well pad and the Robinson Lake and Palermo plants?
We did. We took the opportunity to go and at least do an external inspection to see what we could see from the road and put together with public information to try to build a better understanding of those facilities.
I'm gonna now have you walk us through some photos. I guess but first let me ask: did you take some drone photography or videography while you were doing that tour?
We did, and still photography.
And does this next series of slides with photographs contain true and accurate depictions of Hess facilities as taken from drone stills at the time you did that site tour?
Yes.
And so let's first flip to slide 7. Tell us what's shown here.
This is an aerial view of the Uran well pad. We've been talking about those wells this week, showing the wellheads and the surface equipment necessary to produce the oil, gas, and water stream and get it separated and ready for delivery to the gathering system.
And then turning to slide 8, what does that show?
Slide 8 shows a schematic of the oil, gas, and water system. The lower left-hand corner is that same Uran well pad, and just depicting the lines are flowing away from Uran, picking up other pads along the way as the oil, gas, and water are moved further downstream. And the gas in particular from the Uran is gathered at low pressure, and it's headed for a central compressor station.
Slide 9.
Which would be the central compressor station. This is the East Nesson compressor facility. This facility, with respect to the Uran well pads, replaced the Ross compressor facility. I think the gas previously had gone to Ross, and when East Nesson started up, then the gas came here. It comes in at low pressure. Any liquids that are flowing with it are separated in the inlet separator. And then the gas goes to one of these 4 compressors where it goes through 4 stages of compression. The pressure is raised, it's dehydrated, and it goes right back out the station and heads to the Tioga gas plant.
Okay, so let's turn to slide 10. Tell us what's shown on slide 10.
Slide 10 is an overview aerial photograph of the Tioga gas processing plant, and in the lower right-hand corner here you can see the high-pressure inlet. That's where the gas from the East Nesson compressor station comes into the facility, and across the top is really where the processing units in the plant are located.
Okay, so for the processing area, let's flip to slide 11. What's shown on slide 11?
This is just a breakdown of the process areas within the facility. You see the cryogenic plant and fractionator in the center, the debottleneck plant to the upper right, and then I think Mr. Fraley talked about many of these export options for natural gas, ethane, and so forth are shown on here as well.
Both residue and natural gas liquids.
Correct, although what's not shown on here would be the Y-grade interconnect line for One Oak, and any fractionated product goes into tankage here and then through a 2-mile pipeline to TRT where it's loaded onto rail cars, or it can go into trucks.
So let's turn to slide 12 now and zoom in on the cryo and fractionator portion of that
Okay?
process area. Tell us what's shown on slide 12.
So slide 12 is the area where in the cryogenic facility the gas gets very cold, and with changes in pressure and temperature we're able to liquefy hydrocarbons that are contained in the gas, and in the cryo we can get ethane as well as the heavier components. That mixture of liquids then goes to the fractionation train, and commercial ethane, propane, butane, and a stream called natural gasoline are produced from that fractionation train. It's capable of moving about 60,000 barrels a day off the 250 million a day gas handling capacity of the cryogenic facility.
I think you might have referred to it in passing, but what is the quality of residue gas that the gas plant produces out of this cryogenic facility?
Sure. The cryogenic facility, because it extracts a lot of ethane and the heavier components, makes a very high quality, very dry natural gas stream that can float any pipeline in the country, essentially.
Let's turn to slide 13. Tell us what's shown here.
This is the TGP debottlenecking plant. Earlier, I think Ron might have been talking, or Michael was, about the fact that this plant was scheduled to come online in 2020, but because of COVID was delayed, started up in 2021, and added an additional 150 million a day of gas processing capacity here. This plant extracts using refrigeration technology, so it's cooling a higher pressure gas, and makes a Y-grade stream. It's not fractionated, it goes to pipeline and leaves the basin on the One Oak pipeline.
All right. Shifting gears a bit, let's turn to slide 14. What's shown on slide 14?
This is Ramberg crude oil truck unloading in the Ramberg terminal. So the Red Sky gathering system for crude oil comes into Ramberg. You can see a few tanks at the terminal there. There's about 30,000 barrels of tankage within the terminal. There's a 300,000 barrel tank that has leases at MPLX nearby. And then this facility is connected to TRT via a bidirectional pipeline. So oil here can also get to rail cars. It can get to DAPL or to Enbridge. And the facility also can accept up to 300 trucks a day at the 10 unloading stations that are located on that site.
Turning to slide 15. What's shown on slide 15?
Slide 15 is an aerial photograph of that TRT facility, the rail facility. So the facility is designed, or was designed originally, for a crude oil unit train, so has a full crude oil rail car loading facility. But then in 2014, with the large fractionator startup, the NGL rail rack was added so that they can load rail cars. At the time we visited, and I would think still today, they're loading rail cars 7 days a week, 24 hours a day.
And slide 16, is that the NGL rack you were talking about?
Yes, yes. Shows a more close-up view and notes all the logistics handling with rail cars that are required for NGLs.
And I don't know that everybody needs to turn to it, but I'll have you at least flip to Hess Exhibit 40 quickly. I just want to ask you, in case the Commission's interested, does Exhibit 40 contain some additional photos of the infrastructure that you viewed on your site visit?
Yes, it does.
And so I'll move to admit Hess Exhibit 40 into evidence.
I'm sorry, what was that again?
It's 40. It contains a bunch of the.
Oh, that's fine.
Exhibit is received.
And I'll also have you note, Ms. Adair, is there a larger collection of photographs at the back of your first supplemental report that we previously put into
Yes.
evidence?
There is, which is what, Exhibit
38.
38, yes.
In case anybody has a hankering for more photographs. But we'll move on now and try to be efficient. So with that background behind us, I want to move on to slide 17. And before we dive into specifics, can you just give us a roadmap of your opinions, some of the specific opinions that you're going to walk through with respect to the post-production gas costs at issue here?
Sure. So the post-production gas costs are reasonable. They're based in actual costs that Hess incurs, and they're necessary for the operation of the Hess wells to provide flow assurance and to minimize flaring. We're also going to touch on producer and midstream related companies and the fact that that is not an unusual occurrence and in fact happens all the time in our industry, and especially when large infrastructure projects are required. Then we're going to go on and talk a little bit about my opinions with respect to reasonable rates of return and the fact that the Hess rates are reasonable, and we will look at some public data and information on that subject and address Mr. Atala's opinions and his modifications of the tariff model. We'll talk about how his modification of residual value results in invalid analysis of the tariffs. And we'll also talk a little bit about weighted average cost of capital rates and look at what some of those look like. And then we'll get into the tariff model and talk about residual value and the fact that residual value addresses depreciation. It addresses the spreading of capital costs over volumes in a units of production way or a depletion type concept. And then talk about comparables and Mr. Atala's comparables in particular, specifically address the services that are provided and the technical capabilities of Robinson Lake and Palermo. And then I think we'll be ready to move on to producing overhead at that point.
All right. So with that, thank you for the roadmap. Let's turn to slide 18.
All righty.
And before diving further into some of the specific charges that are questioned by the applicants, can you speak to whether you, in conducting your review, observed anything unusual or unreasonable in terms of the relationship between Hess and Hess Midstream?
No, in fact, the way the contractual structure is aligned and the groups that are working and the Hess midstream entity, this is very typical of the way producers and midstream companies have evolved and conducted business in the shale era when these huge investments in both drilling and infrastructure development were required in order to bring fluids to the surface and produce oil and gas.
What does the table on slide 18 show?
Slide 18 is a summary of the producers who have had related midstream companies really since the beginning of the shale era, so 2010 forward, I would say. Now, not all of these companies are still related parties. Many of them have sold or gone public. The first one, for example, Continental, sold Highland to Kinder Morgan. And so it's now Kinder Morgan here in North Dakota. But it just gives you kind of an overview. There have been a lot of these types of partnerships, and they were necessary to make sure that instead of having the drill bit in front of the pipe, the drill bit and the pipe could get more aligned and have adequate infrastructure available as we were drilling wells in the industry.
Thank you. Let's turn to slide 19 now, and I don't want to spend a lot of time on this because we already spent some time, but slides, just to orient you, slides 19, 20, and 21 contain callouts from a revenue statement and then a couple, image and call out of a gas plant statement. Do you see that?
I do.
And did you review basically the way that Hess's accounting is working to, to flow through the costs to the gas plant statement and ultimately to the revenue statement?
Yes, and I think Mr. Atala and I agree on this, that the numbers do tick and tie and are consistent with the contractual arrangements and the tariff models and fee
And that was
structures.
going to be my question. You agree that you recall his testimony that the charges shown on the revenue statement materially tie out with the gas charges on the gas plant statements and ultimately with the fees set in the tariff models?
Yes, that's true, yes.
So with that, let's move on to slide 22. And fair to say that the gas gathering, Red Sky gas gathering tariff and the processing tariff are the two biggest components by quite a bit of the gas costs that applicants are seeing.
Yes, yes.
And so I know Mr. Gatling and Mr. Fraley have already touched on this a bit, but did you also study Hess's tariff models?
Yes, in great detail.
And do you recall Mr. Atala's testimony to the effect that the math in the models works and that the models do implement the terms that are set out in the Hess midstream contracts?
Yes, and that based on not only my review, but our team's review, that we would agree with that.
Now, we've heard mentioned earlier that that these referred to as tariff models. At a high level, just conceptually, what is a tariff model?
Well, there can be lots of different constructs, I guess, for a tariff model, but generally you're taking some component of cost, spreading it over volume. And typically there is a rate of return associated with the capital that you've deployed to provide whatever service you're providing for the tariff.
And is that what the tariff models at issue are doing with respect to the charges that applicants are disputing?
Yes, in the cost of service period, that's exactly what they're doing.
Yeah. Are cost of service models common in the midstream industry?
They are. They take on many different forms, but they are common.
Have they become more prevalent in shale plays or since the time of the shale boom?
They have, and primarily because of the size and nature of the infrastructure that everyone was clamoring for, not only here in the Bakken, but in Appalachia and the Eagle Ford and the Permian. There was such a large call for capital that investors could pick their projects. And as a result of that, they wanted to have surety that they would get an adequate return on the money they were deploying. So these kinds of models became more and more prevalent over time.
Let's turn now to slide 23.
Okay.
And this slide shows the kind of summarized mechanics of the tariff model. I think Mr. Fraley walked through a similar flow chart in his testimony. You remember that?
Yes, I do.
And, he explained some of the mechanics and how they tie out with the contracts. Were you here for that testimony?
I was, yes,
And
he
you agree
did.
with, based on your review, do you agree with Mr. Fraley's testimony of the, how the tariff models work?
Yes, yes.
Do you have prior experience analyzing cost of service models?
Yes.
In light of your industry experience with midstream infrastructure and charges and cost of service models, what is your assessment of the tariff model that is being used by Hess Midstream, and specifically the resulting rates that Hess charges to working interests?
These rates are based on the actual capital that has been deployed or needs to be deployed to meet the operational volumetric forecasts, and those capital dollars are allocated over time and over volumes, and then a reasonable return on capital is added to that as part of the model.
And you mentioned return on capital. Is that what the box in the bottom right of 23 is showing?
Yes, for the different contracts that we've been talking about, the different tariff rates.
And as I understand it, the Red Sky gas gathering fee, that would be under the gas gathering contract at a 12% return on capital?
That's true, yes.
And then the processing would be under the processing and fractionation contract at a 14%.
That's true, and those are before tax.
Before tax returns.
Before tax, yes. These models all run on a before tax basis.
So let's turn now to slide 24. You just mentioned that the midstream tariffs that are at issue here have a return on capital of 12 or 14%. Have you analyzed how the Hess Midstream return on capital provided in their contracts compares to other gathering and processing contracts that you were able to locate in the public record?
Yes,
Is that shown on this slide?
yes. These are the 4 contracts that we could find that were in the public record and provided the returns that were utilized in the contract.
And it looks like 3 out of 4 of these were cost of service models.
Yes.
Now, I wanted to ask, are the return rates for midstream gathering and processing systems, are those rates of return generally publicly available?
Not generally. These contracts are usually highly confidential, and that is why you can look for a long time before you find one that either was made available in a litigation setting or some other public record so that you can discern what rates were used in the contract.
I want to just pick out one of the examples here that the Chesapeake Midstream contract in the Haynesville that had a 15% return. You see that one at the bottom of the table?
Yes.
Where did you source that rate from?
This is actually, the rate was actually sourced from an expert report prepared by Mr. David Posner, who you all may remember. He was here in the Vitesse hearing, and he had provided some testimony about this particular contract in a litigation setting in Louisiana. I believe it was in 2015, and that's where the rate was disclosed.
And did you review that report?
I did. Yes.
What did it say just in general about the 15% rate of return in the Chesapeake contract?
That the 15% was consistent with Mr. Posner's experience in his review of contracts, as it is with mine, where cost of service models are utilized. And he went on to say that in settings where you don't have a cost of service model and you have a large commitment to build infrastructure, that rates 20% or above would be typical of what he had seen in the industry.
And when we say the industry, you're talking about midstream services.
Correct.
Let's turn on now to slide 25.
Okay.
And I want to unpack this a little bit. The slide, we heard the term WACC yesterday, weighted average cost of capital. You were here for that, some of that testimony, right?
Yes, yes.
And this slide shows a weighted average cost of capital comparison. But before getting into the specifics of what the slide shows, can you just explain to us what initially led you to do the analysis that's reflected on this slide?
Yes, I believe Mr. Atala had either testified or included in one of his expert reports to saying that a weighted average cost of capital rate would be appropriate for the type of return that would be reasonable. Now, in my experience, weighted average cost of capital is usually the floor that a company is looking for when they're making investments, because they do actually have to pay for that. They're paying their investors at that rate. So they would be looking to invest in a portfolio of projects that would return a higher rate than that. But that's what led me to then go and look at what we could find in weighted average cost of capital rates in the public record.
And as relevant to the comparisons on this slide, what type of gas infrastructure does FERC regulate?
So interstate pipelines.
Interstate gas pipelines?
Yes, gas.
And just at a general level, how does FERC regulate rates for those kinds of pipelines?
So generally, tariff rates are filed, initial filings are made when projects begin operating, and then if changes occur or shippers believe that the rates are too high, then an actual rate case is opened, and FERC will actually go in and review what is happening with the cost of service for that particular entity. And so this table on page 25 represents rates that have been through that process, that rate-making process at FERC. Now, FERC reports their, well, let me back up. The companies are required to report to FERC on Form 2s annually what their weighted average cost of capital numbers look like, and what really their cost of service has been. And so that's where we obtained this data, was from those FERC Form 2 reports that are reported annually. They're reported on an after-tax basis, and we converted those to a before-tax basis.
And I was just going to go there. Can you explain again for the commission that, that this specifies before-tax WAC rates?
Right.
Explain to the commission the import of that.
Right. So one of the things that is always an issue when you're talking about the financial analysis of an entity is, well, what is its tax status? And so to compare, generally we look at before tax information when we're comparing. Also in this particular situation here, the rates of return in the tariff models are before tax. So we were seeking to get everything on a before tax basis, and that's what we did. We just converted.
And just to be clear, the before tax basis, if I'm understanding correctly, assuming that the entity is taxed, a before tax basis is going to be higher than an after tax basis.
That's true, yes.
Okay.
And one annotation on this chart for Wyoming Interstate and Elba Express, Mr. Atala pointed out that those two entities at the time of this FERC reporting period were 100% equity. They had no debt. So the rates that are shown there are their cost of equity rates. We went back and reviewed the Form 2s, and when they had their rate case, FERC implied a debt structure on them. And so the Wyoming Interstate number with the debt is about 13.5, and the Elba Express with the debt is about 14. So it brings that range into an even closer range in and around the 12 and 14% HES rates of return.
And thanks for that note. I want to just unpack that a little bit. So the rates that you're showing on this table for Wyoming Interstate and Elba Express, if I understood correctly, those are the correct rates as they appear on Form 2 that the entity is reporting that they're earning, essentially?
Essentially, but it was because they had no debt at that time.
Got it.
So-
And when FERC did the rate case, they were assuming that there would be debt and approved a debt structure rate?
Correct.
And just, again, what was the rate assuming the debt structure for those two?
13.5 for Wyoming Interstate and 14.5 for Elba Express, I believe.
Now, can you tell us, you mentioned that these that these FERC-regulated entities are operating interstate gas transmission lines.
Correct.
In general, how do expected returns compare for interstate transmission lines versus gathering and processing systems like the ones at issue in this case?
So generally, the returns for interstate systems, because they're regulated with cost of service and have generally multiple sources of supply in multiple markets, they're viewed to be lower risk assets, lower risk than, say, gathering and processing, which are not as geographically diverse, tend to be connected to specific reserves, specific gas processing plants. And so I think as you move towards the wellhead, the view is you're getting into riskier and riskier assets.
In that event, why the comparison here between FERC-regulated, the weighted average cost of capital for FERC-regulated entities versus the returns in the Hess midstream contracts?
Well, simply because Mr. Atala mentioned that he thought that would be an adequate return, would be to look at weighted average cost of capital. And because these are the public rates that are available for these entities, that's what we chose to take a look at and provide a comparison on.
And given the general risk profiles you just discussed, would you say that in general that a comparison to an interstate transmission line would be sort of a conservative comparison for a gathering and processing system?
Yes, definitely be conservative.
Let's now turn to slide 26. And tell us how this slide differs from the previous slide.
So this would be for entities that have not had a rate case but are reporting on FERC Form 2s. And I would call your attention here to the bottom half of this chart, the Northern Border Pipeline reporting for 2012, 14, 17, 21, and 20. This Northern Border Pipeline is connected to the tailgate of Tioga. So we're looking at an asset that is directly connected to the assets we're talking about here. And you can see there before tax weighted average cost of capital rates in the time frame 2012 to 2021 have been in the 17 to almost 20% range.
And the Hess return on capital rates from the Hess midstream contracts, the 12 and 14%, are those shown in the vertical bars?
Yes.
That are imposed over the bar graph?
They are, yes.
So before we move on, I want to ask, do you agree with Mr. Atala? He had a slide suggesting that the tariff model is not really a cost of service model like the ones that FERC uses. What's your response to that?
The cost of service period of the tariff model, which is the initial 10-year period, in my opinion, has the same attributes as FERC models, a FERC cost of service model. They may not be named exactly the same. Although the tariff model, as we discussed, is on a before-tax basis, and the FERC ultimate reporting and assessment takes place after tax.
How do you respond to Mr. Atala's assertion, and this was from his demonstratives, that, quote, the cost of service approach uses depreciation, Hess models do not?
The residual value, which we're going to talk about shortly, I think we have a slide on residual value, is the depreciation component. It allocates the capital, and then that capital is retired over time. And in fact, I think in one of the models, it's even labeled depletion. And I think from an upstream perspective, if you're used to talking about taxes for oil and gas wells, depletion is a depreciation-like concept. So that is how the depreciation is taken into account in the models.
And we won't walk through every one of Mr. Atala's points on that slide, but I wanted to hit a few of the highlights. How do you respond to Mr. Atala's assertion that the cost of service approach uses a rate base and Hess models do not?
So the rate base is really what you're investing. So the rate base is the invested capital, the acquisition capital, and the build-out capital that Mr. Fraley spoke about earlier.
How do you respond to Mr. Atala's critique that, quote, cost of service approach uses income taxes? Hess models do not.
Well, even in the FERC cost of service manual, it talks about the fact that when you're looking at relative comparisons, that a before tax approach is often more convenient, and it's easier to understand and to reach agreement on. So, and that oftentimes they defer to before tax analysis in negotiations, in settlement negotiations with entities. And so whether you report it on an after-tax basis or calculate it on an after-tax basis or do it before, I think as long as you're consistent in your comparisons, you're going to end up in the same place.
And just to kind of get back to the basics, are the Hess models calculated on a before tax or after tax basis?
They're calculated on before tax, and so there's no tax recovery included in the models.
Wouldn't make any sense to include income tax calculations in a before tax model.
No.
And we're going to get into this in more detail, but I want to hit Mr. Atala's final assertion on that slide. Quote, because the IRR in the Hess models is greater than the specified return on capital, and neither the return on capital nor the IRR are related to the cost of capital, the Hess model tariffs are not accurate reflections of actual costs. Just in summary, what is your response to that?
Well, first of all, I think his calculations are flawed, and I think that was discussed some yesterday. We may talk about it a little bit more, but I think that's immaterial. The cost of service model is what is being employed. It's got the attributes of that. It's a cost recovery mechanism over a specified period of time. It's based on the volumes that are going to be produced, the volumes of production. It is cost of service.
And is the return on capital in the model, is it accurately doing calculations that earn the stated return on capital over the actual input costs?
Yes, I think Mr. Fraley talked about that this morning.
Okay. So, kind of moving on from our comparison to WAC rates that you sourced from FERC filings, I want to move on now to slide 27.
Okay.
And I want to talk about Hess's WAC.
Alrighty.
Going back to Mr. Atala's opinion in one of his reports, where he says, quote, a reasonable return for these projects would be the WAC. Do you remember reading that?
Yes.
Did Mr. Atala provide an actual calculation of that WAC?
No.
Assuming for the sake of argument that Hess's WAC would be a valid basis for the rate of return, did you perform that calculation?
Yes.
And it looks like this slide shows year end of 2013. Why that time frame?
The tariff models and the contractual arrangements really kick off 1/1/2014. So the nearest full year of information that would have been available to do the WAC calculation would have been in year end 2013.
And just to be clear, this is a WAC calculation for Hess Corporation, is that right?
That's true.
Why not a WAC calculation for Hess Midstream, year-end 2013?
Hess Midstream was a wholly owned subsidiary of Hess Corporation at that time and did not have a WAC.
So can you walk the commission, well, and before we get into that, so what, would Hess Corporation then, as of year-end 2013, would it have owned integrated upstream and midstream assets?
Yes,
Okay.
it did.
So please walk the commission through the WAC calculation that you did here.
And I will spare you, I promise. We'll just look at this at a very high level. To determine a weighted average cost of capital is a well-adopted financial concept. So you start with determination of the cost of equity, and you can see most of this table on slide 27 is devoted to that cost of equity. And you come down to the after-tax cost of equity at 12.72%, and it's derived from the formula shown beneath it there. As we discussed, we're looking at things on a before-tax basis here, so we convert that after-tax cost of equity to a before-tax cost of equity, again, using the equation right below the entry, assuming a 35% corporate tax rate, which would have been relevant in 2013. And you arrive at a before-tax cost of equity of 19.57%. For the cost of debt, we just went to the bond rating for Hess Corporation at the end of 2013, come up with 5.51%. And then simply to determine the weighted average cost of capital, it's just a weighted average of the capital structure attributed to equity at 81.2%, and the capital structure for debt at 18.8%. So you arrive at a before-tax weighted average cost of capital of 16.92%.
And just, you might have touched on it a bit, but just remind the commission at a basic level what the WACC is at a conceptual level.
At a conceptual level, it's the cost that a corporation pays to acquire or maintain its level of financing, really. It's capital base.
And I think you mentioned earlier that in your view that a WACC for, in terms of looking at the returns on a specific project, that a company would usually be trying to exceed its WACC with a given project?
Right. The theory being, if you're paying a mortgage and you have that payment going out every month and you're going to sublet your house to a renter, you'd like to cover that cost or make a little bit more if you could. They'd like to make enough to at least pay for the capital that they're deploying. And in most cases, you want a portfolio of projects that return a higher value than that, because not all projects come out like you think they're going to. So giving yourself a little bit of a buffer.
Now, you just mentioned that at the time of this WACC calculation, Hess Corporation owned both upstream and midstream assets,
They
right?
did, yes.
And in general terms, are upstream projects generally going to have expect a higher return than midstream projects?
Yes, and that's why many companies sought to do what Hess did ultimately, and that was to have someone else buy into and provide capital for the midstream so they could redeploy capital to drill wells in the upstream.
And the reason that the return for upstream would be higher, would be in part because upstream is in general considered riskier than midstream?
Well, and drilling wells is good business when oil prices are good, yes.
Got it. And the kind of the point I wanted to get to, Ms. Adair, was that obviously this weighted average cost of capital is higher than the 12 and 14% return that we see in the contracts, right?
It is, yes.
Given that the company was an integrated upstream midstream at the time of this WACC, would it surprise you to see midstream projects, a bit below the WACC and upstream projects a bit above the WACC? Or?
Again, looking at that entire portfolio, and I think as Mr. Fraley mentioned this morning, because Hess is going to be paying for services, ultimately long-term, they wanted a high enough rate to attract capital, but they didn't want it to be exorbitant because they knew their wells were going to be burdened with those costs going forward.
So let's turn to slide 28.
Okay.
And I guess what I want to ask is, you had that WACC calculation that you did on slide 27 that shows a before-tax WACC of 16.92%
Yes.
for Hess Corporation year-end 2013, right?
That's true.
Were you able to find any independent corroboration for that WACC calculation of Hess Corporation at the same time frame?
Yes, the Texas Comptroller goes through and calculates the before-tax WACs for different petroleum companies that operate in Texas every year. It's part of their property tax appraisal practice, and they publish these rates.
It looks like this table contains not just a calculation for Hess, but for a number of other companies as well.
Yes, that's true.
Is the Texas Comptroller generally considered to be a reliable source for this type of WAC calculation?
Yes, they are, and the property tax practice and what they're doing here is an annual recurring analysis, and it's consistent with the analysis that we looked at in slide 27. It's a very straightforward, well-known approach for these calculations.
And it looks like the calculation here comes out to a WAC of 16.01 for Hess. Do you see that?
I do.
And is this also a before-tax WAC?
It is.
I guess, so it's slightly lower, but within the, within a percentage of what you calculated?
Yes, they probably looked up their information on a slightly different day than we did. Some of their input variables are slightly different than ours.
I guess, what can you say about Hess's WAC year-end 2013 after comparing your calculation with the Texas Comptroller's calculation?
That it appears to be in the 16 to 17% range, generally.
As of the year-end of 2013?
Correct.
And that would be at the time when the contracts at issue, the Hess Midstream contracts, were entered into?
That's true.
And those are the contracts, again, that contain the return on capital rates that are being disputed here. Is that right?
That's true.
Now, I think you mentioned a moment ago that Hess Corporation at the time, year-end 2013, owned both upstream and midstream assets, right?
They did.
Are there other companies shown in this table who owned integrated upstream and midstream assets at the time these calculations were done?
Yes, I would say quite a number of them did, and I believe there are some of the names on here were on that slide. I think it was maybe 18, where we had the related producer and midstream companies, but Chevron, Conoco, Marathon, Pioneer, a lot of companies.
Those examples you just threw out, just for the record, are those examples of companies that you're aware had integrated upstream and midstream at the time of this year in 2013?
Correct. I don't know if all of it was still wholly owned at this time, but they had those associations.
And what's the average before income tax weighted average cost of capital for all the companies shown in this table?
Down in the bottom right-hand corner, 15.09%.
Now, before we move on from this slide, I want to ask you to respond to a few things that Mr. Atala said yesterday. I don't have slides for him.
Okay.
But the first thing I wanted to ask for a response on was that Deloitte article that he pulled out. Do you remember that?
I do.
And I think it was shown to you at your deposition.
It was.
And had you seen it before your deposition?
No.
And Mr. Atala, Atala pulled it out and pointed to it as an example of a range of weighted average cost of capital for midstream companies. Remember that, his testimony on that. What is your response to that testimony from Mr. Atala on this Deloitte article?
Well, first of all, in reviewing the article, it was unclear to me exactly which entities. I did note that there was a mixed bag of entities, including storage providers. There was some gathering and processing, pipelines. So it wasn't just specific to the types of assets we're talking about here. Secondly, it was in the time period 2015 to 2017. Certainly 2015 was not a stellar year for the industry, given the level of prices. So it's hard to discern a whole lot out of that, really.
Oh, sorry.
No, go ahead.
Do you remember Mr. Atala's testimony to the effect that the WAC shown in that article were after-tax WAC calculations?
Yes, I do.
And I think you've already mentioned this, but fair to say that after-tax WAC calculations would be lower than if you trued up to before tax.
Yes,
And again, Hess's return on capital rates are calculated on a before-tax basis.
that's true. Yes.
Mr. Atala also spoke a little bit about this 9% WAC assumption that shows up in kind of an assumptions sidebar in some of the earlier Hess tariff models. You remember that?
I do remember seeing that in some of the earlier models, yes.
And he includes a table in his report that then purports to calculate recalculate tariffs at that rate. Do you remember that?
I do.
And we'll get into detail in a little bit about the issues with his recalculations of the tariff rates. But what I wanted to ask you at this point was just your response to his suggestion that the commission might use that 9% weighted average cost of capital as a return.
Well, first of all, I agree with him that the cells surrounding that, they're not really used for anything other than to look at that little block. They don't propagate into the rest of the model, and they do appear in an assumptions block. But they also appeared to our team to be after tax numbers, and that perhaps they were being used at some point when there might have been an analysis of some after-tax considerations. But largely, I don't think they have anything to do with the model.
Got it. And I think this is stated in your report, but true to say that if you converted that 9%, let me back up. The 9% assumption that was listed in some of those earlier tariff models, was that a before tax or after tax?
I believe it was after tax.
And as stated in your report, fair to say that 9% after tax WAC, if you converted it to before tax basis, would be 13.8%?
It would be, yes, fall right in the range of the 12 to 14% before tax.
Mr. Atala also cited the commission's prior Mock versus Petro Harvester case for the proposition that perhaps one could simply take the prime rate of interest multiplied by 1.58 as sort of a substitute for weighted average cost of capital or substitute for a reasonable return on equity. You remember that testimony?
I do.
And what's your response to that?
Well, I think there are many ways to look at reasonable rates of return and weighted average cost of capital. I've demonstrated some of those here today, and I feel like an arbitrary multiplier times the prime rate may or may not be adequate to assess what a reasonable rate of return would be on anything.
Did you review the commission's order in the Mock versus Petro Harvester case?
I did, yes.
And what is your response to the kind of the characterization of that case as we heard yesterday, and what happened in terms of the case arriving at that result?
I think that there was none of the kind of information that we've talked about here today was provided in that matter. And so the one thing that was put into the record was this prime rate times a multiplier. And I think the commission didn't have any other information to consider.
In other words, your understanding is that Petro Harvester simply didn't provide backup for the rate it was charging?
Correct.
The only thing
That's the way I read it.
Okay. I mean, it sounds like in your view that the commission was sort of led into a result that you would consider perhaps to be wrong just by the fact that it was the only evidence that it could rely on in that case.
And that it was somewhat arbitrary when we know there's other sources of information that could have been more relevant.
Yeah, simply, the commission may have not had those other sources of information
Absolutely.
available in that case.
Absolutely.
Okay. And when we say other sources of information, we're talking about things like the WAC comparisons and calculations that you just walked through.
Yes.
Based on your experience in the industry, would a return on capital equal to the prime rate of interest multiplied by 1.58, would that have been sufficient to attract capital for midstream infrastructure investment in North Dakota at the time these contracts, these Hess midstream contracts went into effect at the beginning of 2014?
I don't believe so based on the data and information we've reviewed, no.
Let's turn to slide 29, and I just want to touch on this briefly because I think Mr. Fraley covered it already. What are you showing on this? Well, let me back up. Mr. Atala yesterday was rather adamant that the tariff models are applying a return on capital to operating expenses. You remember that testimony?
I do.
Well, and what's your response to that?
The formulaic approach that's utilized in the tariff model calculates a return on all of the components and differences those. So to the extent that there is a return on operating expense, it's negated by the return on tariff revenues. So as a practical matter, there is not a return on operating expenses taking place in the models at all. The tariff revenues exceed the operating expenses, as they should and have to, because they're meant to cover the day-to-day operating expenses and be able to retire and create a return on the capital that's been invested. So that just doesn't happen.
And you looked at the tariff models. Did you look at them to confirm that the offsetting revenues did indeed exceed the operating expenses in all years?
Yes, I did, and I had my team do that as well.
Let's turn to slide 30.
Okay.
And we've heard some testimony about residual value in this case. You were here for that testimony as well.
Yes.
And I guess before we get into Mr. Atala's contentions, I just want to start with to have you explain to the commission the residual value concept that's actually contained in the Hess midstream contracts and the tariff models. Does
Sure.
this slide do that?
It's a good graphic to start with, because, engineers like graphics. We can talk better from a picture. Basically, the contract has two terms, an initial term and a secondary term. The cost of service model prevails in the initial term. And in order to recognize the fact that the capital costs will have a longer life than just during the cost of service, those capital costs are allocated based on volumes between the volumes that are in the model to be produced in the initial term and the volumes to be produced in the secondary term. It's a pure ratio. Secondary term volumes over the sum of both times the capital cost gives you the residual value. And then the capital cost that is allocated to the initial term is returned over the period of the initial term based on the volumes that are produced in that time period.
I think you might have mentioned this earlier, but is this similar to a depreciation calculation?
It is. It's allowing depreciation of a certain portion of the capital cost over the initial term, with remainder of capital going to the secondary term of the model.
On a units of production basis?
On a units of production basis.
What is the effect in terms of the per volume rates on the initial term tariff rates of allocating part of the capital spend to the secondary term?
It lowers the rates in the initial term, and what it really does is it spreads those capital costs out over all the volumes that are going to flow through the capital costs
over this 20-year.
over the 20-year period.
Mr. Attala, I referred to the residual value calculation several times. I think I heard, if I wrote it down correctly, as a plug number that it was being used to back into the contractual return on capital. You recall that testimony?
I do.
What's your response to that?
The residual value is determined really on a separate basis, as it's described here. And so it's not a plug number, it's just calculated based on the inputs to the model.
Let's turn now to slide 31.
Okay?
And I'm gonna, I want to talk to you now about Mr. Attala's alternative residual value definition. I'll read from his report. He says it was, quote, calculated using the net present value of Hess's forecasted future cash flows through the secondary term. That's from his second supplemental report.
Okay.
What is your response to Mr. Attala's redefinition of residual value?
Well, first of all, that he is not following the construct of the cost of service model. He is now inserting net present value or an actual valuation type process into the cost of service model, and that's really not what it's set up to do. A cost of service model returns capital over volume in a defined time period, and that's what the first 10 years of the tariff models are set up to do. So conceptually, it just doesn't fit. It's not the way the models work. It's not the way cost of service works. So I think that's probably the primary thing, is it violates the construct. Then secondly, it's not aligned with the terms and conditions of the contract. So if you're going to go in and start changing terms and conditions in the contract, you have to consider, well, what else might change if you start saying we're going to do this differently. I'm not sure it would be as simple as just plugging and playing one term for another. You need to see how that affects the entire construct, theoretically, of what the model's trying to do.
And is it right to say that the supposed quote-unquote actual returns that are shown in Mr. Attala's Table 5 to a second supplemental report are those returns that he's calculating using his alternative formula for residual value?
Because, no, they're not valid, because he's plugged in a different concept into the cost of service.
Right, and we'll get to whether they're valid, but the initial question is just those, I wanted to establish that his quote-unquote actual return is using that alternative concept
Oh, I'm sorry.
of residual value. Is that your understanding?
That is my understanding.
Okay, and is that valid?
No.
Why not?
Well, because it's now moved around and created a new definition, and it's not, the model's not working like it's supposed to.
Yeah, and for the same reasons that you just discussed, why is redefinition of residual values incorrect?
Yes.
Okay. Now, Mr. Attala, talked a lot about the fact that there are net present value equations in the tariff model, and if I heard correctly, seems to infer that means that the tariff model is somehow attempting to do a discounted cash flow valuation. You remember that testimony?
I do.
Do you agree with his interpretation?
No.
What's the purpose of the net present value calculations that are in the tariff model?
So, having built a lot of models to value things and looked at cost of service models and looked over models others have built, there are many different modeling ways to approach the same problem, and to program, if you will, Excel to calculate values under a given construct. And in this particular situation, I would agree with Mr. Atala. It's actually a very unique approach to modeling where all the cash flows, all the variables, everything that goes into the model is moved to the same point in time from a valuation concept. So it's all moved to the same point in time where you're able to calculate the tariff with one numerator denominator set of calculations. There are other ways to model this where you would have to use an iterative approach, a goal-seek function, but the way this particular model is set up, that's not necessary. So I think it's just a confusion about conceptually how the model works, and it's different than someone else may have modeled it.
Got it. And when you're talking about the future values, there's forecasted values in the model, correct?
Right, but it's a little bit different than that forecasting for modeling purposes. It's simply moving everything to the same point in time, which allows you to make one calculation for the actual current year tariff, rather than having to do an iterative approach and solving for it another way.
And then that's what I was
It's just a
getting
different
to.
way.
It's bringing all the different year inputs down to one time.
Correct, yes. yes.
Not attempting to do a discounted cash flow
No.
valuation of the assets.
No.
Okay. Now, we've kind of talked about Mr. Atala's alternative definition for residual value. We talked about his table 5 and the returns calculated in that table are invalid. Mr. Atala then goes on and shows revised tariff rates in his tables 6 and 7 of his second supplement. You remember that?
I do.
And did Mr. Atala also use that alternative definition of residual value in calculating those new rates?
That's my understanding, yes.
And I assume suffice to say that you disagree with, disagree with the rates, or with his use of the alternative residual value concept in table 6 and 7 for the same reason as you would disagree with it for all the reasons we just discussed.
Yes, that's true.
What I wanted to get to, though, was, even if we were going to accept for the sake of argument Mr. Atala's flawed residual value definition, does he, are there any other problems with how he's recalculating the tariff rates in table 6 and 7?
Yes, and I think Mr. Naresh talked to him about that yesterday. But because the model is retiring capital in every year, the prior year results are important, and all prior year results are important as the model calculates forward in time. And what Mr. Atala did was he used a goal-seek function to restate the tariff value in every year, but he failed to flow through his new tariff rates year over year over year. What that meant was because he was calculating a lower tariff, his tariff revenue in the subsequent year would have been lower. So the credit, the amount of capital he would have retired in that year would have been lower had he accurately represented that lower tariff rate in the next year's calculation. But instead, he left the Hess tariff model rates in there, which were at a higher rate, and were therefore retiring capital at a quicker pace than his new lower tariffs would have been able to do. So the net result of that was he calculated tariffs that were artificially low because he was taking a credit for the tariffs that Hess model calculates, which were higher than his. Hess model retired the capital faster than his would have, and had he snaked through those values over time, his rates would have been closer to the Hess rates over time.
And you heard Mr. Atala's testimony essentially acknowledging that tables 6 and 7 for that reason, couldn't be used as a damages model. You remember that?
That's true. Yes, I did hear him
And
say
I
that.
assume that you agree with his concession on that point.
Yes, for sure.
Let's turn now to slide 32. I want to shift gears a bit. Mr. Atala, in his reports and then in his testimony, yesterday, talked a bit about some comparisons he did between Hess's costs for gas flowing through the Tioga gas plant versus information that he had on gas flowing through Robinson Lake and Palermo. Do you remember that testimony? And did you review those comparisons in his reports?
I did, yes.
And what is your assessment of Mr. Atala's comparison between the TGP costs versus costs for the gas sent to Robinson Lake and Palermo?
Well, one of the things you've heard a lot about today is the priority of service, and so right off the bat, Robinson Lake's service is interruptible. Palermo's, I've not seen a contract, but I believe others have talked about it being interruptible. And whereas the Hess-operated properties have priority firm service at TGP, so those are always going to be the first volumes on the system. The processing technology, Palermo is a conditioning plant. It's dropping out only the heaviest liquefiable hydrocarbons, and the gas there is going on to Alliance to go to Chicago to be processed for real liquefiable hydrocarbon recovery. Robinson Lake is propane refrigeration. Again, it's taking some of the liquids, but it's not taking deep cuts of propane and ethane. So it's producing a residue natural gas stream that's not going to be able to flow into any natural gas pipeline. And in fact, we heard it goes to Tioga or other places to be reprocessed. And you're comparing that to TGP that can strip a lot of the ethane and the heavier hydrocarbons and create a very dry residue natural gas stream that can flow pretty much to any pipeline in the country, and actually probably allows some of the residue from facilities that have lesser technologies to be able to flow on northern border, to be honest. And then the fractionation component, and I think Mr. Fraley covered that and talked about having that ability to go to pipe, to go to fractionation, to get on rail cars and go anywhere in the country, to be seeking out those higher prices and have that flow surety that the products are going to actually be able to get out of the basin. Those are the big things, I think, that highlight the differences.
Now, if I recall correctly, Mr. Atala, made the point, something to the effect that, well, if I'm the working interest owner, all I care is, what price I'm getting. I don't care what happens to the gas, downstream of the plant, or those different distinctions. So let me ask you, why these distinctions that you just brought up, why do they matter for purpose of this cost comparison?
They matter because of flow assurance, limited curtailment, and the ability to comply with regulatory components, whether it's VOC emissions or the new Quad O. All of those things are things that can prevent you from being able to operate your wells and produce oil.
Fair to say that you need to look at a broader picture than just a netback price in a given month from a given plant in order to figure out the value that an operator and working interest owners are deriving from a given midstream arrangement.
Yes, and that's consistent with my experience doing reservoir evaluations and looking at properties and potential alternatives for producers throughout my career.
Now, in the course of doing your review, were you able to also assess some of the practical effect of SOGC's reliance on interruptible third-party service and how that affects the results that Hess Bakken is seeing from Hess Midstream?
Yes.
Let's turn to slide 33.
Okay.
Show me what this, or tell me what this slide shows.
This is public data, NDIC public data for producing wells, and at the very top there, the top 8 wells are the subject wells that we're here talking about this week. And you can see those Hess-operated wells had a time between initial production and first gas sales of a month or less. And the wells that are listed at the bottom of the page are from that, if you look up on the chart over there, the Sinclair State well pad is the one well pad I visited or drove by when we were in North Dakota. And you can see there the time from first production to first gas sales varies quite a bit, and the Sinclair State 536H is still not connected after more than 45 months of production.
And this was based on zero gas sales through April 30th, 2023?
That's true. That was the latest NDIC data that was available.
If I recall correctly, Mr. Macbeth testified that there may have been a line built out that connected just in the last week or so. Do you remember that testimony?
I don't think I heard him say
Okay,
that, but
well, the record
if that's what he
stands.
said, sure, yeah.
Let's go to the next slide. Aside from the time from first production to first gas sales data that we just looked at, well, and let me back up. That data we just looked at, that was just comparing one Hess pad to one Sinclair pad, or one Hess spacing unit to another Hess spacing unit, right?
Well, there's two, I think the brood well is in there too, but yes, it's the subject wells to those Sinclair wells, and I think there are 3 pads for those Sinclair State wells.
Got it.
They're
Okay.
right there together, but yeah.
Got it. Aside from that side-by-side comparison that we just did of a handful of wells, did you also review any company-wide or state of North Dakota-wide flaring data for Hess and SOGC?
Yes.
And is
I
that
think-
shown on the slide here?
Yes, I think Mr. Gatling may have used this data or something like it, but yes, this is just NDIC data for company-wide flaring percentages over time.
And what can you say about the trend for Hess versus Sinclair, looking at the data on this slide?
Sinclair's data is up and down, but fairly constant, around 45-50%. The Hess numbers have been coming down over time, and got that continual trend towards zero, which there is a corporate goal.
And I should have mentioned the other thing on this slide. There's a little photograph here. What is that photograph?
That is one of the Sinclair State pads, well pads that we visited during our site visit.
Does the comparative data that we are looking at on this slide 34, does that in any way support your conclusions in the case, your expert opinion in the case?
Well, I think maybe even more so 33, because I believe the contract that we looked at for Robinson Lake and maybe was discussed earlier, the POP contract, the interruptible service, those things went with these wells here, and you can just see the difference in that interruptible service and what the Hess midstream alignment with upstream is able to do.
All right, I want to shift gears now and move on to producing overhead.
Okay.
So you kind of summarized this at the beginning. You mentioned you were going to have an opinion on this, but you're aware that the applicants have challenged Hess's producing overhead charge, right?
Yes, I understand that.
And can you just, again, give us a summary of your opinion that you're going to walk through in terms of producing overhead?
Yes, that Hess recognized through their own internal review that their producing overhead rates were not recovering their actual costs, and then undertook a fairly extensive internal study to determine what those costs should be, what their actual costs were, and then they made an adjustment to that base rate so that they could begin actually recovering what they were spending on overhead for their operations in North Dakota.
And Mr. Garakumar kind of went over the background here, but you generally, do you agree with his description of producing overhead, conceptually in terms of what it is and what it captures?
Correct. It's indirect costs associated with the operation of the wells in North Dakota.
And just to refresh, what type of statement does Hess use to charge working interest owners for producing overhead?
It's part of the JIB.
And how does the producing overhead information on Hess's JIBs, well, what does it look like? Is it just a line item, or what?
Yes, it would be a line item entry on the JIB.
I think we saw an example in Mr. Garakumar's testimony.
We did,
Okay.
yes.
What I wanted to ask you on that is, does the way in which Hess shows producing overhead on its JIBs, in your experience, is that consistent with how other operators charge producing overhead and show the detail on their JIBs?
That it's a single line item,
Correct.
yes, that's what I'm used to seeing.
And Mr. Garakumar described in some detail how Hess recalculated its producing overhead rate that it implemented in 2017. You heard that testimony, right?
Right, yes.
And in the course of your assignment, did you review the calculation that he walked us through?
Yes, we
That's shown on
actually,
slide 36.
yes, on slide 36, we actually had the opportunity on several occasions to speak with people who worked in his group and talk with them about how they made the allocation, the types of data they were looking at, the types of other input in terms of looking at how to do allocations and how to figure out how much of the time and resources from any particular area were going to certain of the activities, which you see in step 2. And all that was very consistent with where we thought those costs should be going, and the reasons why they were doing the allocations made sense the way Hess is organized. And after having been there and toured the operations and looked at everything, understanding how the organization is set up and how the properties are operated.
Yeah, at the end of the day, after that investigation, did you conclude that Hess used a reasonable methodology in calculating its 2017 producing overhead rate?
Yes, that they did a very rigorous analysis of the costs and how they should be allocated to the producing properties.
Turning to slide 37, did you review Mr. Attala's opinions concerning Hess's producing overhead charges?
I did, yes.
And, Mr. Attala points out that Hess and its methodology, failed to engage in negotiations that are envisioned by COPUS in several different respects.
Sure.
What's your reaction to that critique?
I don't think that's typically the practice in North Dakota, based on everything that I've learned and understand and have reviewed, where wells don't have JOAs.
Just to kind of make sure we have it clear, is it your understanding that operators generally negotiate negotiate with working interest owners on the producing overhead rate in the absence of a JOA?
No.
And Mr. Attala, as part of his part of his critique, seems to say that Hess shouldn't have recalculated the producing overhead rate after the wells began producing. You remember that testimony?
I do.
And what's your response to that?
Well, based on everything that I have reviewed, including COPUS standards, and just from a practical perspective, the operator has the right to and seeks to recuperate its actual costs. And that's what Hess was doing here. They identified through an internal review that they were not recouping their overhead costs, and they sought to recalculate those in a reasonable way. And once they did that, they applied those rates to every well. And that's the only way you get your actual costs back. So it seems reasonable and makes sense to me that they applied that methodology.
And to your, just to be clear, to your knowledge, was there any contracted for standard applicable to the subject wells that you're aware of that would have prohibited Hess from recalculating its overhead rate once the wells began producing?
No.
I want to turn now to slide 38.
Okay.
We heard Mr. Atala testify some about his comparison of Hess's overhead rates to other producers. Do you remember that testimony?
I do.
And, Mr. Atala included a table in one of his supplemental reports, Table 8, that compares Hess to several different operators. Did you review that table?
I did.
After reviewing that table in Mr. Atala's report, did you review any additional data to kind of take a deeper dive into what Mr. Atala was setting forth in that table?
Yes, just reviewing his data in Table 8, it was clear that the preponderance of those wells were operated by Continental. And in addition, out of the 8 Continental wells that were shown, only one had a JOA. So given that 8 of 18 were Continental wells, only one had a JOA, we just went back to Hess and asked, what are your Continental co-owner rates, your overhead rates you're being charged on wells you're in with Continental? And so Hess provided to us the data that's summarized on slide 38.
Got it. And just to be clear, I think you mentioned 8 of the 18 comparisons were Continental wells. I assume that was by far the most comparisons to any
Yes.
single operator in that
To
table?
any single operator, and then there were obviously other operators that had more than one well, but many of those had JOAs.
Okay.
So we were looking for non-JOA. And the Continental appeared to have the bulk of its wells without JOAs.
So what does the table on slide 38 show?
This is just a sorting by value of the 165 Continental rates for different wells that came from Hess. So this would be rates charged to Hess by Continental for wells that Continental operates.
And where does, I mean, just to be clear, did you have in that data set, did the data set say which Continental wells had JOAs and didn't have JOAs?
Did not, no.
But I think you mentioned this before, it sounds like 7 of the 8 in the Atala table were lacking JOAs.
Right.
Is it your understanding majority of wells in the Bakken generally lack JOAs?
That's my understanding. The horizontal wells, the older wells tend to have JOAs.
So how does Hess's producing overhead rate line up with the distribution shown for Continental in this table?
Well, this is May of 2017, and if we want to look back at slide 36, you can see in May of 2017, the producing rate was $2,021. And so it would fall in the upper portion of the distribution. But from 2,000 to 2,200, there's 71 of 165 wells that fall into that. And the little call-out box, there are 53% or 88 of the wells greater than 1,800 in the sample we got from Continental. And it's interesting that it seems to be kind of bimodal, that there's a big group, again, are in the $1,200 to $1,300 range. So,
Given that comparison that you just walked through, do you believe that the Continental data set you reviewed supports your conclusion that the Hess producing overhead charge in this case is reasonable?
it's certainly in line with that of one of the larger operators in the Bakken.
I don't know that everybody needs to turn to it, but I'm just going to have you flip to Hess Exhibit 63 quickly.
Okay.
And the question, once you get there, is simply is whether this document contains the data set that you just discussed in terms of the continental wells in which Hess owns an interest.
Yes, I think, yes, we verified that. This is it.
And I'll move to admit Hess Exhibit 63.
No objection.
Exhibit is
actually-
received.
Thank you. While I'm doing that, let me have you, I think I might have missed it earlier. Why don't you flip to Hess Exhibit 75 as well? And my question there is just whether that exhibit contains a true and accurate copy of the Texas Comptroller publication from which we took the WAC data that we discussed earlier.
It does on page 2, yes.
And I'll offer Hess 75.
No objection.
Exhibit is received.
All right. So with that, I think I'll have you turn to slide 39, which is just your conclusion slide. And so I just want you to kind of sum up your opinions at the end here. The first thing I want to ask you, because we got a question or two from the commission yesterday, is I wanted to be clear, do you believe that the disputed gas gathering and processing charges that are at issue in this case, the post-production costs, are costs for the operation of the subject wells?
Yes, because here in North Dakota, those services provide the flow assurance to allow the operators to produce with minimal flaring.
And are those costs incurred at the well by Hess Bakken as operator of the subject wells?
They are. The costs come back to the sales meters that Mr. Fraley was talking about this morning.
And in your opinion, are those costs necessary for the wells to continue operating?
Yes.
And I think you kind of detailed it in the Vitesse hearing last month. The transcript for which is now in the record would be accurate to say that your opinion in that respect would be would line up with the opinions that you expressed in the Vitesse case.
There's nothing different. That's true. They would.
In terms of the jurisdictional question.
Correct.
I want to move on now and sum up regarding your opinions on the merits about whether the disputed gas gathering and processing charges at issue in this case are actual and reasonable. Are they actual and reasonable?
Yes, and they are the costs that are necessary to provide that flow assurance we've been talking about, minimize flaring and curtailment of oil production.
Do you believe that they constitute, or that the tariff charges that have occurred to date represent actual costs spread out over the volumes with a reasonable rate of return?
Yes.
And for all the reasons you discussed, do you believe that that 12 to 14% return on capital charged in the Hess tariffs is reasonable?
I do.
And again, do you believe that the midstream services that they provide are necessary to operate the subject wells in a responsible manner and minimize flaring?
Yes.
Which results in flow assurance?
Yes, gas capture and flow assurance.
And then finally, I just want to have you sum up, we just covered it, but your opinion on the disputed overhead charge. Do you believe that charge calculated by Hess in 2017 and then carried forward as reasonable?
Yes, actual and reasonable costs and a reasonable methodology for determining those costs and implementing them going forward.
And do you believe that they are in range with at least one of the other largest operators in the Bakken in terms of what they charge for producing overhead on a number of their wells?
Yes, as we just discussed.
Best witness.
Again, we've been going for a couple hours now. Do we take a 5-minute break, please? Or,
That'd be great. Great.
we'll go off the record. All right, we'll go back on the record. It's 3:19, and I'll just remind you, Amanda, that you're still under oath.
Understood.
Good,
Hello.
Paul, thank you, sorry. Good afternoon, Ms. Adair, how are you?
I'm good. How are you?
I'm good. So this is the third time that you and I have done this, right?
Yes.
So I suspect that we're going to agree on a lot of things. And I can't remember who examined Mr. Antella, but asked some questions about his compensation, and you're being paid $600 an hour for your testimony
Yes.
and work on this?
Yes.
And I think you told me in Dallas that 80% of your work is in dispute resolution.
Well, that's
right?
probably true right now, yeah.
And over the course of 3 days, we've heard a lot about terms like minimum volume commitments and weighted average cost of capital. I feel like if I hear the words flow assurance one more time, I'm gonna run screaming out of the room, but.
You need to curtail that?
Yes, yes. But at the end of the day, this case is really about the amount of the deductions on the revenue statements that my clients have got, right?
That is the focus.
And you've looked at those revenue statements,
I have.
and I'm gonna hand you the last page of a revenue statement that Missouri River got in 2020.
Okay.
And what is the value of the products on there?
No, wait.
It says-
$17, I think is what it says.
Just for the record, is this the page she's looking at?
No, it's 1524, 1524.
It is, yes.
I might not have a full copy.
And I'm talking total, the total at the bottom.
On the, but,
The
oh,
gross-
not
gross-
total plant products, total property? Sorry.
Sorry to interrupt, but we're talking about, we should identify the exhibit, and it's A26, the last page, right?
Yes,
Yeah,
it's the last page of 826.
Okay, thank you.
yes. So I think. we-
I was referring to the numbers starting from the left on the very bottom.
The check total?
Yeah.
Okay, I see the gross at 470,521.66.
And how much are the deducts?
$456,182.30.
So what's the net?
$12,665.39, and this is for March and April of 2020, so right as COVID hit, when prices were plunging.
So as a working interest owner, if you saw that amount of deducts as opposed to that amount of gross value, would that concern you?
I don't know that I could look at it in isolation on one check stub and conclude that.
You may just take it in stride?
No, I'd probably look at many check stubs.
Okay. I'm going to start off talking a little bit about Hess's structure. And I think we're going to agree on a lot of this.
Okay?
You would agree that Hibic, HTC, and Hessam are all taking direction from Hess Corp, right?
I think the way it's been described and what I've observed is there's operational control of Hessam, and of course, Hibic and HTC are wholly owned by Hess Corporation.
So operational control, taking direction, pretty much the same thing, right?
Well, I think it depends on what you're talking about, but day-to-day operation of equipment and getting volumes through the system and to market, I think that's what I think about when I think of operational control. Financial controls, I think Mr. Fraley talked about that some, and maybe Mr. Gatling too. That's a different
And you can
animal.
tell that you and I have done this 3 times, because my very next question is, Hess controls the day-to-day direction and operation of Hessam's assets, right?
Yeah, they do,
Okay.
yeah.
And we talked about the Global Infrastructure Partners transaction, where Hess Corp sold a share of Hessam to GIP and got $2.7 billion, right?
We have talked about that, yes.
And if you look at their public filings, Hess Corp realized a gain of over $700 million on that transaction.
Yes, I think Mr. Gatling talked about that.
Okay, and you'd agree with me that long-term contracts are an important part of valuing a midstream asset?
They sure can be, yes.
And prior to Global Infrastructure Partners acquiring that partial interest in Hessam, Hessam had been wholly owned by Hess.
Yes, we talked about that a few minutes ago, yes.
Sure.
for
And the
sure.
contracts at issue here were entered into before that sale to GIP, right?
That is true.
See, so far so good. There's no reason, or you can't think of a reason, why a Global Infrastructure Partners director on the Hessam board would oppose something that makes more money for Hessam at the expense of HTC or HIPIC, right?
I guess I don't know what they would approve one way or the other. I'd be speculating. I would think they would try to make decisions that were in the best interest of the shareholders of Hessam. I mean, I
And
think
most
that's,
shareholders of publicly traded entities want to make more money, right?
well, one would think so, as long as the long-term value is there.
Okay, and just taking one step back, the working interest owners in these wells, like my clients, didn't receive any proceeds from GIP's purchase of its stake in Hessam, right?
No, because they didn't own any of the assets.
They didn't own it.
Yeah.
Okay. And you'd agree with me, and we're gonna get into this in a minute, Hessam's return on the gathering and processing agreements is guaranteed by an annual fee recalculation, which is designed to achieve IRRs of 12 and 14%.
The return on capital rates are 12 and 13 in the cost of service initial term of the contract. Yes, not the entire 20-year term, but the initial term.
And we all know that these wells aren't governed by a JOA, because if they were, we wouldn't be sitting here, right?
Well, I don't know one way or the other, but they do not have a JOA.
And you would agree with me that most JOAs provide that charges by affiliates cannot exceed prevailing rates in the area, right?
I think that that's language that is sometimes in those JOAs, yes.
Very, very common language.
Sometimes, sure.
Okay. I want to switch gears to overhead. You'd agree with me that a non-operator should know what it's getting for its overhead dollars, right?
Well, I think they should, just by virtue of the fact that they know what goes into operating a well, if that's what you're asking. I'm not sure really what you're asking there.
I think we agree on it. I mean, a non-operator should know what overhead is attributable to, right? Shouldn't be a mystery.
One would think they should know, like they intuitively should know if they're investing in wells, what it takes to operate a well, I guess is where I'm coming from.
All right. And you'd agree with me that an operator shouldn't be able to profit on its overhead charges?
I think pretty much, my understanding of the custom in the industry is operators seek to recover what they spend, what their costs are in operating the wells. That's my experience.
And you'd agree with me that Hess did not notify the applicants or other working interest owners in these wells before recalculating its overhead rates in 2017?
I don't know who they notified before they did it.
If they did, you haven't seen any documentation of that?
I would defer to Rom.
Sure.
No.
And you've not reviewed any of the details that led to that overhead recalculation in 2017, right?
Well, I have interviewed the folks at Hess who did the evaluation that led to the recalculation. So if that counts, yeah, if
Let me
that's
ask
what
you.
you're thinking.
It's not what I'm thinking.
Okay.
Other than talking to Hess folks, did you do anything to confirm the details that led to those recalculations in 2017?
Just understood the process they were going through to evaluate their costs. That the question came up, are we recovering our costs, and how they went through that preliminary exercise, which led to the more detailed exercise. That's all I know about it.
So they told you what you did, what they did, but you didn't go back and check their work.
Did not check their work.
And I think we all agree that that overhead increase in 2017 vastly exceeded the recommended COPUS escalation factor, right?
If they would have applied the COPUS escalation factor, they would not have gotten the $2,000. That's true.
And prior to the recalculation, they had followed the COPUS escalation factors, right?
Well, off of a different rate base, yes.
Sure. And while we're on the topic of COPUS, you're not a member of COPUS.
No, people who work for me belong to COPUS, but I do not.
All right. And how long have you been in the industry?
A very long time.
Okay.
Do I have to answer that question?
I like
more
your
than
answer.
more than 35 years.
I like your answer. For the very long time that you've been in the industry,
Yeah.
you've never seen another instance where an operator escalated overhead charges pursuant to COPUS escalation factors, then calculated actuals, then went back to COPUS escalation. You haven't seen that before other than this case, right?
And no, I've not observed that.
And you're not aware of any operator in the Bakken with higher charges than Hess for producing overhead?
only the only other rates that I've looked at from an operator that's similarly sized, who I know didn't have JOAs, was Continental. So to the extent that any one of those Continental rates might have been higher, I know they're close to the same.
There's a couple that are close, right?
Yeah, within $15 or $20 is my recollection.
If you could look at your slide 38, please.
Sure. Okay.
So in the little box on the right, it says 165 producing overhead rates for May 27 from Continental, 53% or 88 exceeded $1,800. Did I read that correctly?
You did?
Okay. So that would tell us by simple math that 47% were lower than $1,800, right?
Yeah, that's true. The distribution is shown there.
Okay. And you only looked at Continental, correct?
True.
Continental is the only producer, or operator rather, in the Bakken that has overhead rates close to Hess, correct?
I believe I've seen at least one other in some of the data we've looked at this week. But certainly in terms of a whole data set and many numbers, this is the largest set of data for any one operator I've looked at.
All right. And you were here when Mr. Gaura Kumar testified this morning about Hess having non-operating working interests in a number of wells operated by others. Obviously, it's not operating. I think you know what I'm asking.
I know what you're asking. Yes, I did hear him say that they had working interest in wells operated by other operators than Continental, yes.
And did Hess provide you any of the producing overhead information from those other operators?
No, I was simply responding to Mr. Atala. I didn't ask for any others.
You didn't ask and they didn't give.
No, that's true.
And when I'm just looking at your breakdown here, so 73 of these Continental wells are over $2,000 a month, right?
Yes,
But 77 of them are under 1,400, correct?
I think that's probably true.
And we've talked a lot about the absence of a JOA. In the absence of a JOA, you think COPUS doesn't govern, right?
There's no contractual requirement for that, that's true.
Okay, and in those cases, you think it's up to this commission to determine what's actual and reasonable for overhead, right?
I think that would probably be up to the commission to decide.
That would make sense to you.
It would.
I want to talk a little bit about basics of the tariffs, and then I'm going to go into a little more detail on the weeds.
Okay.
You'd agree with me that the linchpin of your analysis on the post-production costs, including the tariff, is that those costs were properly calculated pursuant to the gathering and processing agreements.
And I would say in addition, that they're actual costs and that now we've done, work to, establish that the 12 to 14% rate of return on capital is in line with other rates of return for, or cost of capital type numbers, return type numbers for other similar assets.
Okay, let me break that down a little bit. You'd agree with me that when I deposed you the first time that the linchpin of your analysis was that the costs were properly calculated pursuant to the gathering and processing agreements, right?
Well, that was one thing, yes.
Okay, so maybe the linchpin's gotten a little bit bigger since then, so let's talk about the second thing you said, which is, I can't remember the second thing you said. It was before the average cost of capital. What did you say?
Well, one of the things I know that.
Oh, that they were actual. I remember. I apologize.
That they were actual, and I think also that, by that time, I think we had actually made the site visits and inspected all the systems and equipment and so forth.
Yeah, and I remember the question I wanted to ask about actual. When you say they're actual, what you mean is that HESM actually charges HTC for the amount set forth in the tariff models.
Well, and further that actual, the costs are money that was actually spent to build things and buy things and pay for things and pay people's salaries and that sort of thing.
And then that money's repaid through a tariff model calculated in the agreements.
Some of it's through a tariff model, some of it's through direct charges, some of it's through fixed fees, but yes, they're charged back through, to those, delivery meters on every well pad.
And the applicants had no input on the negotiation of the gathering and processing agreements, correct?
Not to my knowledge.
They weren't in the one room where that happened, right?
No, but nor would I say that's unusual in my experience.
And you're unaware of any discussions between Hess and applicants regarding how the tariff rates would be calculated?
Not that I'm aware of. I mean, that's probably a better question for somebody at Hess, but not that I'm aware of, no.
Sure. And you made no effort to compare how these gathering and processing agreements perform in comparison to other similar contracts in the Bakken over the past 8 years?
Did not do a comparative analysis of other facilities, primarily because the assets that Hess operates are pretty unique.
Flow assurance?
Flow assurance, the scope of the operation, the focus on the reduction in emissions and more electrical equipment, all those kinds of things.
Sure. And you didn't compare Hess's post-production costs to any other operators in the Bakken?
Just reviewed Mr. Atala's.
Okay. And we talked at your deposition, and I discussed it with Mr. Gatling, his fireside chat, do you remember that?
I do.
And you'd agree that these contracts provide built-in stability and growth for Hessam?
Well, I think, as Mr. Fraley and probably Mr. Gatling discussed as well, there's a dedication, so you definitely have that assurance that the gas is coming that direction. You have MVCs for some, I guess, the initial period. And you're backed on those MVCs by Hess Corporation, so I think all those things would probably result in stability.
And growth?
To the extent that there's still drilling, there's, continued development, yes.
Now, in his fireside chat article, or the fireside chat article, the contract structure was described as one of a kind. And in your testimony earlier today, I think you described it as nothing unique. So I'm curious, do you think the gas gathering and processing agreements here are unique or one of a kind?
I think that
Or not unique?
the
Sorry.
assets are, in this, well, first let me say, almost every gathering system and processing facility is unique because they're designed to flange up, work together, and pressures, temperatures, material selections, the types of equipment that's included, those things are very system specific, so I think they're unique in that respect. And also to the extent that you have such a large dedication of 70 years worth of drilling locations, I think Mr. Gatling said, I'd consider that to be pretty unique. Now, the terms and conditions of the contracts, using a cost of service model, having MDCs, fixed fee components, a lot of those types of things are things you see in many different gathering and processing agreements.
Okay. So let's talk a little bit about the terms. The contracts are designed, in your words, to achieve a certain return on capital deployed.
Return on capital, yes. Mm-hmm.
Okay. And at sort of a side note, I'm guessing the answer is no, but have you done any work to tie out the returns from the tariff rates to Hessam's 2022 EBITDA of just under $1 billion?
I don't believe we've looked at any 22 data. I think we don't have anything after 2021.
Okay. In your first deposition, we talked about an article you wrote in 2004,
Yes,
which was a long time ago.
I still remember.
It was a good article. And in that article, you said that contract negotiations are key in gas processing agreements. Do you remember that?
Yes,
And here, my clients weren't part of any such negotiations, right?
true, but again, not unusual in my experience. It's usually the operator's responsibility if the operator is marketing and moving products from the lease.
And in your first deposition, you and I agreed that an actual cost can be unreasonable.
It's possible, sure.
Okay. And we agreed that the tariff rates here have never gone down.
That's true because the capital spend continues.
And in your first deposition, you told me that you had done no work to validate rather, validity, to validate the accuracy of the capital expenses that went into the tariff model. Is that right?
The only thing that we did to validate was to talk with the Hess manager who was responsible for the drop down. So when they formed HESM and they went through an exercise to gather those assets and to move them, we discussed how they did that, how the capital values were transferred, and really that whole process. And from that point forward, then it's been, the capital that's been added has been based on acquisitions or things that have actually been built, like the debottlenecking plant, for example.
So it sounds to me your answer to this is a little bit like your answer to the recalculation of overhead. You talked to Hess to learn what they did, but you didn't go back and check their work.
We did not audit their work, no.
All right. And I understand that you don't believe HESM has overbuilt its infrastructure in the Bakken, correct?
That's true.
But in your first deposition, you agreed with me that if HESM had overbuilt the infrastructure systems, those excess capital expenditures would act to increase the tariffs.
Well, it could, if capital was added without commensurate either sustainability or increase in volumes, it could, just mathematically.
Sure. You talked a little bit about the services, or maybe more than a little bit, at Tioga compared to Robinson Lake and Palermo. And it's true, isn't it, that you've made no effort to quantify, put a number on the economic benefits to my clients from the services at Tioga compared to Palermo or Robinson Lake?
That's true. It would involve looking at data similar to, as a starting place, the Sinclair data we looked at in terms of curtailment of production, what effect that has.
Right, and you acknowledge the fees, the processing fees at Palermo and Robinson Lake are lower than those at Tioga. You just think the services are different.
The services are different and the fees are lower. Now, the Robinson Lake contract is from 2008, so that was from a time period before shale and before all the plants in North Dakota were full. So, but it doesn't surprise me that it's lower for that reason.
And I'm going to ask you a question now that's not about the tariff, but I want to ask it before I forget. You're not aware of any authority supporting Hess's decision to attribute costs to working interest owners to prevent royalty owners from going negative on gas settlements?
No, I mean, I've seen that. I've seen other operators do it. I think that's an individual company by company decision is what I've seen.
So let's get a little bit deeper into the weeds in the tariff model. The annual tariff recalculation is to maintain a targeted return on capital, right?
The annual tariff recalculation is to ensure alignment between the development plan and the system plan, which results in a tariff recalculation, I think is the way I would think about it.
Okay, and that maintains a targeted return on capital, right?
That's how the math works, yes.
Right. And in the agreements, open quote, return on capital, close quote, is just a number, right?
Yes, it is a number, and then I think as Mr. Fraley discussed this morning, the G2 exhibit shows how that factors into the overall tariff calculation.
Right. And the number, I think it's 12% for gathering and 14% for processing.
It is.
And you'd agree with me that the way the tariff model works, if you spend capital over forecast, that increases HESM's EBITDA, correct?
I have not looked at that.
Okay. Would you agree with me that under the contracts, gas volumes in excess of dedicated production estimates are not counted for next year's recalculation of the tariff?
I think that's true, and I think that's, Mr. Fraley talked about that being part of the side rails that they negotiated early on.
Okay. So now I'm going to use, despite my earlier comments, one of the terms that we're probably all sick of hearing, residual value.
Okay.
And you can't recall any other situation where residual value is calculated using the same methodology as in these contracts.
I've not used the words residual value in this way. but it's very clear that this is the depreciation term, irrespective of what label you put on it.
I mean, and we can all read what the definition of residual value is in the contracts, right?
Right.
It's just that you haven't seen a residual value defined that way in any other agreement.
I'm not sure that I've ever seen residual value defined in an agreement. Maybe I have.
And on
Not
dir-
that I can recall.
And on direct, I think you talked about having done a lot of valuation modeling, I think was what you said.
Yes.
And typically residual value, it would be more of a terminal value, right?
I tend to think of it as terminal value, the tail of the reserves, if you will, at the end of a forecast.
We talked earlier, I think I talked with Mr. Fraley, about Tioga not being at capacity. Do you remember that?
Yes.
And when we talked the second time, you said that you didn't think it was in anybody's interest to have capacity that's underutilized, right?
True.
Okay. But isn't the tariff model designed in such a way to yield that specified return on capital regardless of how the facilities are utilized?
Well, the utilization is translated into the model in terms of the volumes, I believe. And I guess back to the prior question, when you're building facilities of the size and scope of a debottlenecking plant, for example, that's not something you can do on a short schedule, 6 months or even a year, and especially not in North Dakota. So you have to get those facilities in place so they're there when they're ready for the drill bit to finish. And so that timing is not going to be instantaneous. And I know that the forecast is for that facility to be full in 24 or early 25. So.
My question, I think, maybe was different or simpler. The way the tariff model works, it yields a specified return regardless of how much the facilities are utilized.
Well, it does, but it's not just capital that drives. I mean, you have the volumetric component too. So I think it depends on how those are matched up.
I mean, it's a guaranteed rate of return, right? That's the whole idea.
It is, yes, but the value of the tariff is driven off of more than just the capital and the rate of return. It's also driven off the volumes.
What other aspects of the oil and gas industry have guaranteed rates of return?
Well, a lot of midstream contracts do, beginning in about 2010. And then, of course, we talked about the regulated assets. Those are the ones that come immediately to mind.
Okay. And that's a great segue, because I was going to ask you about the FERC cost of service model.
Okay.
Does the FERC cost of service approach use an NPV?
No, it uses just like here, it spreads capital over volumes in time, defined periods of time.
But the Hess tariff model does use NPV, right?
The Hess model uses an NPV calculation to adjust all of the data and information to a common point in time to calculate the current tariff.
Right. And the FERC cost of service approach does not use residual value, correct?
I don't believe it does, no.
I'm not even going to ask the next question because we all know the answer to it.
Flow assurance?
Not flow assurance. Does the Hess model use a residual value?
Yes.
Okay. Operating expenses. So in the Hess model, the 12 or 14% return is not only on capital, but also on operating expenses, correct?
Not as a practical matter, no.
Okay. And when you say as a practical matter, what you're saying is because the revenues exceed the operating expenses in each year, you don't consider that there's a return on that?
There is not, because the return that is also on the operating expenses wipes it out.
Okay.
So it's wiped out effectively by the difference that occurs after the NPVs.
You'd agree with me, though, that in the tariff model, there's, I think it's maybe 6 cost buckets
There are several.
that funnel down through the process, and then there's an NPV calculation, and so forth and so on, right?
Yes.
And operating expenses is one of the cost buckets, just like historical capital, maintenance capital, correct?
Sure.
All Has Hess done everything correctly in calculating the tariff pursuant to the agreements?
Done everything correctly. The only thing I can think of, I think it's a footnote in one of my reports, that in 2 of the years, instead of inputting the gas volumes, or instead of pointing the Excel model to gas volumes, oil volumes may have been used instead, but because they were used in calculating a ratio, it didn't really matter. And oil volumes are surrogate for gas volumes in the short term. So I think we actually did recalculate that, and it was, would have made the tariffs go up. That's the only thing I can think of.
Right, that's what I was thinking too. So the
Okay.
contract says you're supposed to use gas volumes, and for 2 years, Hess used oil volumes.
And the tariff was lower as a result.
And I think you described that use as being perfectly reasonable, right? Remember that?
Because oil volumes, because of they're following the curves in the short term, didn't make that much difference. I think it was a few pennies.
And because of that, you'd agree with me that something cannot comply with the contracts and still be reasonable, right?
And I think for that particular thing, it was an immaterial difference.
I want to go back to residual value for a minute.
Okay.
The definition you referred to as a plug, or I think Mr. Attella referred to as a plug number.
He did.
And do you disagree with that?
It's not a plug number. It's determined based on the values divided by the volumes, and those values are in a specific period of time. So it's not a plug.
Right. So the current definition of residual value in the agreements results in returns of 12 and 14%, right?
Well, it's
Or at least that's the
use is to define the capital base that will be recovered in the initial 10 years of the contract. So the return calculates after you've defined the capital base.
And when we talked the second time, you agreed with me that the folks at Hess are smart enough to come up with a definition of residual value that could return 100%, correct?
100% of,
100% return, instead of 12 or 14.
so a return on capital of 100%.
Yeah.
I suppose you could make the formula calculate that.
If you could look at your slide 27, please.
Sure.
And also, same question about slide 27 and 28.
Okay,
The WAC there is for Hess Corporation, correct?
that's true.
And you agreed with me, your point is that at the time of these contracts, Hess Midstream was not yet a separate entity, correct?
That's true.
But you agreed with me that if it had been, that Hessam's WAC would be different than Hess Corporation's, correct?
It would be whatever it would be, yes.
Okay, but you don't know what that is.
No, I do not.
All right. And Hess Corp's WAC would be higher because a significant portion of its operations are exploration and production activities, which are inherently riskier, right?
Well, I think if you look at the average on page 28, you see that these companies range from 13 to 16, maybe 18. So there's a range, and I would think that the Hessam assets would probably fall at least within this range. I mean, without knowing exactly what they look like, it's hard to say.
Okay. Let me just ask it again. You think Hess Corp's WAC would be higher than Hessam's WAC because Hess Corp's operations include riskier exploration and production activities?
I think it could be.
Okay. Mr. Forster asked you some questions about that Petro Harvester mock case before the commission.
Sure, I remember.
And when I asked you about the commission's decision at your second deposition, you just told me they got it wrong, right?
That the 1.58 times the prime rate probably wasn't adequate for a company like Petro Harvester. But I understand why it happened. It happened in the absence of other information.
You actually used the words, they got it wrong, right?
Yeah.
Okay.
Yeah, it didn't reflect the weighted average cost of capital. It was an arbitrary assignment of value.
Okay. Could you turn to your slide 24, please?
Sure.
And the purpose of this slide is to show that other gathering and processing contracts have returns similar to the gas gathering and processing agreements here, right?
I would say it a little bit differently. We actually went out and tried to find other gathering and processing contracts. These were all the ones we could find in the public record.
Right.
So it wasn't as if we went out to look for returns that would validate what's in the Hess contracts. We went and looked for any contracts we could find. So just with that caveat.
I understand your distinction, I appreciate it. So in other words, you searched high and low and all you found was these four.
That were in the public record, yes.
But were there some in the private domain that you didn't include, or, I mean, I'm not trying to be a smart aleck, but these are all you could find, right?
These were all that were available in the public record.
Okay.
I have seen hundreds of contracts, but most every one of them is private confidential.
Okay, all right, I understand what you're saying. So let's go through them. Antero, that's a related parties deal, right?
It is, yes.
And the second one, Chesapeake, in that one, you rely on Mr. Posner's opinion?
It's the last Chesapeake that, in the Haynesville, that his report was,
Oh, okay, let's talk about that one then.
okay,
So you were here a month ago testifying opposite to Mr. Posner, right?
I was.
And you're here today relying on Mr. Posner's.
Just saying, here's a contract someone else has looked at. Mr. Posner's experience is in the marketing and midstream. He contracts with companies and moves gas for them and negotiates midstream contracts. So, yeah, I thought that this would be something that, his opinion would be right down his fairway. It seemed to me like his evaluation of this was something he had definitely had the experience to do.
Okay. In contrast to what he did last month?
Well, last month he was opining on upstream matters. I think he's more of a midstream person.
If you could turn to applicants exhibit 69, please.
Thank you for that. Sorry. Is it in there? Yeah, looks like it. Okay, 69.
Yeah, and this is in relation to the Chesapeake Williams gathering and processing agreements in the Eagleford, right?
I see that. Mm-hmm.
Okay, which is the second one on your chart on slide 24. And this
True.
is a document issued by the Railroad Commission of Texas in that dispute, right?
It appears to be, yes.
Okay. And I'm not an expert on this, but I'm guessing the Railroad Commission of Texas is a little bit like this commission with regard to Texas oil and gas matters. Is that fair?
Maybe. I'm not sure they have the same purview, but I'm sure they hear a lot of similar issues.
Okay. In Chesapeake and Williams, were they affiliates?
I believe Williams. I believe the original system might have been something that Chesapeake started, but I believe Williams ended up owning it.
And this decision dealt with a rate of return under something called the Mockingbird Agreement, right?
Yes.
And could you turn to page 36, please?
Okay.
Page 36, first full paragraph. decision reads, in other words, the Mockingbird agreement rate likely included bundled consideration wholly unrelated to gathering service, making Chesapeake's rate a bad benchmark choice. Did I read that correctly?
I'm not sure where you are, but
First full paragraph, second sentence starts, in other words. Are you there?
okay.
Okay. In other words, the Mockingbird agreement rate likely included bundled consideration wholly unrelated to gathering service, making Chesapeake's rate a bad benchmark choice. Did I read that correctly?
I see that's what it says.
The fourth, it's the fourth in the way I'm doing it, but I'm skipping around. On your chart on slide 24, there's a Southland Williams deal there
Yes,
that had a return of 26%.
yes, that's
Okay.
gathering and processing,
Okay.
I believe.
And the company making the payments to realize that 26% return was Southland, right?
It was.
What happened to Southland?
They went bankrupt well after this deal. I think when prices went down, they filed bankruptcy in 2020 like many other gas-laden producers, like Chesapeake.
No further question.
Thank you.
Nothing.
Great, thank you. Any staff questions?
This is.
Lisa, on your slide 36, you're indicating that the recalculation that Hess had on overhead was 2021, correct?
Yes.
And on Hess's previous witness with Rom,
Yes.
this looks like it's identical to his exhibit, or slide 9. And when I asked Ram about this, he admitted that it was recalculated in March of 2017, and I believe he said it was $300 higher. Do you recall that?
I do. Yes.
So why wouldn't you use the recalculated March number of 2,300 in your analysis?
I think we could use the 2,300. I just picked this because it was totaled up here and was the original 2017 rate. That would put it right at the top range.
Well, actually, it would be, if you look at your slide 38, the 2,300 and some would be, maybe 5 out of the 165 would be at that rate, right?
Yeah, and my recollection, and honestly, you should look at Mr. Gower Kamar's testimony, but my recollection was that the $300 change was a makeup, and because I recall the rate going to like 21.37. And I don't have anything else to look at here in front of me to verify that, but that's my recollection. So I think that might have been more than a 1 month makeup, that $300.
And why wouldn't you look at any other overhead rates of other operators in the area?
Mainly because I was replying to Mr. Atala, and I was not tasked with, making a study of all the operators in the basin. So that I was just looking at his data, and I wanted to expand his data with the largest volume of data he had in his data set.
But I believe you indicated that the overhead rates that Hess was charging was reasonable, right?
Actual, and followed a reasonable methodology. Yes, they're recouping with this new rate their actual overhead costs.
Well, when I think of reasonable, I don't think necessarily that the process was only reasonable. I think of reasonable as the amount is reasonable.
Well, and I think I'm just saying the amount is reasonable because it reflects what it really costs them to do business in North Dakota.
But you already admitted the overhead, you didn't do an audit on the individual pieces that go into that
We did not.
calculation.
Yes.
And wouldn't that be how you would determine if it was actually actual costs? Is
Well-
by checking and verifying that they use the right inputs.
So one of the things we did discuss with them was the way that the system captures data and the way that the allocation is done within SAP, which is their accounting system. And Mr. Gaurakumar explained that the controls within SAP are, I mean, it's a little like the AI bot, Chat GPT, don't allow for double counting. And when you're doing allocations, they must be complete. There were a lot of internal checks on the way the system worked that gave us comfort that the charges weren't double counted, that the process they went through was very detailed down to individual employees' work times, but we did not audit. And that's not what we were retained to do. So if somebody wanted to trust but verify, an audit might be a next step.
And have you compared Hess's post-production costs for gas versus other operators right in this area?
Only looking at the contract, the Robinson Lake contract, and then the numbers Mr. Atala provided. We did not have access to any other gas settlement statements or contracts for other.
So do you believe
Throughputs.
Hess's post-production costs are higher per MCF?
I would guess they probably are higher based on the age of their equipment, the capacity they have installed and are handling, the fact that they have made a concerted effort to change out, for example, aging, less efficient gas-driven machines for all electric. All those kinds of things are not cheap.
Okay, well, you really qualified that answer, but you said, I would guess they are, and then you gave a myriad of reasons why you thought it would be. Do you know that they are higher?
No, I do not know,
So you
for
haven't
sure.
done any comparison then?
No, not other than look at Mr. Atala's data.
Okay, from what you've heard in this case, do you believe that Hess's charges are higher?
Well, I know they're higher than Robinson Lake and Palermo, but I know why they're higher.
Okay,
I mean, there's reasons for it.
firm capacity has come up a lot.
Yes.
If you have, just say for instance, that 12 months out of the year when you're selling your gas, it's a negative. And you have firm capacity. So you're selling it, and you're getting a negative every month. And that negative is coming off of your oil sales. Isn't that a type of curtailment on your portion of the oil produced and sold?
Well,
Because you're actually getting a reduced amount of revenue from that oil.
yes, but if the alternative is that I cannot produce the oil, that I am curtailed or shut in because I can't move the gas, and, there have been periods of time when gas processing has been negative and when downstream markets have been negative. The Permian has had a big problem with this where gas values were negative, not including any takeaway. The Waha prices just went negative. Then you have to make the decision in looking at the overall economic situation for individual wells, whether or not you want to continue to produce. And we did this in the Permian in the 90s, where we actually did individual studies to decide which wells we would continue to produce and which we wouldn't, based on the overall economic analysis, because gas prices were awful. So I think the gas price situation, coupled with the cost to move gas, sometimes puts the industry in that situation. I think the good news from many of the statements that I've looked at is that the gas portion of the revenue is not huge. So it is a very oil-driven play, and you would probably drill the wells even if you thought the gas was going to be negative a lot of the time, because most of your revenue is coming from oil. Now, that could all change if, oil prices go very low. I mean, the market gives to us prices, unfortunately. But having done a lot of reservoir evaluations, I have been in a situation where we looked at shutting in wells. Some operated and some didn't, just because the gas portion was uneconomic. So it just depends.
Okay, well, we're talking North Dakota and the Williston
Sure.
Basin, but when we look at a negative value, then 100% of your revenue is from oil, right? If it's negative
Yeah,
all the time for gas.
that's true. That's true.
And if you shut in or curtail your well, you do have, because of capacity limits on your gas production, at least you have that oil to produce another day, right?
Sure, of course, and the gas
But if
too.
you don't, if you sell all your gas, there's some point where it's worth shutting it in, isn't it? If you're paying too much for your gas processing. I mean, you have to do an analysis on it. I don't think you can just say firm capacity is better no matter what you're paying.
Well, if the alternative is because of quadomethane and, trying to meet.
Quadomethane, though, is not under our purview.
No, but it's a
so-
consideration for the operators,
yeah.
right? So when they're looking at their economic analysis, they've got to consider all of that. And you can do an economic analysis, and one of the other things you have to look at is how many days of shut-in are you going to have? Can you predict that? Can you look at when you're going to be shut in or curtailed? And how does that affect my economic return? Would I be better off drilling a well somewhere else or trying to focus on areas that are less gassy, if that's possible? In some places it is, because that affects my rate of return. So there's a lot of variables that go into that, but you're exactly right. You can model that.
So my point is if you don't look to see how much the post-production costs are and compare it to others, how do you know that they're reasonable or not?
Well, you can compare to others, but the tricky problem with that, and we get asked to do this a lot, is coming up with an accurate economic comparison and talking about exactly the things that I was talking about on Palermo and Robinson Lake, and that is, are we getting the economic advantages for these different alternatives on the same basis as we're comparing them? Because if you're sending your gas to Robinson Lake and it can't get into Northern Border because it's not dry enough and you have to pay to reprocess it, or the value of the gas is lower, what is the overall value proposition of that to the producer? So it is a very detailed analysis, and you should look at your alternatives if you're a producer.
Okay, thank you.
Would you take a look for a minute, please, at Mr. Gatling's, I guess it's S 85, page 25?
I will try to find it here.
What was it? 85. 85.25.
Okay.
Lisa, did you look at all at the Little Missouri 4 gas plant and gathering system?
Only, only to understand its capabilities. I really didn't, we didn't go there, and I haven't delved into what's actually happening on the ground there, but I do understand the equipment there and its capabilities.
Is it capable of the same deep extraction that the Tauga gas plant is?
I think they can recover some ethane. I'm not sure they recover as much because it's the tariff to go on Elk Creek all the way to Conway or the Gulf is relatively high to recover the ethane because the ethane's the least value product. So if it's only worth 25 cents and your tariff's 25 cents, you wouldn't always recover it.
So the big difference that you're pointing out is Elk Creek to Conway, Kansas versus Vantage to someplace in Alberta.
Exactly.
Okay.
Yes.
But the plant has the same capabilities.
I think they can recover ethane. It's just a question of whether it makes sense to do so economically.
And Hess processes 100 million a day through LM4?
They have that capacity available. I have not looked at the throughput to see every day what it is, but yes, they have 100 million a day there.
And were you asked, or did anyone ask about the tariff calculations for LM4?
No, they would be part of the gas processing module.
Okay.
I don't think it delineates one from the other. It's just gas processing, because gas can move in the system just based on pressure.
Does Hess pay Targa a tariff for the gas that goes to LM4, or
No,
or
they-
does it do all the books on its own gas for its share of LM4?
They co-own it, so they have that 100 million of capacity is for Hess, so they would pay their proportionate share of the operating, and then they utilize that capacity. They don't pay a tariff for it.
Okay, so they just, do they apply the same tariff process to
Yes.
their capacity at LM4?
Yes.
Thanks.
It's my understanding that Targa doesn't use their 100 million, that they might only use 25% of that
On Targa's side,
on Targa's side.
I don't know anything about that. I'm
So
sorry.
I'm just wondering, does Hess get charged half of it, or do they get the proportion that they're using of it?
Better question for Mr. Gatling. I'm just not sure.
Okay,
I
thank
just
you.
didn't dig into that.
Lisa, if I understood the testimony correctly, the recalculation that Hess did, that's the only time you've ever seen that?
That's the only time I've ever been privy to that kind of calculation. I mean, I know that we used to do those kinds of calculations when I worked at ARCO, because we would routinely be asked to do time allocations for people who worked with us and for us, but I've never been involved with it at that level.
And do you have, what's your opinion on the overhead rates we've seen for JOAs, from what I can recall seeing, they're almost always lower than the rates for the non-JOA wells. Why is that?
I have not done a study, but what I've picked up in looking at the data I have seen is that those tend to be from older wells. And so the rates were set quite some time ago, and they're being escalated off of older JOAs rather than there being, 2015 JOAs. But I haven't done an exhaustive study of that. That's just been my observation of the ones that I've looked at.
And the tariff model that Hess has here, their cost of service, have you seen a tariff model used anywhere else?
Tariff
In a
models?
similar,
They're not all called tariff models, but yes, a lot of the midstream contracts for the big shale infrastructure are done on a similar basis for the exact same reasons.
Okay, thank you.
Lisa, just to kind of clarify a few things here, you had many exhibits showing the different facilities, compression, so on and so forth. And I think as Mr. Hicks was asking, and I want to make sure I understand that too, you didn't do an actual audit to ensure that what was being billed out, you've seen the actual sales for the different equipment, you just simply did a site inspection and stated that, yes, that compressor is needed to move the product down line.
Looked at how it was all designed and put together and laid out, yes, and talked to them about how it was built, and then looked at the capital expenses, but we didn't audit the capital expenses.
So would it be of your opinion that an audit to verify all those would be a little bit more accurate way to determine what is being billed out to all the parties?
So on the tariff models themselves, so remember there are only 4, I think, rates that are determined in that fashion, that you could verify some of the data and information on a sampling type basis. I think it might be an overwhelming task to try to audit all of that. I mean, it's a lot of just the 100 and however many pages Mr. Naresh showed you. There's a lot of data and information in there, but maybe on a sampling basis, there could be a review of some of it, sure.
And one more for my own knowledge, you were stating that the modeling could be changed to adjust your rate of return, your capital. Am I stating that correctly?
Different formulaic approaches?
Correct.
Sure.
So if that's the case, how would the commission, how would anybody, I guess, go about determining which is the correct one if many different models can show you something?
So there's not always just one way to do things. And in modeling economic contracts, investments, wells, all those kinds of things, there are different ways to do things. And you can still wind up with the same answer. And so someone else might take the approach where you would have to manually goal seek and go through. This is just a different way to do the exact same thing. So it's a different sequence to get to the same answer. I mean, somebody could build the model a different way, and I think there are people on my team who probably did a couple of those exercises, doing some of these calculations in a different way to verify them. But I don't know that it needs to be redone. It's just this is a unique way to do it. There are other unique ways to have the exact same outcome.
Thank you.
Mm-hmm.
Any additional questions? Anything else, Bruce? Any follow-up questions from council?
Just 2 really brief topics from me. Ms. Adair, there was some question about, and if you turn to your slide 36 on that producing overhead calculation, there was some question about the, how the rate has recalculated, how that changed over time.
Yes.
And do you recall, if we look at 36, you see that initial 2017 estimate? Do you see that? Where
Yes, the 1717, yes.
Yes. And then I think Mr. Gower Kumar discussed, but they continued to look at their analysis and noticed a couple buckets of costs that they had missed in that analysis.
Yes.
Remember? And then that got to the approximately 2,000 number, which is shown as the final step, right?
Correct.
And there's about a $300 difference between those 2 steps, correct?
Correct. And then I think the 4th step was in April, they applied the CPI.
The COPUS adjustment,
Yes,
right? And so
yes.
I just wanted to, just a minute, so we have a clear record on what happened.
Yes.
I'm going to put an exhibit A60 in front of you.
Okay.
And one of the applicant's exhibits, but I believe this is one of the documents that you looked at in preparing your expert report, correct?
Yes.
This is, if we look at A60, it's simply
Exactly.
it's simply a chronology of the producing overhead rates that were charged in the subject wells from December 2016. Oh, my computer just went to sleep.
Yes, to April 2017, and it shows the initial estimate of 1717, the adjustment of 304 applied for 2 months. It's a 608, which gets to the 2629.
And let's stop for a second and unpack that, just because I want to make sure that everybody's following along. So we have the 1717 rate, which corresponds to the initial estimate shown in page 36 of your slides, right?
Yes,
And then that's charged for 2 months, for January and February, right?
correct.
And then we, in March 2017, the applicants, if we look at the total overhead rate, we see a total charge of 2629, right?
Correct.
And then this is broken down into base overhead rate and overhead rate adjustment. Do you see that?
Right.
And the base overhead rate shows 2021, $2,000 and $2,021.
Yes,
And what does that correspond to?
that is the rate prior to the CPI adjustment that's shown on
That's the final step
Yes.
row, the outcome of the final step
Slide
row on slide 36?
36.
Okay. And then the 608, what is that?
That's the out-of-period adjustment to bring January and February to the same $2,021.
So in other words, the 1717 charge in January and February were each was $304 below the final calculation of 2021? And so
Correct.
that 608 was charged as an adjustment for January and February?
That's correct.
And then the 2,132 charged in April, what is that?
That is after the application of the CPI to move the 2016 basis to the 2017 CPI number.
And that adjustment moved up the rate by, it looks like, just over $100.
Exactly, yes. And that's what I was recalling. Thank you for that.
Okay. No, just wanted to kind of clarify the record on exactly how that played out. And then the second area I wanted to ask you about, there was some question about well economics in relation to post-production costs. Do you remember that?
Yes.
And what I wanted to ask you is a couple things on that topic. One is, if you were going to run an economic analysis, would you run the economic analysis of gas in isolation or oil and gas together?
You would run it together.
And is it your understanding that Hess Bakken, as the operator, incurs the same post-production costs as the other working interest owners in the wells it operates?
Yes, as Mr. Gatling explained, Mr. Fraley explained.
Do you think that Hess Bakken would continue to drill and operate wells in the Bakken if doing so was not economic to them?
I would think they would not, no.
No further questions.
I think we're all ready to go home.
Okay, well, has submitted any
Yes,
additional witnesses or any,
No, we'll rest our case.
okay? No rebuttal,
We have a briefing scheduled, no rebuttal.
okay?
And the briefing schedule's already in the record, isn't it?
It is.
Yes, okay.
So before we leave, is there anyone else present that would like to make any public comment or submit any information to the commission? Because after this, I'm going to close the record and for the purposes of any testimony or written comments. Seeing nobody who would like to present any written or oral comments to the commission, the record will be closed in this matter and will go off the record at 4:28. Thank you, everybody.